and what goes on inside that company. Meantime, Nippon Steel's vice chairman will visit the U.S. again next week to discuss the company's $15 billion bid for U.S. Steel. That deal has, of course, been delayed because of concerns from the White House and United Steelworkers Union over foreign ownership of U.S. Steel. And a new report from Adam Research finding that the cost of a typical home, now we're talking about mortgage payments, property insurance, and taxes, well, it consumes 35% of the average person's wages. That is the highest share since 2007. Rising costs along with mortgage rates, now near 7%, have outpaced income gains as a shortage of listings pushes the medium price to a record high now of $360,000 across the nation.
Seems like a big percentage.
Seems like a very big percentage.
Paycheck.
You bet.
Another twist in the Paramount Global saga and Julia Boorstin. You just might as well wait around here. You're back on set.
Just wait around until the deal is done here. Yeah, so the latest drama here. Now, it's been less than a month since National Amusements deal to merge its Paramount Global with Skydance fell apart, and now the deal is back on. This according to sources close to the situation. Last night, David Elson's Skydance and his partners Redbird Capital and KKR reached a preliminary deal to buy National Amusements with a plan to merge Skydance with Paramount and also to inject $1.5 billion into its balance sheet. Now, sources tell me that last night the deal went back to Paramount's board of special committees on the board for approval. This is a step which the last deal never quite reached. Now, what's changed since National Amusement called off talks after agreeing to financial terms of the deal back in June? First, this new deal offers National Amusements more legal protection from any shareholder lawsuits, and now National Amusements would be paid around $1.75 billion for its equity. That's up from the $1.7 billion offer that Redstone rejected last month, though it's still down from the original offer to Redstone, which paid less to Class B shareholders but left Redstone more exposed to potential shareholder lawsuits. So what's next? If this deal is indeed approved, then there's a 45-day go-shop period for National Amusements to look for better options. But guys, this deal's far from done. It seems like this does seem like the most likely deal, in part because remember that Skydance owns so much valuable IP, 50% of Top Gun, 50% of Star Trek, and these franchises that are really core to Paramount's value.
What do you make of the Diller? We talked about it yesterday, but the Diller at least being around the hoop, and Sony being around the hoop, and all the other players being around the hoop, because the other piece of this is that there might be a go shop.
There is this go shop period.
So if this period happens, do you think that there's going to be other people who are going to?
Okay. Sony and Apollo expressed interest. They were going through the process, and then you have the fact that also Barry Diller and IC expressed interest and signed the NDAs. But neither of those deals are as far along as Skydance is. And the thing to remember is it's a very complicated deal, complicated to structure, because you're effectively buying out the controlling shareholder, not actually doing a deal. This is really, the Skydance deal is a merger, and it's really contingent on a lot of the IP that David Elson and Skydance controls. So I think that we'll see what happens. This is an incredibly unpredictable type of deal, but this is the one that seems most likely.
And what about the shareholder piece of this?
Well, the real question is, what is the shareholder lawsuit piece of this? And the way this is structured is designed to make Sherry Redstone less concerned about shareholder lawsuits and shareholders less likely to sue. Could there still be shareholder lawsuits? Yes, of course.
Well, that's what I was going to say. There's almost invariably going to be lawsuits just because that's what happens. And so then there's going to be the timing piece of how quickly a transaction like this could close.
Yeah.
I was thinking if they wait long enough, the fortunes or the prospects might improve, but then I don't know. I mean, obviously they didn't get top dollar. Nowhere near it. It's kind of sad.
But this isn't when you say when.
But it might even be lower eventually.
Yes.
Instead of.
I mean, look at the stock now. I mean, the stock is so far down off of its peak. This is an industry that's suffering from cord cutting.
Is it the bottom or is it a falling knife? That's the question. I think it might. That's why Barry Diller's interested. He thinks the legacy assets are undervalued.
Yeah, and in terms of the Barry Diller deal, multiple sources have told me, look, this is a long shot, but he figures might as well check it out. Joey Levin, who runs IAC, is always looking for new opportunities, and worth checking it out when it was still in the market. We'll see how long, how long this all lasts.
Thank you, Julia. Appreciate it. And happy 4th of July.
Happy 4th of July.
Talking about the 4th of July, we should mention the travel rush expected to be the busiest in history, all of history. We're going to speak to the CEO of Kayak about the booming business of vacations, and then Digital Assets Subcommittee Chair French Hill on Donald Trump's promise to loosen crypto regulation if he returns to the White House. Squawk Box returns with all that after this. News just in from Southwest Airlines this morning. The carrier has adopted a so-called poison pill. This after activist investor Elliott Management disclosing an 11% stake. Now, Elliott has been pushing for changes at Southwest and criticized the airline's management team after the company's latest cut in revenue guidance, shareholder rights plan, making it more difficult for Elliott to increase its stake without negotiating directly with Southwest.
Join us now for more. Jim Paulson, author of Paulson Perspectives at Substack.com. Big fan of Godfather 3. They pull you back in, don't they, Paulson? What happened to? We said goodbye. We need to take that all back. Just couldn't. Stay away.
Once you got a hobby for too long, Joe, you can't stop.
Exactly. Woody Allen talked about that. Now you're knocking my hobbies. We saw 24% last year. We got 15% in the first half of this year. You were one of the few people that were pretty friendly towards the market all last year. How about after what is that, 24 plus 15? That's like 40% in a year and a half. More to come?
I think so, Joe. We're still up 15% from its high at the in the market in the last cycle before we had the bear market. in 2022, which isn't a lot. That's 2 years where we've gone up 15% from that high, if you will, overall. I just think, I guess, I think this bull has been operating on less support than it normally has, Joe. And it's because the Federal Reserve has opted for this very unique policy cycle. This is the only bull market in post-war history that has existed entirely under a Federal Reserve which is tightened throughout its entire existence. That's never happened before. Usually the Fed eases rates before a bull even starts and eases in a good part of the early part of a bull market. This one got nothing but tightening. And the result of that has been, I think, a very narrow bull market because a lot of its supportive pieces haven't showed up yet. All the market's really gotten so far is disinflation, which has been very beneficial in helping the economy and the market go up. But it's missing a lot of other pieces that could come if the Fed eases. The big one, of course, is lower bond yields and lower interest rates. But also, if they ease, monetary growth will pick up. It's been negative most of the time in this bull market, year-on-year growth. But if liquidity starts to improve, that's a big plus for the market. And then lastly, confidence would increase. Consumer and business confidence would increase, which also typically is associated with bull markets. And I think because it's lacked these other catalysts, it's been a very narrow advance. So if the Fed does finally declare victory on inflation here, which I think they're gonna, and we do cut rates, then I think we're gonna see a lot more stimulus come for the stock market, and we kind of might have a move that looks a little like the start of a new bull market that we never got in this cycle yet.
The rise in rates orchestrated by the Fed didn't come till after a couple of crazy things, unprecedented things like the pandemic and like staying at zero for like 6 or 7 years. So, and then there's a lot of liquidity just built up from that. And maybe they did go up 500 basis points, but you look at, we keep hearing how much money is ready to go into the stock market, Jim, whether it's from the Fed or whether it's from all the stimulus that came even after the pandemic was over. There's $6 or $7 trillion laying around ready to come in. So it all does play into what you're saying, but it just doesn't seem like it's organic liquidity. It seems like it's faux $33 trillion in debt liquidity.
Well, I think that one of the things that makes me feel pretty good about this is that the economy, to me, I think still not likely to fall into recession anytime real soon, Joe. And the reason is because the private sector is pretty healthy, really. And a recession needs vulnerabilities in order to bring the economy down. And I just don't know where they are. The balance sheets of the household sector are very strong. Debt-to-income ratios have been falling for years. Debt service ratios almost at a record low. Real wages are going up. Job creation is still happening. Net worth to disposable income's close to record highs. The corporate sector similarly in really good shape with low debt-to-equity ratios and high net cash flow to GDP ratios. Corporate profits are at new high. I don't know where the recession's going to bite to bring this thing down.
But
without the vulnerability.
That could all be government, or at least a lot of it. And even when you talked about, I've heard net income is up too, because real wages are still down from 3 or 4 years ago. Net income's up because of pandemic stimulus in the period. So my only point is, I know there's a lot of money there. There's a lot of our corporations benefiting from the Infrastructure and Inflation Reduction Act and the CHIPS Act and all these subsidies. Is that, in your view, that there's no piper that needs to be paid down the road, or don't make me chase now? You think it's going to be like this long enough to where you want to be in, but is it healthy?
I think so. I think the government policy has gotten way out of the box, Joe. I'm not going to argue it isn't. I mean, monetary and fiscal policy bull have gone off the rails starting with the financial crisis in 08-09, and we've never put it back in the box. That may come up someday, but I don't think that's going to be part of the rest of this bull or the rest of this recovery. I think that comes up maybe in the next recession or something, but not now. To me, I also can't think of another bull market cycle that ended when there's this much pessimism around. When you look at consumer sentiment or small business sentiment, they're closer to recession-like lows, and bull markets and cycles generally end when there's more optimism. How does a recession win if everyone's waiting on recession? They're all hunkered down, pessimistic, know it's coming, and that means they're prepared for it. I just don't know how we have it. I think before this is over, we're going to see optimism truly rule in the private sector and more aggressive behaviors, and people get out over their skis.
Nobody has a recession. We did have a recession. Everybody had, pretty good probability for a recession. That's gone already. Nobody thinks some of the soft landing is. That's the narrative we have right now. So some of the complacency might be wrung out. We'll check back. So how long are you going to do this gig? I mean, are we going to have another retirement party, or can we count on it? Should we call you in 3 months or something? Can you guarantee you're going to be
absolutely.
there?
I mean, if you're gonna, if you're gonna sponsor the retirement party, I'll be there, Joe.
No. I don't even know what that means. Retirement. You can't retire from who you are. That's the way I think of it right now.
That's kind of where I'm at. I enjoy it too
You can't retire from
much.
being Jim Paulson, and I can never, as many people would like, as much as they'd like, I can't retire from being Joe Kerner. I don't think. It's
That's
impossible.
right. That's right. It's a good thing, Joe.
Yeah, it is. See you later. Thanks.
Okay. Coming up next, the CEO of Kayak talking travel trends in the 4th of July holiday rush, supposedly the busiest day, or busiest July 4th in history. We're coming right back after this.
Time now for today's Aflac trivia question. What national park constitutes the largest subtropical wilderness in the U.S.? The answer when Squawk Box returns. Now. And now the answer to today's Aflac trivia question. What national park constitutes the largest subtropical wilderness in the U.S.? The answer, Florida's Everglades.
4th of July travel rush is expected to be the busiest in history. You're not at O'Hare, are you? Well, Philbo joins us now.
I'm not.
No, I would
not, Joe, I know.
drive some. People flying. Why bother? Driving a great open highway. It's nice. Stuckey's is around.
Depends on where you're going.
I would drive. Yeah, you're right. Yeah, you're not
Yes,
driving. I'm not
but for
driving
a
to
lot of people,
Bahamas.
Joe,
Yeah.
yeah, you're not driving. Yeah.
Actually,
If you're
people
going
try.
down the Caribbean right now,
People trying those old Buicks. I see them sailing around those. They're coming here usually though.
true. That's true. And you see plenty of them everywhere. Let me show you what we're expecting in the skies, because it will be and has been a very busy week. Busiest week ever? Well, if you look at the numbers, it backs it up. There, in fact, last Thursday, go back to last Thursday. It's really when people start measuring 4th of July travel, about a week beforehand and 3 or 4 days afterwards. A record number of flights, almost 54,000 in one day. And we are on the cusp of seeing our first day with 3 million passengers being screened by the TSA here in the U.S. For some perspective on in terms of travel now and how many people are flying versus last year and previous years, take a look at the number of people screened by the TSA. In June, the daily average was 2.73 million passengers per day, well above what we saw last year, which was a record year. And most people believe, again, that we will see a 3 million passenger day, maybe today, maybe on Sunday, which is when a lot of people come back from the 4th of July. Domestic capacity is part of what we're seeing driving the number of people who are flying right now. If you're looking to go somewhere, generally speaking, you've got more options than ever before. And in certain markets, there's too much capacity. Let's say Las Vegas, that's a good example. A number of destinations in Florida. The industry has added so many street seats to some of these destinations that many believe that when you get past Labor Day, we're going to see a pullback because there's overcapacity in the system. Take a look at shares of the major airline stocks, including Southwest, and I know you guys just had the news about the adoption of the poison pill. Remember that airfares are down about 2%. Some of that is because of this overcapacity in the system domestically. But right now is, relatively speaking, a great time to fly if you're looking for a domestic airfare, because you are seeing them close to, not record lows, but really darn close to the lowest levels we've seen in a long time, guys.
You know, Phil, the post-pandemic, what we saw, the big rush to do all these things, I think it may have moderated, but we're at a permanently higher level, I think.
I think we are. We talked to Ed Bastian about this last week. They see no sign of slowing bookings. It is in the system right now. Now, corporate travel is not yet back to pre-pandemic levels. It's still a little bit below there. But in terms of leisure travel, we're there. And we're there for, I think, I hate to say for good, because something may change if you get a recession, etc. But we're there on a permanent basis in terms of crowded airplanes, crowded airports, a lot of people flying, doing leisure trips.
Right. What else are you going to spend your money on once you got a couple of big screen TVs? So again, you got every streaming service. You got your bundle.
I got an idea. Go out to Yankee Stadium, see your Reds play the Yankees.
That's did you see last night? See Ellie?
I did. Who doesn't like watching Ellie?
You know what? I think it's just beginning. It's just beginning, but we were just talking about it. In fact, who's here? He's only hitting 250, but 250 is like 330. It's like today hitting 250 is like hitting 330 because everybody's swinging for the fences. Is that why? But
right.
If he hits, if he
bottom line,
stretches,
you have to when he is on the field, you have to watch him. Most exciting player in baseball right now. One of the most
because
exciting
if he hits a
players in
single, it
baseball.
usually turns into a triple because of those strides.
Right.
It's really exciting.
Mm-hmm.
He was so proud yesterday too, in front of all the DR people, the Dominican Republic people in the stands. He was so proud. It's awesome. It's a great story, Phil. Thank you for bringing
It
that
is
up.
fantastic.
You were a Cubbies guy, right? Or a White Sox? You Cubbies or White Sox?
I tend to be more of a White Sox person, but we don't like to talk about that right now. It's a rough time on the south side of Chicago.
It is. Yeah, that speaks volumes. When is it not? All right, thank you.
Meantime, let's bring in Kayak CEO Steve Hafner, get a sense of what's going on in the skies and travel. Steve, it's great to see you. As you know, I am a regular and almost religious kayak user. More for the interface than anything else. I think maybe it's I'm not sure. I don't know if it's just been doing it for so long. So Steve, what are you actually seeing? And I know you're more on the consumer end of things than on the business side of things, but in terms of where you're seeing prices and what kind of appetite there is for this sort of YOLO economy to continue.
Yeah, thanks, Andrew, for having me back. And I love and appreciate your using kayak. You know, Phil got it right. It's a very busy travel season, which is a great time to be in the travel business. You know, we are going to see 3 million people a day passing through airports. I'm highly confident of that. And then the roads are going to be crowded. So if you talk to AAA, there's going to be over 60 million people on the roads this weekend, which is an amazing thing because July 4th is on Wednesday. So all that travel volume is smeared out, if you will, across 2 weekends. And for those of you who are traveling by air, you're getting great fares. So, you know, I think the average airfare is down 2 to 4% domestically year over year. But if you pick your route right, you can be down 18% according to Kayak's data. So if you're going down south to like Florida, great deals to be had. I don't know why you want to go there because it's pretty hot, but great deals to be had there.
What do you think is happening in the hotel and lodging universe?
So for the moment, prices are still high because demand's still high. So according to Kayak data, hotel and car queries are up 6% year over year. And prices on the hotel level, about $280 a day, so up 4%. And if you're renting a car, it's about $100 a day, up 6%. But I suspect as we head into the fall, those prices will come down. That's typically what happens. So if you can afford to wait, do so.
Right. The 2 to 4% decrease in prices on air, is that economy or is that across the board?
I think it's capacity.
Okay.
You know, so the airlines added a lot of capacity going into the summer flying season, and demand hasn't quite kept up with that. And I also think their input costs, so fuel and labor, are a little bit lower than they anticipated. So they're able to lower prices a bit. But, you know, if your average airfare domestically is still $350, which is robust, unless, of course, you're flying Spirit or someone else. And if you're trying to get outside of the U.S. to Europe, for example, that's $1,100 for a coach class seat, which is still a high ticket price.
Okay, final question, just because I'm a cheapskate and I want to get some value. Do you actually think the combined deals are better, or do you actually think separating things are better? I've always found the separating things turns out to be better in the end, but I know that's not the business model.
Yeah, no, if you bundle flights and hotels, you typically will save, but you lose flexibility, right? So I tend to, and most Americans are like this, they don't buy bundles. Europeans are different, they do. But I think if you actually really want to save, Andy, I know you like using the Kayak app, take a picture of a travel itinerary, send it to us via the Kayak app, and we'll tell you if you got a great deal or not. It's pretty cool stuff.
Okay, cool. Steve, thank you. Happy Independence Day.
You too, Andrew. Take care.
Coming up, we got some stocks to watch, and then we're going to talk crypto regulation in the upcoming election with Congressman French Hill. Squawk Box will be right back.
you waiting for?
Welcome back to Squawk Box here on CNBC. I'm Dominic Hugh. Here's a look at some morning movers. We'll kick things off with a check on deal news. Paramount Global shares up just about 11.5%, now 12%. Over 250,000 shares of trading volume. This comes as deal talks resume between Paramount's controlling shareholder National Amusements and David Ellison's movie studio Skydance, with a new preliminary deal being reached. That's according to people familiar with the matter. Talks had, remember, ended with no deal just weeks ago. A special committee at Paramount is currently reviewing the revised proposal. Next up, a check on electric vehicle giant Tesla, up just about 2% or so, 4 million shares of volume, a day after a 10% gain on the heels of better than expected quarterly delivery numbers. The run today continues to trend higher. That's already seen, by the way, a 66% rise just since the lows that we saw back on April 22nd. New this morning, analysts at Wedbush have upped their target price on Tesla to $300. It was $275. They maintained the outperform rating. Tesla reports its quarterly earnings on July 23rd. And we'll cap things off with a look at shares of MGM. They're up just about nearly a percent or so. Thinner trading volumes. We're getting some help from analysts at BTIG, who've initiated coverage of the casino and online betting platform operator with a buy rating and a $52 price target. That's possibly about a 23% upside from last night's close. They're citing things like near-term upside revisions to estimates thanks to better results in Las Vegas and China, also an underappreciated digital gaming business. Now, for more on that and other top analyst calls of the day, just head over to cnbc.com/pro. Subscribers there get more access. Andrew, I'll send things back over to you.
Dom, thank you for that. Meantime, when we come back, the pathway of manufacturing, the path that brings boxes to your doorstep. We're going to take a deep look at the global supply chain and its impact on daily life. The author of How the World Ran Out of Everything is going to join us as we head to a break. We'll look at crypto this morning. We're going to speak to Congressman French Hill next about regulation of the industry. Squawk returns in just a moment.
Now.
Well, it's been widely reported that former President Trump would loosen crypto regulation if elected. The comment was made several times, but also at a Republican fundraiser in San Francisco last month. Joining us now to talk crypto regulation in the upcoming election, Arkansas Congressman French Hill and Vice Chair of the Digital Finance Committee and Chair of the Digital Assets Subcommittee. Congressman, it's good to see you. Welcome. How are you?
Hey, Joe. Good to be with you.
It's widely thought there'd be a light touch across the board on a lot of regulations, maybe, antitrust. We've heard about crypto, but he's the former president is a mercurial guy that can change his mind, whether it's about TikTok or take your pick. Do you have a high degree of confidence that the environment would be better for Bitcoin and other crypto assets if the former president, maybe I got vice president on my mind because of what's happening today, but do you think the former president would be more friendly?
Well, Joe, it's good to be with you. Look, I think our Fit for Purpose Fit 21 Act that we passed in the House with 71 Democratic votes is exactly the kind of framework that President Trump would support were he reelected and brought back to the White House, because it directs the SEC and the CFTC precisely what kind of regulatory framework we need for crypto, for people who are innovating and starting a token crypto-related firm, how to trade, how to custody those assets, how to make sure consumers are protected. So that framework, I think, is the right approach, and I think that's what I would recommend to the president that he endorse if we haven't passed it between now and the end of this Congress.
You, as a vice chair of the Financial Services Committee, what else would you expect from a re-elected President Trump?
Well, on the Financial Services Committee, I think you'll see that President Trump wants to be a pro-growth, pro-innovation president, and therefore something like the Fed and the supervisors are considering now this Basel III new capital standards for our commercial banking industry. I think that's a very pro-cyclical approach, meaning it will exacerbate downturns. It's a approach that we don't need. It's an approach that even the banks in Europe are generally rejecting. So I would hope that President Trump would reject something like full implementation of Basel III and use a much more tailored, appropriate view to bank regulation as well.
Congressman, one of the things that we hear a lot about is his plans for tariffs on China and others, and the inflationary effects that could create. You look at some of the reports in terms of when people try to do their estimates of what that could mean. And the one thing that I'm sort of yet to be convinced about, but maybe you have a different view, is that I'm not sure that he would actually necessarily go through with all of these tariffs, even though I know he says that he would, and that they are more potentially as a political cudgel that would be used to negotiate for other things from a China. But I don't know if you think we should take it at face value and take the estimates as what they are, in which case we would have enormous inflation that would actually be a real headwind, or we should look at it as something else.
Well, Andrew, I think it's a good question. I spent a lot of time in trade when I was a White House staffer for President George H.W. Bush. The Trade Policy Review Group was part of my responsibility looking at tariffs and other trade-related negotiations. And I think you're right. I believe that President Trump says to our countries, from big countries, huge trading partners like China, to others, we're going to impose tariffs on you if you dump goods in our market, dump goods in third countries that then get sold in the United States. And that it is, as you say, a cudgel to bring people back to the negotiating table and have a fair trading relationship. We saw President Reagan do this in the late 1980s with Japan. I think this is the right approach because, as you say, across the board tariffs imposed on all imported goods, obviously that's going to contribute to inflation and not necessarily increase production of those similar goods here in the United States.
So, Congressman, there's a lot of your colleagues are meeting with President Biden at, I think, 25 or so. I don't know if they tell you what they're going to talk about. Obviously, they're Democrats. governors. He's going to hear from some governors. What do you think they're going to tell him? And we've got, not that betting sites, they change very quickly, but it's been amazing to watch Vice President Harris and President Biden more or less with the same numbers for who becomes a nominee and the chances of becoming president. Do you think President Biden can survive at this point? Do you think he'll be the nominee?
Well, as a Republican, I hope he's the nominee because I think President Trump can beat him in a re-election bid. But let me say on behalf of the whole country, Joe Biden is not being rejected because he's too old. He's being rejected because his ideas are terrible. He's made terrible decisions in foreign policy to coddle Iran, not push back authoritatively and aggressively against Russia and Ukraine, the horrible exit where 13 of our military were killed coming out of Afghanistan, and then his domestic policy where he's green-lighted $6 trillion in new spending, and the budget deficit, the CBO says it's going to be up again this year, is up because of his dumb student loan forgiveness idea. So look, he's going to be a candidate that Republicans can campaign against in the House and the Senate and at the White House. But I think it's because his ideas are bad, not because he's too old.
Well, that's the Biden administration that did all those things. So that putting Vice President Harris at the top of the ticket doesn't negate any of the things you just said, I guess. So
I agree.
Okay. All right, Congressman, thank you.
Great to see you, Joe. See you. Have a happy 4th of July.
Okay, you too.
I was saying that one's a longer conversation to get into some of the policy stuff.
All conversations are long, but some if you cut to the chase, are really not that.
Maybe. Coming up, economist Peter Goodman's new book, How the World Ran Out of Everything, takes a look at how the pandemic disrupted the global supply chain and its impact on everyday life. In the meantime, though, take a look at the futures ahead of this holiday shortened trading session. We are coming right back after this.
We've got this.
Welcome back to the Squawk Box. During the pandemic, we ran out of toilet paper, computer chips, car chips, baby formula, so much more. The new book, How the World Ran Out of Everything, takes a deep dive into the sensitivity of the global supply chain and how it impacts our everyday lives. Joining us right now is the author of that book, Peter Goodman, New York Times global economics correspondent. It's great to see you, Peter.
Great to be with you.
It's a fascinating book, and as you get into sort of all the things that happened during this period, I'm hoping what you can do is sort of take us back, but also spin us forward in terms of how you see the challenges from the past and where you think we are now and what you still think we need to do to avoid this again.
Yeah, you know, it's a really important question because this is not a history book. There's a lot of history in it. It's really about the present and the future if we don't figure this out. Essentially, we're at the mercy of a largely unregulated international shipping cartel to bring us most of the things we depend on in modern life. That's, you know, gadgets and gizmos, it's parts for things we make in the United States, that's basic medicines, that's life-saving gear, personal protective equipment like face masks and medical gowns. A lot of this stuff made in China, a country that, not incidentally, we've decided to have a trade war with. And then we're really at the mercy of badly run railroads, a trucking industry that's been kind of decimated by loss of drivers because we've downgraded that job to the point where lots of people are quitting. At every step of the supply chain during the pandemic, we had these shocks that revealed vulnerabilities that had been there for decades, and they're still there.
And so what is the answer to that, Peter?
Well, we need to look at the supply chain sort of like the way we look at electricity. You know, most of us don't think about the supply chain any more than we think about the electrical grid when we flip on the switch, unless the lights don't come on. This is a moment where we've got to get back to sensible regulations so there's some transparency in how these companies are dealing. We certainly need to hold shipping companies to account when they're jacking up prices, you know, sometimes tenfold in the space of, you know, months and breaching contracts. We've had lots of importers have contracts to bring in containers from factory towns in China to the west coast of the United States. We're told, sorry, we don't have space on the ship unless you pay, you know, 5 times as much in special handling charges. That's just a basic antitrust problem. Same goes for the railroads. We need to get back to more transparency in pricing so that we have some idea what sorts of sweetheart deals are getting cut. I mean, we've got a supply chain that's optimized for a handful of companies, Amazon, Target, right, Walmart, and smaller businesses are just getting screwed.
To the extent that we need more regulation, what does that regulation look like? And by the way, how are these shippers regulated, if they are or not, on their way, by the way, to a Europe or to a China on the other end of things?
Yeah, I mean, they're really not sufficiently regulated anywhere. The Europeans have gone farther than most, but because it's an international industry, and in any given country, you're talking about foreign carriers that are bringing the goods. You know, it's going to take some international cooperation, but it's also going to take the realization that we've overdone it with just-in-time and distant supply chains separated by oceans. We don't need to go back on globalization. Trade is a wonderful thing that's brought us a lot of prosperity. This is not a book about how we need to go back in time, but we need to be more sensible in terms of diversifying our risks. We can't just depend solely on container vessels.
So now let me throw a hard one at you. How do you feel about tariffs? And because we were just talking in the last segment about, you know, the tariffs that former President Trump wants to put on if he becomes president and what the inflationary effects of that may ultimately be. He would tell you, I think, not only does he want to do that for economic reasons, but also believes that that would encourage and incentivize manufacturing and other things back here in the United States.
Look, we saw that movie in the last administration. It didn't work. We actually saw loss of manufacturing jobs because the fact is there are lots of Americans employed in factories in the United States dependent on a global supply chain to bring in parts and components. Those container vessels, they're not just full of finished goods, they're full of, you know, the piece parts of industry. So when you slap tariffs across the board without any look at the details, what you're doing is you're making American companies less competitive. You're separating them from their suppliers, and it will definitely be inflationary.
Peter Goodman, I want to thank you. The book is called How the World Ran Out of Everything Inside the Global Supply Chain. It's a fascinating look into the modern era and all of the sort of intricacies of how the world really does work in a way that I think most people don't necessarily appreciate. So I'd encourage you to check it out.
Coming up, America celebrating its 284th, 248th. Who else has that? 248th birthday tomorrow. We've been together too long. But is the American dream still alive and well? John Fort is here to weigh in. Plus, we're expecting the latest read on ADP employment and initial jobless claims in the next hour. The futures ahead of the data are mixed. Not big moves, any of the averages. We'll be right back.
Us now.
The American dream turns 248 years old tomorrow, counting from the signing of the Declaration of Independence. But with the high cost of living and the growing inequality in the economy, it's fair to ask, is the American dream dying? People say it's already dead. I don't like this one. I hope you come down on that it's still.
Well, you can count on me, Joe.
to move that pen from right to left and for me not to know what you really think.
Yes.
I'm listening close. I hope you make a really good case for one, but it's sort of a wimpy case for the other.
Well, Joe.
You don't do it that way.
The American dream is dying. And it's important to admit that so we can save it. First, a definition. It was first clearly articulated in 1931 by historian James Trussell Adams in his book, The Epic of America. He said, not a dream of motor cars and high wages merely, but a dream of social order in which each man and each woman shall be able to attain to the fullest stature of which they are innately capable. It echoes the Declaration's equality, life, liberty, and pursuit of happiness. So what's gone wrong? Well, in the last couple of decades, this chasm has widened between the rich and everyone else, and it's destroying social mobility. the idea that kids can do better than their parents did. 90% of kids born in 1940 grew up to earn more than their parents. Only half of millennials born in 1985 are doing that. And it sure looks like things are getting worse. Fresh data today shows many millennials and Gen Y can't afford to buy homes. Education, student loan debt per student doubled to top $37,650 over the last 15 years. Now, this post-pandemic inflation surge is the straw that broke the camel's back. How can people be thrilled about earning a few extra bucks an hour when rent nearly swallows it all, home ownership is out of reach, and college loans don't pencil out? Save the dream, fix the system so talent wins, Joe.
The second one that you do is normally the one you believe in. So, what's the benchmark year for the American dream? What are we trying? Where are we trying to get back?
Well, Joe, on the other hand, the American dream isn't dying. Loving America means knowing the truth. The dream's never been fully alive for everyone, and the work of our republic is to make it more real each generation. In 1776, America didn't yet exist as a sovereign nation, much less as a dreamer. July 4th was as much a baby shower as a birthday. And the Supreme Court's wrong-headed 1857 decision in the Dred Scott case nearly killed the potential for an American dream. It took a war to bring it back. When Truzilla Adams animated the idea in 1931, the Great Depression raged and unemployment was on a march to over 20%. So it's no shock that kids born a decade later would earn more than their parents. But here's why the American dream isn't dying. The American people have more access to more knowledge than ever in history. We have better financial products and investing tools, and as expensive as traditional four-year colleges are, between community colleges and online education, getting skills for career advancement doesn't have to break the bank. So bottom line, an essential part of the American dream, and July 4th is sometimes seemingly irrational optimism that despite overwhelming odds, this generation can make things more fair and more economically just for the next one. Things are better than you think, Joe.
No, they're not. They are good. And I'm certainly not going to judge whether the American dream is alive or not by what millennials are doing. All right. So that's no, I'm kidding. I'm kind of kidding. But it's a work in progress. We know it's a work in progress. I would say you're a damn good example. I was in an orphanage when I was born, so I mean, not that I'm the end all be all. Now, well, you were in Scarsdale or something. Maybe. No, I'm kidding. We all have overcome things to get here, and we've got a modicum of success, I think, which is
a modicum. Yes,
a modicum of success. The one thing I was thinking when you were saying that, is there another country where they say, are you going to achieve the French dream? Are you going to achieve the Cuban dream? Are you going to achieve, just because we call it something so unique, and American exceptionalism has stood the test of time, where we argue about whether the American dream is, you don't even talk about that anywhere else. And people, do they not want to come here still to try to get a piece of this, John?
Absolutely, absolutely.
So the second part we believed in more.
Well, I'll tell you what. Read the newsletter, and you can decide which one you believe more with the QR code on the screen, or you can, if you like to type in cnbc.com/OTOH, you get the full text.
We've been arguing about this for years.
And that's what you've been arguing about for years. It's the American dream.
We've been arguing about what the definition of the dream is. Is it the Horatio Alger story? Is it some other kind of story?
I think no. After doing the research on this one,
you know, is it just upward mobility? Look. You could look at I was actually thinking about this. The valuation of the European stock market in 2007 was of all of Europe, was basically the same as the U.S. Today, the valuation of our markets, I think, are 4 or 5 times the entire. By the way, the size of NVIDIA is larger than the entire valuation of all of every stock in France.
You know what that would say? That would say that trying to game outcomes instead of opportunities, and the endless quest for total egalitarian societies ends up lowering everybody down here. You'd rather have some people up here if everyone's trying to get there. I'd rather try to join people at the top than join them at the bottom.
You're not going to get any disagreement on that front. The question is how you effectuate that.
Frickin' July 4th. Can we please be happy to be here and believe in
We're
the mission?
definitely happy to be here.
We're happy to be here.
Okay.
Yeah, and we disagree, which is also American.
Not on this issue.
Not on this issue.
You're going to be less happy to be here on Friday. That's the
You know what?
Just think about it like
We
that.
should never, ever complain
Never.
about,
That's true.
right?
Absolutely.
We shouldn't.
Right, right. That, look, it's a work in progress. Let's get everyone to the point where, you know, if they work hard and do the best they can, get to that position where they have a chance.
Yes.
And then it's up to them. It's 8 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Joe Kernan, along with Andrew Ross Sorkin. Becky's off today. Among today's top stories, sources tell CNBC that Skydance Media has a preliminary deal with Sherry Redstone's National Amusements to merge with CBS and MTV parent Paramount. Sources say Paramount's special committee will now review that deal. Shares of Paramount Global this morning you can see up about 13.5%. Tesla shares are high in the pre-market, and that was a 10% gain, which we saw yesterday. That led the S&P 500. Second quarter production and delivery numbers weren't great, but they beat analyst expectations, though deliveries fell about 5% from a year ago. And Southwest Airlines adopting a so-called poison pill after activist investor Elliott Management disclosed an 11% stake. The shareholder plan, rights plan, makes it more difficult for Elliott to increase its holdings without negotiating directly with Southwest. Elliott had been pushing for changes at the airline and has criticized the company's management team.
Meantime, U.S. markets, they do close today at 1 p.m. Eastern time, but ahead of those, let's show you where things stand in the futures. Dow would open up right now about 35 points higher. NASDAQ off just about close to 3 points. S&P 500, we're going to call that unch. But what we do want to do right now is get down to the New York Stock Exchange, where Mike Santoli is standing by thinking about what may happen between now and 1 p.m.
Absolutely, Andrew. Yesterday, the market kind of woke up after, about a couple weeks of very, very calm sideways movement on the surface. It was the first day yesterday, actually, that the S&P 500 moved as much as 0.5% in 2 weeks. It actually was up 0.6% at a new record. You can see that flattening out right before yesterday. Kind of remarkable. And, we've assumed more or less a similar angle of ascent from the October lows just after that April pullback. Now, a lot of people will kind of criticize, and they want to essentially say that this is not a true reflection of what's going on in the market, because it definitely remains somewhat top heavy. Yesterday was a broader rally, but since this point right there at the end of the first quarter, the median stock in the S&P is down about 1%. The S&P 500 itself is up 6%. So, you're a passive indexer or you own the big cap stocks, you've been okay. Everything else is kind of going sideways. Now, take a look at a couple of more cyclical indicators, because for a lot of this rally, you've been able to say, and I've been able to say, and pointing out, look, things like home builders, things like industrials, they're participating there in uptrends. Now, they still are, but they've lost some altitude here, softened up. In fact, home builders are back to essentially where they started the year. Industrials have just really flattened out. It's been one of the stronger groups, but they first reached these levels in February. So kind of could just be consolidating right here, but it does show you some cyclical areas of the market are looking a little softer as we figure out exactly how much this economy is decelerating. I know we've been looking at and talking about Tesla all morning and yesterday as well. Here's a 5-year chart with the 200-day moving average. I find it interesting. Now you see it kind of poking above that 200-day. Now that trend line is still going down, so usually it takes some work. You sort of saw some efforts there to try to reverse the trend. What I also find interesting is, so 235. 231 was the price at which Tesla traded as it went into the S&P 500 in December of 2020, actually. So been a big round trip, chopped around that level quite a bit, but definitely kind of an aggressive burst yesterday, Andrew.
Okay, Mike Santoli, I want to wish you a happy Independence Day.
You're
Look forward
welcome.
to talking to you again soon. Meantime, we want to talk more about the markets. We got some data coming up, by the way, 8:15, the ADP number. But Treasury yields have come up in the last week, roughly since the presidential debate. Joining us right now is Kamal Srikumar, president of Srikumar Global Strategies. We also heard from Jay Powell yesterday over in Europe about what he thinks the path of things are, which may take a little bit longer than some had anticipated. Sri, though, you've been right about this. The question now is, what do you think the path is?
The path, I think, think clearly depends, Andrew, on what the two candidates are going to be saying and doing from now the next couple of months. Clearly, the yield curve steepened since Thursday night because after Biden's dismal debate performance, because with the chances of a Trump presidency rising, the long-term bond yields have risen. And the issue is, what does Donald Trump do about it? To the extent there is a reaction, and he talks about how deficit may be kept in check, tariffs are not going to be comprehensively issued, but only on selective imports. That is going to give a lot of confidence to the markets and likely to bring the yield down. So that is the immediate impact. Longer term, it depends very much on what the fiscal deficit is going to perform like, because we have clearly a big expansion in the deficit, big expansion in spending, which needs to be controlled, Andrew.
Are you surprised about just how the markets are reacting right now? I mean, we're basically just high, and I can't tell whether you think that we're in for a turn at some point in all of this. And you'd think also there'd be more volatility, even given what we're hearing around this presidential election at this point.
You do have, first of all, two things. One, the equity market is rising and the impact or the influences are very different from the bond market. You have technology, you have NVIDIA, you have the AI boom, which is all affecting equities in a way that fixed income doesn't get affected. You mentioned volatility. You don't have as much volatility on the equity side. But the treasuries have been extremely volatile. You can see if you go back 3 months, how they have been up and down, and we have had in the 10-year yield, we have a move up of about 15 basis points immediately after the debate. So the bond market has taken the volatility hit, whereas the equities are doing well due to other considerations, Andrew. And I don't think that is going to change in the next few months.
And do you think right now the market's just pricing in a straight Trump win? I mean, we keep talking about this sort of prisoner's dilemma issue. If you believe that President Biden is going to get switched out with somebody else, and I don't know if you believe that, does that change the entire equation all of a sudden?
First of all, the bond market is not assuming a Trump victory. It has increased the chances since Thursday. That's the first thing. Second, if there is a switch of candidates on the Democratic side, it depends on who it is going to be. Vice President Harris is frequently mentioned. And if she's the one who replaces him, the question is, what does she say she's going to do in the days and weeks after the nomination? Can it change the conversation? Can it change the direction of treasuries? Yes, it can. But it is not going to be a wholesale definition until the elections are over, because the elections have to end and you have to find out who wins. But if there is a switch of candidate, clearly it is going to influence yields.
Sri, maybe you can tell us where you land on this question. It's my last question, because we got to get some data. Inflationary pressures, one of the things we talked to former President Trump about this idea of what the tariffs would look like and how inflationary that may ultimately be. But what we were talking with French Hill about earlier is, in fact, whether former President Trump would, in fact, implement the tariffs he's talked about if he becomes a president, or whether this is a negotiating ploy, if you will, with China and others.
I think it is very much a negotiating ploy. I don't think it is going to be comprehensive, because I think he and his advisors would realize that it would push up the inflation rate. The question is, though, the bond market right now is affected. Every statement that is made is going to push up the yield. That's why I think, in addition to a negotiating strategy with the Chinese, he needs to have a negotiating strategy with the U.S. voters and be more careful on the statement.
Sri, we got to leave it there. We appreciate your perspective. As I mentioned, you've been right about a lot of this, so we're going to listen to your words with a lot of attention. Thank you. Talk to you soon.
Thank you, Andrew.
Wish you a happy Independence Day. You bet.
Coming up, breaking jobs data. We've got the June ADP employment numbers. That's next. Stay tuned. You're watching Squawk Box on CNBC.
you waiting for?
Welcome back. Futures right now haven't moved much since last time, and haven't really seen a lot of action this morning. A couple of highs though yesterday in the S&P, first time over it's closed at these levels. Same with the Nasdaq, all-time highs. Treasuries this morning, we just got finished talking to Shri. We want to get though now at this point, at least when we got 3 seconds to get the June ADP employment report. Steve has a number.
Thanks for having my back on the timing, Joe. 150,000 June ADP payrolls. They're saying that the private sector, that's what they're trying to estimate. Actually, they're not even trying to estimate the government anymore. They're just saying, here's our measure of private payrolls and how much they rose, 150,000. Goods sector, 14. All the heavy lifting done by the service sector, up 136,000. And maybe a little bit shy relative to the non-farm payroll estimate for Friday of 200,000, unless the government, which is the big difference between the two, does a lot of the work. May revise up slightly from 152 to 157, not really of consequence. Well, where were the jobs? Take a look. You can see they were not so much in small, not so much in, but in medium, as well as mostly in medium and large size businesses. By industry, well, we've seen this before. Leisure and hospitality, 63. Construction doing a bit better. Could be a lot of government construction jobs there, or private sector jobs hired by the government. Professional business service, 25, and trade and transportation. These are ones we've seen continuously. Resources and mining down 8,000. This may be the biggest and most important news here, though, is the median wage. They use actual data from millions of paychecks, and they find that it's down 1/10 in both the job stayers and the job changers, plus 7.7%. This data, I think, is very good. When I look, Joe, at the difference between the BLS private sector payrolls and ADP, it's plus or minus 77,000. And in the last year, they've been a little bit light relative to the government, but the government data is yet to be revised. The ADP will not. So there you go, Joe.
All right, Steve, stay with us. Let's bring in ADP Chief Economist Neela Richardson. If I was going to look for a report to sort of just confirm what recent reports have been indicating, I guess this would kind of be it. Any major divergences from what you were expecting, Neela?
No, this has been a very modulated cool down. The labor market is striking the right note at the right time to be consistent with that gradual easing that's consistent with the 2% inflation target. The concern, and this is one concern we have, is how concentrated these job gains are. As Steve mentioned, they're in the service sector. The leisure and hospitality sector is carrying 40% of the job gains this month. And so while we think that this is a gradual cool down that we all expected, I'd like to see the hiring be more broad-based than it is now.
You know, the details in the numbers, does it make you think that the progress on inflation that we've seen recently, can that continue, or could we get stuck?
Leisure and hospitality, the labor market more broadly, has really helped the Fed. It's helped the Fed be patient. It's kept its pace and then gradually cooled again at the right time. But if you look at those paychecks and the fact that we've broken 5% year-over-year growth with this highly strategic, individualized match data set, that is important. The last time we were under 5% was in August of 2021. So this pay growth, the fact that it is slowing in a modulated way, is so important for the Fed. I think it is the most important data point right now.
Would you change any of your expectations for what we're going to see on Friday based on all the details here?
I think it's harder to predict what's going on in the BLS report. One, government jobs have really been strong in that report the last couple of months, so will that continue? Healthcare has been, again, picked up very strongly in that report. This is a sector that is not as sensitive to interest rates, so we may see that again. But what you really, I think, is worth paying attention to is the unemployment rate. How cool is cool enough for the Fed, and how fast is that unemployment rate going to rise, or is it going to stall? I think that's the key question going into Friday after we all have a break on Thursday.
Steve?
Hey, yeah, Joe, I just want to point out when you're talking about with Neil about wage gains, the rate of decline, this kind of highlights the Fed's problem. It's true of inflation overall, and it's true of wages. It's really flattened out, right? So you went from 5.8 or so back in October of 23 down to 5 real quickly, and in the last 4 months we've gone from 5 to 4.9. So there's not been all that much progress. It's going, as Neil has said, in the right direction, but it's kind of like what's happened with the overall inflation rate, which is you had these big drops in the second half of 23, and now the drops have moderated. And what's interesting, though, about what Neil is saying, I don't see, Joe, how you get, if these numbers are right, 150,000, there shouldn't be much rise at all in the unemployment rate from there.
Neil?
Yeah, just to continue with that line of thinking, we did see percentage point declines last year in year-over-year pay growth for job stayers. We're not seeing that anymore. It's edging down. And our contention when we look at the data is it's likely not to get back down to pre-pandemic levels. The economy has shifted. The demographics are not in the favor of seeing year-over-year pay gains around 2 or 3%. So if you think of a world in the future where year-over-year pay gains are elevated, it does make the job harder for the Fed. They can't rely on basically flat year-over-year gains in some industries. That's not happening.
All right. Steve, thank you. Neela, were you up late, couldn't carry the 3 minus the divided? I mean, were you? When did you find you didn't do that? It's like homework. Is it? It's like getting a paper done. When did it have to be in? 8:15. Had to be in at 8:15.
I always get a good night's sleep for you, Joe, so I can be sharp in the morning. So we make sure that happens.
AI would have given you 150. I'm sure. I'm almost positive. Right?
Likely. Yeah.
That's the future. All right. Call us with the Friday number if you figure that one out. Thank you.
We'll do. Thank you.
Have a good one. Hey, what is it, Steve? What are we looking for exactly?
We're looking for 200, right on the button.
Okay, exactly 200. All right.
Okay. Thanks, Steve. When we come back, another rapid-fire round of economic data. We're going to get weekly jobless claims in just a few minutes. Don't go anywhere. Plus, tens of millions of Americans hitting the road for July 4th. What can they expect at the gas pump? We're going to ask an expert from Gas Buddy. Stay tuned. You're watching Squawk, and this is CNBC.
and Peacock.
Hurricane Beryl making its way towards Jamaica after killing 6 people in the southeast Caribbean. The storm is currently a Category 4 hurricane, but on Monday became the earliest to develop into a Category 5 in the Atlantic. A hurricane warning is in effect for Jamaica and the Cayman Islands. The director of the U.S. National Hurricane Center says Jamaica looks to be directly in the path of the storm. It's expected to weaken slightly in the next day or two, but still be very powerful. Even Friday, when it's projected to hit Mexico's Yucatan Peninsula. And up next, more economic data, jobless claims, and a new look at the trade deficit. Our next Squawk Box coming right back.
What are you waiting for?
Welcome back to Squawk Box on CNBC. We're just about a minute away from more economic data. We're going to get initial jobless claims and a new look at the trade deficit. The futures, you can see right now, the NASDAQ is now down 24 points or so. The Dow Jones down just over 20. S&P backing off an all-time high. It hit Tom Lee's number, closed above it yesterday. Now you can see the 10-year, which is backed up a little bit. Right now, 442. 442. We talked to Shri Kumar a little bit earlier. A lot of speculation now. We talk about it a lot, Andrew, about who's more inflationary if they're elected in November. Just depends on. It's like a Rorschach. A little bit. They're both pretty inflationary. Could be. Rick Santelli standing by at the CME in Chicago. Hey, Rick.
Hey, good morning, Joe. Of course, we're looking towards the trade balance claims. A lot of data this morning before the Independence Day holiday, hitting the wires for initial jobless claims, expecting a number around 235,000. pretty close, 238,000. Now that's up 5,000 from last week's 233, but I would expect revisions to come shortly. 238 is still rather well behaved when you consider that this would be the third month in a row we're in the 230s. Now let's look at continuing claims, a different story. Our last look on continuing claims, we're at the highest level since November of 21. And it's out at 1,858,000. That's a little higher than expected. And in the rearview mirror, the revisions are coming in, subtle on initial claims, and on continuing claims, also subtle revision. But let's put a face on this. So 1,858,000, that would be the highest, continuing to allude towards November of 21. But what's interesting here is this is now the fourth consecutive week above 1.8 million. Trade balance coming out. We know the trade balance is a deficit. We're expecting a deficit, the red ink around 76 billion, 75.1 billion, of course, with a minus sign in front of it. Subtle revision to last month. I guess what's noteworthy here, there's been a lot of benchmark revisions here, but we finished last year basically with 3 or 4 months right around minus 64 billion. We came in this year at minus 66. So once again, it is starting to grow a bit. And we need to pay very close attention to this. Not only does it give us an assessment of demand globally, but of course it lets us know potentially how the U.S. ultimately is dealing with the export-import situation. The imports seem to always run a little bit more aggressive than the exports, although both toy with records. We're not an export-driven economy like China, like Japan. We are, for the most part, a consumption economy, and much of the problems in China would disappear if they only could fan the flames of consumption a little bit stronger. Interest rates, Joe, you're right, they're down a bit on the long end. But let's really look at what we're dealing with here. We're nowhere near 4%. We're nowhere near 5%. We're smack dab in the middle in an election year where tax cuts and deficits and comparing one administration to the other is going to be center stage. And the more that's talked about and the more the press shadow boxes it in the way they normally do, of course, they'll make a much bigger deal about deficits now than they have in the past. I suspect that will continue to pressure longer dated rates higher. And the short end, well, as our Fed chief has pointed out many times, especially yesterday with Sarah's interview, deflation isn't the word, it's disinflation. The Fed likes the word disinflation. The public would rather have deflation because disinflation doesn't make the compounding of history disappear. It just makes it a little bit slower. Back to you.
Well, if you had to say which administration you think would bring about more inflation, the Trump administration or the Harris administration?
You know, I would think that both administrations aren't going to necessarily...
He just goes right into... Are we assuming it's going to be Harris at this point? Rick, I was just saying that because I don't know.
Well, listen, I really personally don't think, everybody's always bashful. I'm never bashful to give you my opinion. I can't imagine that the ticket's going to stay as it is. And if it does, woe be to them. Because, listen, we know that Joe Biden was a much more vigorous person in the past. And I really think that when you look at what happened during the debate night, it really puts to bed all the things that we've been told by the administration and, of course, their water carriers in the press that ignore your eyes, everything's fine. You know what? The only threat to democracy is challenging the public's ability to get to the ballot box in November. That's where democracy is founded. That's where basically it's born. And you know where it'll die? It'll die when we don't get a chance to speak through the ballot box of who we want, what policies we want, and have a chance to vote on how all that is affected. You know that there's so many agencies involved in the Supreme Court this week has slapped down much of the agency activity that we don't have a chance to vote for. So I think, when I read that one administration's the end of democracy, I laugh because it certainly seems as though I have a name for both parties. I call the Democrats the projectors. They project everything they say that the other administration does, they basically do. And I think the Republican Party are kind of pretenders. They're anti-deficits, they're conservative, but yet when they get in power, they don't seem to really act on those principles. I don't know if we need a third party. What we need is a party that delivers their message. And I will say one thing about Trump. People could say what they want about him, but when he had that trading card when he got elected, and he wrote down all the things he wanted to do, he had a checklist. He actually tried to make a difference. Whether you agree with him or his personality, that's one thing. But there haven't been many politicians that say they're going to do A, B, C, and D, and really strive to do A, B, C, and D.
The most amazing poll was the one where more voters thought that Biden was a threat. That was so crazy. It was Washington Post. It wasn't Washington Examiner. Let's get to anyway. We'll get you to weigh in on the 10% tariffs across the board sometime, Rick, because there are some. I mean, both administrations, the Trump and the Biden, knew how to spend. We know that. Steve Leisman joins us again with more on the data and some Fed news. Don't start anything with Rick now, Steve.
Well, I just wanted to offer another perspective to something Rick said.
Thank you. Thank God. Thank God. I was going to say quiet just because I don't want to.
This is the way it
start a riot.
This is the way it always starts.
Well, I offer it gently and just for consideration that people may say they want a deflationary period, but I don't know how many people consider that generally in a deflationary period, incomes go down too. Now, Rick and I may agree maybe short term. I think there's a good argument that if you restore the prior supply chain situation that we had before the pandemic and the prior competitive situation before the pandemic, that indeed prices could go back closer to where they were before the pandemic on a short run basis. But I would just urge people not to wish too much for a deflationary period, because in that period your prices go down and your incomes go down. And you have two examples of that. One was the the great financial crisis, and of course during the pandemic. That's when you had deflationary period. And if you look at what happened to wages and salaries, well, they fell as well. I would just offer that on the jobless claims numbers, Rick already said this, we're towards the high side, but not towards the red flag side, I guess I could say. I would think 250 or above would be where you might get concerned. You have a 1.2% unemployment rate or unemployment insurance rate, and that's pretty much where it's been. As the number of people employed goes up, well, the actual number of unemployed insurance becomes less concerning. And I'm not going to say anything about elections or anything like that, just that almost every study has said that tariffs are paid by the people domestically, not by those companies overseas that would make pressure them.
Go ahead, Rick.
Sure.
All right, I'll tell you what. Here's the issue with tariffs, okay? That you say we're going to just pass it along. I couldn't agree more. But my counterpoint is, look at what the world has been without them being the driving force of any type of revenue. Do you think we should be bragging about $35 trillion in debt? Like the other side of the equation isn't anything to strive for, to throw a flag up the pole and call it success. Maybe going the other way would be better. Pass it on. We pass everything on.
That's fine, Rick, but just don't sell it as something being paid overseas and something not raising prices and not essentially as a tax increase. It's fine. The public can decide, or the government can decide with the public's consent, I assume.
The tax increases they want to bring without the tariffs. The other administration talking about tax increases too.
Right.
I don't
exactly.
understand the difference.
But
prior to income tax,
the difference is
paid for its bills with tariffs.
But one is called a tax increase. The other is essentially lied about as not a tax increase.
Tomato. Both of them aren't going to be generous to us with all this debt.
If that's the way you want to do it, then it's okay to make things up.
Nobody likes deflation because when you're in debt up to your eyeballs, it exaggerates debt. But when I go to the store and see
another reason not to like deflation.
Affected, maybe they would like a little deflation, not crisis era deflation. Why does it have to be like a little, none, or a ton? There's something a little bit in the middle.
Yeah, and Rick, I agree with you that I think there needs to be a little bit more discussion about why some prices have not gone back to where they were before. And we really come full circle.
Let's ask Elizabeth
which is this,
it's because of gouging.
Well, no. Let me finish, Joe. Rick, let me finish. Remember what I said. Prices can go back to their old level if we restore the competitiveness and the supply chain of the pre-pandemic era. Tariffs work against that, Rick. If we want to pay higher prices, if we want to protect.
capitalism reversing out pushes prices up. But you know what? We're going to be better off. Sorry.
You call it,
so we pay.
you call it globalism,
prices,
Rick.
But
I call
what's
it
the alternative.
Okay.
I call it capitalism, Rick. The idea that people have an ability.
Enemies?
I call it capitalism, Rick.
Now, I want to see
idea, Rick, that.
Hold on, no, we're done. We're done. But now I want to argue with you.
No.
This is not what you were talking about. You were talking about something totally different, I think, than tariffs, weren't you? No, I don't want. I'm kidding. I don't want to argue with you. Not before Independence Day. We got to go. And thank you too. I'm sorry to cut you off. They were screaming at me in my ear to do that. I can just. I like watching that. Do you like watching that? Because it's not us, and we don't have to. We can sort of. We can watch from afar and not be part of it.
Project from afar. Meantime, if you are planning to hit the road for the July 4th, here's a bit of good news. Gas Buddy saying Independence Day prices at the pump projected to be the lowest since 2021. $3.49 on average across the U.S. It's only a penny lower than last year's mark, but $1.30 below the price in 2022 when the economy was running hotter and Russia had recently invaded Ukraine. Joining us right now to talk about how oil prices are filtering through to the consumer, Patrick DeHaan, Gas Buddy, head of petroleum analysis. Good morning to you. We often talk about, the price of gasoline being this sort of bumper sticker or ad for what's going on from an inflationary perspective, or even how the economy is going on every corner in America. And you're saying that here we are, and it's much lower. I wonder actually how that you think is going to affect the consumer psyche and maybe even the political psyche.
Well, I think, Andrew, to your point, not to start another argument here, I think the one thing that nobody can argue about is how low gas prices benefit that psyche of the American consumer. Look at what low gas prices do. They make every American feel like they can travel wherever they need to go without restriction. And so low gas prices are a huge part of that psyche about feeling freedom. This July 4, we're feeling a little bit more free than we have in the last couple of years. As you mentioned, Russia's invasion of Ukraine caused prices to skyrocket in 2022. That, and apparently everyone decided to hit the road in 2022. Now that we've kind of been in this post-COVID era, people are adjusting their travel habits. That is, people also road trip last year because it suddenly became more affordable. This summer, it's more about some of those long-haul destinations, those overseas destinations. Having said that, gas prices here are inching up. Oil prices have jumped about $10 a barrel here in the last couple of weeks. However, gasoline demand still relatively soft, holding under 9 million barrels a day, according to Gas Buddy data. So people are saying they're going to hit the road, but still gasoline demand a bit soft amidst gas prices that are decently affordable.
Patrick, real quick, how do you feel about President Biden and this administration effectively selling gas to producers like BP at maybe below market? I don't know what you think of that. We've talked about sort of releasing SPR. Some people think these things are politically motivated. Some of these things people think are consumer motivated. Do they need to be done now? What's your take?
Well, Andrew, I think, that the Northeast Gasoline Supply Reserve had been sitting there, had been costing taxpayers $200 million in the last decade to maintain. I mean, something like this is apolitical. Trump tried to shut it down. Congress now has required Biden to shut it down. The value of that gasoline, $98 million. I really wish they would have done this in 2022 to shut it down because it would have fetched taxpayers a lot more benefit. But I think it's one of those things that was a solution in search of a problem. Now, having said that, of course, now we have the earliest Category 5 hurricane on record. It does highlight a sensitivity that hurricanes can disrupt the supply chain. We'll be hoping that doesn't happen here over the next 8 to 12 weeks as hurricane season gets into its prime. That's really the one wild card that could send the national average still above the $4 a gallon mark in the next 8 weeks for the rest of the summer.
Okay, Patrick, we're going to gas up. Happy 4th. Thanks.
Thanks, Andrew. You too.
When we come back, an important shift underway in New York City real estate. We're going to tell you what it is and how it could affect the entire U.S. economy. You don't want to go anywhere. We're coming right back after this.
Now.
We could be seeing the start of a new chapter for real estate right here in New York. Robert Frank joins us on set with the details. I hope it's is it a happy chapter?
If you're a buyer. If you're a seller, not so happy. The average apartment price in Manhattan fell 3% in the second quarter. It will now cost only $2 million to buy an apartment in Manhattan. Median prices also fell. One big reason is rising inventory. Now, unlike a lot of the country where inventory remains very tight, unsold apartments in New York are piling up fast. There are now more than 8,000 apartments for sale. So at the current sales rate, it would take about 10 months to sell all the apartments listed. Brokers say anything over 6 months basically signals a buyer's market. And by the way, they are buying. The number of sales closed in the quarter jumped 12% over last year. That is the first increase in 2 years. Brokers say more sellers are listing their properties and dropping prices to get deals done, and more buyers are biting the bullet because prices and rents remain very high, $5,000 a month on average. Brokers say they expect the rest of the year to be stronger, especially if rates fall. And mortgage rates are not much of a factor in Manhattan. In fact, 62% of deals in the quarter were all cash. That is near the all-time record. So you've got a more discretionary market in Manhattan, unlike the rest of the country where people are locked in these high mortgage rates. People in Manhattan bought with cash, and now they're just saying enough is enough, we got to sell.
But you think this is going to hit everywhere? This portends.
I don't know about every market is going through. It's like South Florida right now has a ton of new inventory, and prices are expected to drop, whereas like parts of the West and Southeast are not seeing that. But I think in New York, you're going to start to see more sales, and you're going to start to see prices fall.
Okay. You in the market?
I'm not in the market, but
I mean, again, it's all relative. The average, it's
but we still have
1,600
this
square
mortgage
foot.
problem, which is just the overhang of all of this, which is that there are people who think that they can't leave.
Well, but that's my point. New York has more flexibility because both the buyers and sellers are not as mortgage locked. They're doing a lot of cash.
Do you think there'll ever be a day where banks, you know how in a commercial real estate universe, you can effectively take over somebody else's mortgage or take over the loan?
Right.
Do you think that banks will ever, if banks ever allowed that, and then you do sort of a blended mortgage, it would be.
People have been fantasizing
about that
for a long time. I just don't
you don't see it. You don't see it. Robert Frank, we wish you a very happy July 4th.
You too. Thanks.
When we come back, top stocks to watch ahead of the opening bell. Take a look at futures right now before we get there. We still got about 40 minutes to go before the open. And you're looking at the Dow off about 11 points, NASDAQ off 42 points, the S&P 500 off about 7 points. You're watching Squawk Box, and this is CNBC. A little more than half an hour to the opening bell of Wall Street. Tom Chu joins us now with a look at some of the morning's top pre-market movers. Good morning.
All right, so Andrew, Joe, we'll start things off with a bigger earnings-related mover this morning. That's Constellation Brands, which is higher by just around, maybe call it 3.5 to 3.75% over 30,000 shares of volume. This is the beverage alcohol company reporting quarterly profits that topped estimates on revenues that were just very slightly missing compared to consensus. Constellation also affirmed its full-year guidance, so those shares up 3.5%. Next up, you got Paramount Global higher by over 11% on 3.5 million shares of volume after deal talks resumed between its controlling shareholder, National Amusements, and David Ellison-controlled movie studio Skydance. According to people familiar with that matter, a preliminary deal has been reached under revised terms. A special committee at Paramount is reviewing that proposal. Those shares up now 13.5%. And we'll end with a check on electric vehicle giant Tesla, which is higher by nearly 2%, just around 8 million shares of volume after a 10% gain yesterday tied to better delivery numbers. New this morning, analysts at Wedbush have upped their target price on the stock to $300. It was $275. They maintain the outperform rating, so those shares up north of 1%. Joe, I will send things back over to you and Andrew and wish everyone out there a happy Independence Day and happy birthday, America. Bye.
Excellent, Dom. We appreciate that. Thanks, Joyce. Now for more on the markets in the third quarter ahead. Megan Horniman, Verdant's Capital Advisors, Chief Investment Officer. We've been asking similar questions to people that do this for a living. Megan, 15% in the first half after 24% in the S&P last year. Those are pretty good numbers. I mean, no one ever went broke taking a profit, did they?
No. I think that right now the market's sitting at this record high, and going into the second half of this year, it's a little bit concerning to me that they're not looking at any of the downside risks that we may see. The market's focusing on upside risks, and the market's focusing on what they want to see, which is that the Fed's going to come in and cut interest rates in September. I don't think that's something that we should bank on at this point. The Fed's made it very clear they don't have to be quick to cut interest rates. And then I think from an economic standpoint, we saw it with some of the data today, and we are starting to see some weakness in the labor market. That was one of the last dominoes that were standing from an economic standpoint.
Is there just so much, trillions and trillions on the sideline that people have not deployed because they haven't trusted this market? Is that a good sign? Is it true? And is it a good sign?
Was the trillions of dollars on the sideline because they're worried about the market, or because they're earning 5 to 5.5% on their money? And we haven't seen that in so long. I think a lot of it has to do with you're earning a significant amount of interest on your money. So why take the risk when the risks are, in our opinion, so many to the downside? Let's not forget we've got a lot of election risks coming up in the second half of this year. We have earnings that, in our opinion, just still seem too unrealistic for this year and next year, and we haven't seen anybody budge that. But yet everybody's talking about how the economy is going to slow. But earnings are going to be 10 to 15% on the upside. So I think once you start to see that earnings revisions coming down, that's when I think it's going to take the wind out of the sails of this market.
What does the election risk look like, Megan? Is it uncertainty? Is that all you need to say? Or do you want to even be more specific? We did have, I thought Lonsdale Sorkin that was on, he was talking about either unrealized capital gain taxes or long-term capital gain. He said both would be really hard on entrepreneurs and innovators, if you recall. He said that it could do that. So when you say election risk, what kind of election risk? Other people think, the end of democracy if Donald Trump is elected, that could be a problem for the markets too. Maybe so. I don't know. What type of election risks are you referring to?
I think you kind of hit it there. I think there's a lot around the taxes, a lot around the uncertainty, depending on, if President Trump comes into office, what does that mean for the Federal Reserve? But our biggest concern on the, uncertainty is what are any of these politicians going to discuss about the unbelievable and unsustainable path of debt that we have in this country that's going to have to be addressed. I don't know how. I don't know exactly when, but that I think can cause a lot of volatility, not just around the election, but into 2025.
Right, and I think the solutions are kind of, they're mutually exclusive. One would be try to grow with a vibrant private sector, lower taxes. The other would be try to raise more revenue from higher taxes. So you know, it is very difficult to try to decide what's more market friendly. And then you got, you know, unsustainable entitlements that something has to be done. That might be easier to fix if we just accept that something needs to be done, but neither party wants to touch that third rail.
Yeah, and the unfortunate thing right now is I don't know what the solution is. I'm not a politician, obviously, but I do know that you know, we have to be very careful because we're walking a fine line. We haven't been in this situation from an inflation standpoint that we have. You know, the inflation, it's coming down, it's getting better, but there is still sticky inflation. So if you do things to promote growth, what happens to inflation there? We're running a deficit of roughly 7% of GDP. You know, in the past we haven't seen that, so it's a difficult situation.
Okay, Megan, thank you.
Okay, quick final check on the markets. Dow off about 12 points, Nasdaq off 33 points, the S&P 500 off 6 when we open in about a half an hour. We're going to wish everybody a happy Independence Day, July 4th. Watch yourself with those firecrackers, my friend. Watch yourself with the barbecue.
Worried about the dogs.
And I'm worried about the dogs. Join us on Friday. We will be here. Squawk on the Street begins right now.
Gummies. Give them some gummies. Maybe me too.
Good Wednesday morning and welcome to Squawk on the Street. I'm David Faber with Melissa Lee and Mike Santoli. We're live from Post 9 at the New York Stock Exchange. Jim and Carl have the morning off. We have an abbreviated trading session today ahead of the 4th of July holiday. Market closes at 1 p.m. Eastern. Bond markets, and that's the stock market, yeah. We end trading of bonds an hour later. Let's take a look at futures. As you see it right there, we are looking for a bit of a down open. Let's get to our roadmap this morning. It does begin with that big tech rally. Microsoft, Apple, Amazon, all at new all-time highs. Tesla also notching its longest winning streak since last July. Plus the Skydance dance, it's back on with Paramount. Sherry Redstone's now backing a deal she previously rejected. We'll give you my latest reporting. That's in just a few minutes.
And Southwest Airlines adopting a poison pill to fend off activist Elliott Management.
Let's start with the markets, though, in record territory and new milestones for the tech sector. Great to have two of the greatest in terms of discussing the markets with me here on set. And yeah, both of you.
Oh, I mean,
Melissa's
totally
looking at who
for
else
sure.
besides her.
No. Far from it, far from it.
And so I'd just love to throw it over, get a sense, Mike, as to what your thoughts are, given what we've seen so far this week. Don't seem to be taking a lead, perhaps, in the bond market as much as we have the last 2 days, perhaps?
Not as directly, although yesterday the bond market sort of calmed down a little bit. Yields receded from the prior day's gains. It seemed to open the door. Yesterday's action was really slow in building. Late in the day, we got this rally. Yep, it was pretty much led by a handful of the mega caps. And what is interesting, too, is that the laggard among the mega caps get their turn. And that's what has been the story. NVIDIA was down again yesterday, and Amazon, which, of course, has broken through the $2 trillion market cap level, but has really done very little point-to-point for 3.5 years, or 3 years, let's say. And therefore has this catch-up potential. And, of course, Apple has gotten this little bit of a move, too. And it's essentially been the formula. It's a very split market still. The S&P's up 6% since the end of the first quarter. The median stock in the S&P is down about 1% over that period. So you still have this critique that it's not fully an all-inclusive rally, although yesterday a little bit broader. Some sensitivity to signs of slowdown. Some sensitivity to signs that the continuing jobless claims today remain somewhat elevated, and it just creates this friction about, is the Fed going to stay more patient than the investors can wait? You know, and that's kind of the story.
I mean, what we've heard in recent days from Fed officials is this concern about the tipping point where increasing joblessness will lead to a higher unemployment rate. We heard that from Mary Daly of San Francisco. We heard that from Jerome Powell yesterday in Sintra. And so there's that sort of worry. And in that sort of playbook where you want to be a little bit more defensive, do you still go to the stalwarts in the market? And that would be, of course, big tech. And you also have to wonder, how much have politics been playing into this whole thing? And I know that we're not political as a channel, but I know, seriously. But as more traders come around to the idea that there could be a Trump presidency in store, and there is a prevailing sense that that would be better for the markets in general, I wonder if you then say, you know what, big tech has another sort of breath of air.
Although things haven't
because
gone
of
too
that.
badly over the last few years during the Biden
Oh, not at all.
presidency in terms
Right.
of the markets. And
Exactly.
there was an impact, we were talking about it obviously in the bond market in the sense
Yes.
of a Trump presidency, which at this point certainly seems more likely than not, conceivably would lead to even more spending, which at some point we could have a reckoning.
To me, that's where the trade has mostly been concentrated, is in the bond market. I mean, gold is up. What I find interesting is the standard wisdom going into the initial Trump presidency was you were going to rotate away from the secular growth stocks, and it was going to be about real economy, and it was going to be, honestly, what the market picked up immediately after the 2016 election was we can have a higher nominal GDP economy. It can be a higher metabolism economy after slow growth, low inflation, because you were going to catalyze with the tax cuts and low regulation, catalyze domestic industry and consumption. And the market got there, but nothing worked to the disadvantage of tech along there. Yeah, banks did well for a while, and domestic companies did well for a while with the corporate tax cut. But in general, everything comes back to, well, what are you going to do with these mega cap companies that are basically nation states to themselves and have above average growth rates, impenetrable balance sheets, and not too many competitors? You know what I mean? So it doesn't seem like that's too susceptible to the policy question. To me, it was much more about the way it inflamed the fiscal concerns that are really just barely below the surface at any given moment in the bond market.
Right. Of course, that will continue to be the case. In fact, the unassailable position seemingly of some of those mega cap is even more so now as a result of the capex spending that they are undertaking, which is simply not something that any of these other companies are capable of doing in terms of forging the generative AI future. You know, it's hard to imagine in some ways that this is going to change, regardless, other than perhaps the regulatory threat under a Trump presidency would be lessened.
Right.
In terms of at least the DOJ coming after some of these companies and saying you're just too big and too powerful.
And their ability to then do deals. Think of all the deal making that has just been, you know, when you think about all these sort of startups, these AI startups, you think, who can take them over? Well, it's not going to be the big guys because the government will not allow that. But in a regime change, could the government allow it? You know, it is conceivable.
It's hard to know, but that's certainly, you know, when it comes to M&A, there is certainly an expectation perhaps that there will be an ability for more consolidation.
I mean, it feels in general a little bit early to really lock into the policy trade, but you can't keep people from doing it. You can't. The market's going to try to anticipate. There probably will be turns where it seems like the probabilities shift around, and you know, we remember that from last time where you had, you know, the tariff basket and the, you know, the tariff immune basket that would trade off against each other. You see solar stocks getting hit, things like that.
Right.
But beyond that, I think in general, market is kind of on its own steam in terms of earnings growth getting where it's supposed to go, skewed toward the upper end. And then this question of whether the economy is softening in a beneficial way or in a way that we have to be more concerned with.
Right.
$4 trillion. We're going to get some companies going to have a $4 trillion market value before long. Right?
Yeah, I mean, we're still at least, what, a 25% move from there, I guess, thereabouts. You know, so
I know,
don't like
but
to just
NVIDIA went
pencil
from
that
2 to
in.
3 trillion in how many trading days?
Yeah, it was like a month or something.
Blink of an eye, basically.
Something like that, yeah.
Incredible.
Yeah.
All right, we talked a bit about consolidation. Let's get to M&A this morning. Once again, we're talking Paramount. My apologies to some who perhaps are tired, but it's been a fascinating story. At some point, there will be a movie about it. I would assume it'll be done by Paramount. Where are we now? We are very close to the end, it would seem, in terms of a deal actually getting signed between the control shareholder of Paramount, Sherry Redstone, and once again, Skydance and its partner, a private equity firm, Redbird, which were successful in bringing Sherry Redstone back to the negotiating table after that very much unexpected turnabout of a number of weeks ago where a deal they thought they had done was rejected by Sherry Redstone. What got them there? Well, my understanding is David Ellison, who runs Skydance, would be the CEO of this combination of Paramount and Skydance, had reapproached over these last couple of weeks. Also, a lot of conversation, is my understanding, with Sherry's son Tyler as well, and they got to a new agreement, very similar to the old agreement. In fact, when it comes to the common shareholders who are probably watching right now, nothing really changes. The only change was the addition of roughly $100 million in terms of what they were willing to pay for NAI, that is National Amusements, which holds the control stake, and the addition of another $100 million towards potential indemnifying Sherry Redstone, if there is any litigation that arises from the transaction and should there be some sort of liability. So 200 million more. Remember my reporting from some time back where I talked about the fact they took 200 million out to give more to the common shareholders. So they, in many ways, restored that, at least 100 million for the equity, and then, as I said, that 100 million in the indemnity fund, if you want to call it that. That was enough for a transaction, to be fair, that Ms. Redstone had supported throughout until the last couple of weeks when they were getting very close to the finish line a handful of weeks ago. And so the expectation at this point, at least according to people familiar with the situation, is they will get a deal done by the weekend. Could be as soon as Friday. We'll see. The special committee of the board of directors now has it. They will obviously be once again reviewing. As I said, the terms are essentially exactly the same as I'd reported them some time back. $15 for 50% of the stock, so that's a premium, obviously. The A shares also getting, some of them getting taken out. $1.5 billion added to the balance sheet as well. And so you're talking about Larry Ellison and Skydance and Redbird spending close to $8 billion in equity to take control of Paramount, half of which will still remain out there once the deal closes, but you will get a liquidity opportunity if you are a common shareholder at a premium.
So basically, Sherry gets more money.
Gets a bit more money.
And so the deal looks like it's on better footing at this point.
Yes.
Yeah.
I mean, it was a deal, to be fair, again, that she had supported throughout.
Yes.
It was a deal that she had brought to the special committee originally and said, I want you guys to review this. That was why it was so shocking that day when I joined you on your show, that there was that reversal at the last moment. You know, there was some emotion involved there. They seem to have got past that. There is expectations on all sides that they will get this transaction done. But of course, this is a challenged industry. You're still going to have a very long period of regulatory review in which the buying group is not really going to have the ability to affect change there, so to speak. And you got a three-headed office of the CEO.
Bizarre.
You know, there's no shortage of potential risk here, it would seem. There's going to be a go shop for 45 days. That doesn't matter, but you're certainly going to want an ironclad contract, I would assume, if you are Paramount, and that's what the special committee will be ironing out in the next couple of
reporting
days.
this week that maybe Paramount is exploring some kind of a joint venture for its streaming business, maybe with Warner Brothers Discovery. Was that kind of a in case we remain independent type thing, or is there everything being explored at
That's
all
a great
times?
question, Mike, and it's possible that that kind of a thing will still move forward, at least in terms of potential conversation, but I'm not certain as to exactly what they're going to be willing at this management team. Now, they're supposed to be independent to agree to. That said, they have a controlled shareholder who's selling, and so she may say, you can't do that.
Right.
But there is going to be a need for that. You know, the incoming team, if and when this deal gets done, led by David Ellison with assist from our old boss, Jeff Shell, as well, as I've reported many times, has a big plan for cost cutting, a big plan for what they believe will ultimately be the ability to actually grow this company. Oracle is going to be involved from a technology perspective. I don't really know what that means. And Larry Ellison is there behind it all, a guy whose net worth went up on that day that Oracle stock jumped on earnings, well more, I think almost double what the equity check is here. I think he went up, his net worth, he owns 41.69% of Oracle, so you can do the math. And so in many ways, you know, that is something that gives a lot of people comfort here in terms of the ability of Paramount to weather the coming storm. That and their NFL contract at CBS, which still has a long way to go.
Yeah, that's true.
Does this deal change, in your view, the media landscape in terms of how these streamers stack up against each other and their ability to withstand this very difficult streaming environment?
Not necessarily, and not until you start to see what they really do. You know, is there the possibility of a tie-up with Max in some really significant way? But we've all come back to the same conclusion, which is this is a very difficult environment in which to be spending all of that money, where churn continues for some of these players, and the question is to whether they'll ever get to a significant level of profitability, including obviously the indebtedness, both at Paramount with $14 billion in debt, and also at Warner Brothers Discovery, which has an enormous amount of debt on its own balance sheet. Our own company as well is under some pressure because of losses at Peacock also. So this will continue to be an issue. If there is an incoming Trump administration that looks more leniently on the ability of these companies to get together, perhaps that will change things, because there is a belief that you do need consolidation and you do need global scale.
Scale, yes.
Global.
Yeah.
All right, coming up, we're going to have a closer look at the rebound in Tesla shares. This is the company aims to, or the stock aims to erase what were losses for the year that were very significant only a couple of weeks ago. Let's give you a look at futures. We get started with trading here at the NYC. Remember, shortened session. We conclude trading for equities at 1 p.m. More Squawk in the Street straight ahead.
What are you waiting for?
Ford is out with its auto sales figures for the second quarter. Let's get to Phil LeBeau, who's got the numbers. Hey, Phil.
Melissa, in the second quarter, Ford sales were up less than 1%, pretty much in line with the rest of the industry, an increase of 0.8% for the second quarter for total vehicle sales. But there's some numbers within the numbers that show where the growth is happening at Ford. Best truck sales in the second quarter since 2019. Also, hybrid sales up 56%. EV sales up 61%. And I know some people will say, well, the EV numbers are coming off of a smaller base, but this is critical for Ford and really for all of the automakers separate from Tesla, because as they ramp EV production, they want to see those sales continue to grow. And so you see that in the second quarter with Ford. Again, EV sales up 61%. Guys, back to you.
EV sales up 61%. I mean, Phil, can you piece it together and say that there's been an inflection point in EV demand?
I'm not sure if it's an inflection point, Melissa, but we are not seeing the drop-off in EV sales that was predicted in the first half of this year. When things slowed down, we said it, others said it, we said EV sales are going to continue to grow. They're just not going to grow as quickly as in the past. But that was interpreted by the broader market as, oh, here we go, people are pulling back, they're not going to buy EVs. That's not the case. You are seeing EV sales continue to grow, but just at a slower pace. I haven't gotten the full Q2 numbers, Melissa, but the expectation is that they're up 10, 11% year over year. And we're going to continue to see that here over the next year and a half as more models come into the markets.
And Phil, I know you were kind of talking all day yesterday about Tesla's delivering numbers as well as this move in the stock, which, as always, has a lot more behind it than the here and now in terms of sales. But what do you think the market is sort of suggesting about Tesla's relative position in EV sales? Because it did seem as if the fragmentation of this market had people wondering if Tesla, was still going to retain as much of an advantage. I don't know if people are drawing the connections between maybe fewer, EV credits or subsidies for the traditional automakers would net help Tesla or something like that down the road. But what's the read on that?
Well, I think, Dave, when you, or Mike, I'm sorry, when you take a look at what you're seeing with Tesla and the numbers yesterday, one thing stands out. The EV business, while it is not growing as it has been in the past, in fact, year over year, the sales were down, 4.8%. The market, in terms of the investors, they are focused on the lower priced models that are supposedly coming in the first half of next year, as well as the robotaxi. And that's, when you look at the EV part of Tesla's portfolio, that's what I think investors are focused on. So they are not necessarily focused on the pure EV sales to you and I alone. They're looking at this next generation of lower priced models, as well as what happens with EVs in a robotaxi world that Elon will be outlining on August 8th.
Right, August 8th. July 23rd, they're reporting earnings. So those are the 2 dates in which we may get incremental or additional news, so to speak. Right, Phil?
Yeah, and the July 23rd numbers, David, remember, the big focus there is going to be what's been the pricing impact in China. We know that they're definitely in the middle of a brutal price war with the Chinese EV companies, and we'll get a better sense of that after the bell on the 23rd.
Yeah, well, we talked yesterday about BYD's deliveries, which are very, on just EVs, as you made the point, not including hybrids, which are very close to Tesla's at this point in terms of numbers.
They're nipping at their heels, real close.
Phil, thank you. Phil LeBeau. Coming up, an area where some are seeing a buyer's market. Stay tuned to find out all about it. Let's give you another look at futures. We got about 9 minutes before we get started with this shortened trading session here. You can see, not looking for much right now. More Squawk in the Street when we return.
U.S. now.
Take a look at the S&P gainers as we get ready to begin trading. We talked about Paramount. You can see Constellation on there. You like beer? Well, apparently a lot of other people do too. More perhaps than wine and spirits these days. 8% net sales increase, 7.6% rise in shipment volumes of beer for Constellation. Opening bell coming up. Don't forget, you catch us anytime and anywhere. Follow the Squawk on the Street Opening Bell podcast.
JP Morgan chief market strategist and co-head of global research, Marko Kolanovic, is reportedly out. Bloomberg is reporting that Kolanovic is leaving the firm after 2 challenging years. He was one of Wall Street's most high-profile strategists. Kolanovic was bullish in much of 2022 when the S&P dropped almost 20%. Then he turned bearish just as the stock market bottomed, missing last year's almost 25% rally in the S&P, as well as this year's first half double-digit gains. He's been at the firm for close to 2 decades.
Yeah.
So it's been quite a run as chief market strategist go.
Yeah. Tough to miss those 2 calls, though.
He's been fighting the market. Had about like a 4,200 S&P 500 target. That's what JP Morgan's been carrying. So that's 20% down from here. On the other hand, that would be like 16, 17 times this year's earnings. It wouldn't be some absurdly low valuation for the market. I do think one thing that just reading his work all the time, he really fixated on first sticky inflation, was basically going to undercut market valuation. Now he's been more focused on things like the ISM and the manufacturing PMI type survey numbers, which really have been a false negative signal for the overall economy and certainly the stock market for a while. And then if you're a strategist and you don't sort of acknowledge the power of the big growth stocks and their ability to support the index and create earnings where they otherwise wouldn't, it's been tough to keep keep up. So, I think net, everyone's, there's going to be a rush to say this is a contrarian sell signal for the market. We had the biggest bear on Wall Street carried out. It happened in 1999 with Chuck Clow at Merrill Lynch. It's tough to make those calls because honestly, it's never that perfect. It just seems as if there's just lots of push and pull in here. We had this report of Mike Wilson of Morgan Stanley maybe getting a little bit sidelined at the firm, but he's still there.
Yeah, he is. Although who has the greatest influence these days, if any, amongst strategists? Because Wilson obviously had a great call for a while on stocks being strong, then reversed course incorrectly for quite some time.
I feel like strategists are not, it's no longer the days of the Chuck Clow or the Abby Joseph Cohen over at Goldman Sachs when you sort of put them on a pedestal. Right now, it's like we're in a world where strategists, they change their forecasts. The markets are increasingly hard to predict because of various factors. So here we are.
I think there really is among the people who do that job an acknowledgement that the prediction of the index is kind of a fool's game, and they're just trying to give you color around the themes that matter in the market.
Yeah, I mean, right. If you can present some facts
Ding, 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 ding.
doing the honors, the New York sector, celebrating July 4th. Of course, over at the NASDAQ, Friends of Firefighters, a nonprofit providing mental health services for the FD1. All right, throw it over to both of you, see if there's anything in particular in terms of the market and or a particular stock that's grabbing your attention as we just get opened here.
We do have, Tesla following through to the upside. I would just point that out in terms of...
Yeah. Let's listen to you, Tesla bashers.
To say dollars.
AVGO is moving.
That is kind of interesting. Dollar slipping below line. I've got on my chart at 105 right now, spot 06. So it is kind of pushing through what has been support since about June 20th. Maybe the dollar softening.
Double topping on SPY.
Up to the dollar. They're kind of back on par now, so perhaps the dollar has some to give. Given the order of operations there, I pointed out for weeks that the dollar was very elevated next to yields. Yields caught up pretty much to the point now where it seems like bonds have done their work to normalize around a September cut. But the most interesting thing is Bitcoin, I think, looking pretty soft. Crude oil, though, hanging in there, too. KG's with me, Kevin Green, our senior markets correspondent. We're going to talk some stocks, but when you got KG, you got to talk some macro, too, real quick. Mr. Green, what are you looking at here this morning?
Well, hopefully we can just maintain, Oliver. I think that's going to be the key, especially having a shortened trading session here today. Let's see if...
Okay, we're definitely elevated here on the SPX.
We talked about it yesterday. 55.25 is going to be the key.
And we got a double top working on the SPY.
For this week, and anything above that is just going to be icing on the cake. And if you can maintain the 5,500 level, I think it's also going to be a win.
We can see if we get a new high here.
55.75 to be your support area. So I don't think there's
That
going to
we
be a lot of
get put.
activity here today. We already had the major economic data points really come out. ISM services is going to come out at the top of the hour, I believe.
That's a big
That'll
one.
probably be the biggest headline. Yeah, that'll be the biggest headline one. And then you want to just see the prices component if you want to see that one actually decelerate. And then you also want to see, obviously, the headline number still stay above 50, but maybe coming in a little bit lower than we saw for the previous month. I think both of those components would be bullish.
Okay, that's pretty much exactly the expectation. Consensus for 53, a drop from 53.8 for ISM, but needs to be well into 50 for sure, unless prices paid come down. That would be the other good version of that report. The factory orders too, don't sleep on that, could be interesting, but also, it's hard to imagine us moving too much before employment. You have to have like a real shocker. Don't you love that 15 minutes between PMI and ISM? You get the PMI, it's like the little brother. It's like, all right, let's see.
SPY July 5th.
Yeah, I kind of look at the PMI number.
The appetizer.
Yeah, and sometimes they do align, and sometimes they
550 calls have 18,000 filled on it already.
For that number. Once again, you want to see that price component kind of decelerating.
And the SPX 548 puts.
Data point as well. Also look at the employment side of that number as well. They have
At a buck.
Employment gauge. I think the market's looking at 49 for that, which would be contractionary territory. Anything lower than that, I think, once again, would be bullish for this market for now until we start getting some concrete data on
There we
Friday
go.
regarding the labor market outlook and if we are starting to see a slowing in jobs being added.
Okay. All right. PMI 45, so that's 12 minutes away, and then ISM right after. It's amazing the way the market really over the years has just put ISM at a way different level than PMI. Sometimes you get a little bit of movement in the morning, but ISM's the one. Nvidia's down about 0.5% right now. Nothing huge there. Gold is up while Bitcoin's down, which I think is kind of interesting. If it extends, if it continues more, Bitcoin's still above 60, so not that interesting to me yet. However, crude oil, I think we have to keep tabs on. We talked a little bit about it yesterday, KG. The fact that it's now been cruising. I mean, we did like $9 in like 20 days, right? That's a pretty decent move.
Yeah, I think crude oils are up around, 15% since the lows. So it's had a nice little run, kind of hitting an area of resistance at around that 83.5 level. So keep your eye out on that. And we had the API report that came out yesterday.
There we go, $100 right there, 120.
From inventory. Now that is well exceeded the street's expectations. Did still see a buildup when it came to gasoline inventories, a drawdown for distillates, and then Cushing, I believe we saw a 400,000 barrel buildup there. So let's see what the EIA data point's going to really show. Sometimes you can have these dramatic draws when it comes to inventory, and for the API it's a little bit hard because sometimes it could be in transit as well. So did we see a spike in export activity that would ultimately be bullish for crude right now? But it's sitting pretty well. Given the dynamics that we're getting from the economic standpoint, it's pretty much outperforming the expectations of a lot of traders out there that thought maybe $80 would be the key area of resistance that we would not be able to break above.
Okay, nice. So we've kind of defied that, even as inventories rose last time.
We'll
We'll
make
get
it.
an update for that in an hour too, right? EIA's coming out in an hour?
Yeah, well, yeah, I think today it should be coming out in an hour
Yeah.
from now, but sometimes they do adjust the times because of holidays. So traditionally, yes, it would be out about about an hour from now, I would say.
All right, cool. All right, can you tell that I don't want to talk about Paramount, which is what we're supposed to talk
You and me
about?
both.
Yeah, right. It's just I'm so tired of the story, but hit me. What's latest? Up 8% now. I mean, so somebody's gonna buy it eventually. So just wake me up when somebody buys it. It's gonna keep going down until someone buys it, and if they don't, it's gonna go down more.
We might be getting closer to
Anthony, you're not funny this morning.
For everybody's sake here in the market, but we do have a report. National Amusements has reached a preliminary agreement to sell the controlling interest of Paramount Global to Skydance Media. Now, this is going to be a situation where Skydance will pay about $1.75 billion for the controlling stake, around 77% of voting shares of Paramount. Now, this deal will not
Anthony's not funny.
Redstone shareholders, which was actually a big issue that was like a hurdle. We had one major shareholder that was kind of flip-flopping back and forth on potentially trying to sell. Now there is going to be a 45-day go shop period. This is actually normal when we're looking at these deals. This is going to allow Paramount to get other offers. Now there's rumors that there's other offers that are being put out there, but once again, we've kind of heard this story over the last 6 months that there's been bidders out there and just hasn't been able to cross over the finish line. Now this is also amidst Paramount Global also looking at trying to add Paramount Plus to other streaming platforms, and one of the players in that space could be Warner Brothers Discovery that could look at integrating Paramount Plus into the Max product offering. So Paramount's got a lot of things going on right now, but hopefully this is going to be the end of this back and forth when it comes to the Skydance.
Okay, we're double topping here.
Yeah. So it's just like it really is a South Park episode, you know? Like they made it was
Well, it's confusing.
Yeah.
It's confusing.
I had a chance to sell it once and I didn't, so we'll see.
They come, they go. Some of them are back, you know, from years. So, all right, the shares though were just making lows right before this. So, I mean, as a trade, is it tradable at all? Like, that's honestly that's part of the reason where that like, because I try to look at things through the lens of, you know, how interesting is it to trade? I mean, like, this is just a literal roller coaster madhouse to try and trade this.
Yeah, I would say this is probably more buy the rumor, sell the news type of an event here. I mean,
Apple at resistance.
Takeout price for these shares, and then when you look
Tesla
at
double
price,
topping.
that's probably where you can find some arbitrage opportunities to the upside here, or even to the downside, because we have seen some preliminary.
Let's keep the headlines minimal to Tesla here. We
kind
don't.
of discounting this news until we
don't want to pump the Mimi.
45-day window, but. When you're kind of looking at the stock overall, it's in a downtrend. It's very difficult to really try to pick a bottom for this name right now.
True, nailed it. All right, thanks. Appreciate it very much, Mr. Kevin Green. Let's go to New York. Caroline Wood standing by. We do have some earnings, Constellation Brands, but shares aren't really doing squat right now. What's up, Caroline?
Could get out of this thing right now and be okay with it.
Constellation Brands pretty much flat. Actually dipped slightly negative.
I'll pay for my dinner.
Modestly higher at the open. The conference call for this isn't until 10:30 a.m. Eastern time, though, so that could potentially cause the stock to move a little bit more.
I don't want to pay
But
for
this was
more
an
than
earnings
that.
beat, a revenue miss, reaffirmed the guidance for the full year. Just kind of running through the numbers, EPS of $3.57, easily topped analyst expectations of $3.46. Revenue did rise 6% to $2.66 billion, but Wall Street was looking for $2.67 billion. So that was a slight miss there. Breaking it down by segment, beer sales continued to be strong. Those jumped 8% on shipment volumes.
Come on,
that were up
Putzy.
7%.
We're at 80.
Meanwhile, though, wine and spirits saw sales slump 7% on a 5% decline in shipments volume. In the release, the company said they continue to face challenging market conditions, primarily in the U.S. wholesale channel across most price segments in the wine category. So looking out for the full year, back to their full year earnings view of $13.50 to $13.80 per share. They see fiscal year net sales growth of 6 to 7%. And then breaking that down by segment, they expect beer to continue to be strong, net sales growth of 7 to 9%, and operating income growth of 10 to 12% for fiscal 2025. And then for wine and spirits, they reaffirm their outlook for fiscal 2025 sales decline of 0.5% to a gain of 0.5% on operating income decline of 9 to 11%. So as I said, the conference call isn't for a little less than an hour from now, so we'll see what the company has to say, especially about that weakness in wine and spirits, and if any analysts weigh in after that. But shares basically flat right now, up about 7% year to date.
All right, I did my part, so.
And I don't like wine anymore, so maybe I'm doing my part in sending those wine and spirit sales lower. I used to like Prisoner, I used to like some of their other brands, and just can't drink it anymore.
I didn't even know which ones they make off the top of their head, but the Prisoner one's pretty popular. All right.
Rufino, Prisoner, Robert Mondavi.
Okay, nice. That Robert Mondavi was the Outback special when O.J. Renick was a server way back in the day. That's how you know people were classing it up.
Mondavi and the Bloomin' Onion. So what? Does that mean you're a Modelo and Corona drinker?
108, come on.
Now, right? Is it Modelo number one? Because I had that conversation last week when I was in Vegas with somebody, and they were surprised to hear that. Was I wrong?
It was.
Spy at the VWAP.
At least last year when Bud Light was going through all of those issues, but I don't know what.
Spy at the VWAP.
Bottom line is, with all of those, if the stock doesn't, do well, then what's the growth trajectory, right? It doesn't, especially now that their kind of foray into the weed stuff hasn't really paid off handsomely. There's still such a mess in that industry generally that it's hard to turn a profit on it. So, is there a strong bull case at this point? Are people that jazzed about it?
Come on, baby.
I have to take a look at the breakdown. I mean, if you take a look at the analyst breakdown, there's 25 analysts that cover the company, and 22 of them have a buy rating. So it's still very bullish in terms of the analyst breakdown, $300 median price target. Right? So, I think that let's see what analysts have to say after they actually hear from the company on the call. But, I think that
come on, you just chicken shit.
Stock. It's not the AI play. So
110.
I don't think it's a huge surprise that we're not seeing any wild swings, and it is already up about 7% year to date. So I think the question is what's already priced in, and the fact that they just
So you can easily respect the VBOP.
versus boosting, and they actually missed on
So you got to make a business decision.
getting punished for that.
Right. Well, they pay a 1.5% dividend, so they made it through the food experiment.
Hello. How are you looking today?
Profit-wise,
perfect.
I guess $300 roughly. Price target. They think it's decent.
Perfect.
A few others here. Let's talk Southwest. Under some pressure with the activism, and they're adopting the poison pill. Okay, take us through it.
Yes, just to kind of run through it, Southwest shares still lower year to date, but did see that big jump higher on news that Elliott Investment Management built a $2 billion stake, or nearly $2 billion stake in the company. They said they wanted to overhaul the company leadership. They wanted to oust CEO Bob Jordan and Chairman Gary Kelly, and then really to try to boost the financial and stock performance. But now the airline has adopted a shareholder rights plan, the so-called poison pill, as you said, to make it harder for Elliott to continue building a stake. Southwest said it
They wanna
needed
hold the VWAP.
an acquisition of the airline that doesn't appropriately compensate shareholders. So the poison pill will activate if Elliott or any other investor acquires at least a 12.5%
Oh, God.
stake of the company. If that happens, shareholders actually have the option to purchase shares at 50% discount, at half the price. Elliott is at about 11% right now, but they made filings with antitrust authorities that would allow it to acquire an even larger stake by next week. So Southwest kind of in preparation for that, it enabled this poison pill. So this creates a deterrent from Southwest building a 12.5% stake or higher. So Executive Chairman of the Board, Gary Kelly, said Southwest Airlines has made a good faith effort to engage constructively with Elliott since its initial investment and remains open to any ideas for lasting value creation. We are confident that we have the right strategy, the right plan, and the right team in place to succeed. So obviously, Gary Kelly and Bob Jordan on the chopping block, according to Elliott Investment Management. So kind of see how this all shakes out. Southwest shares now up about almost 1% today, only down about 1% year to date. But we know that Southwest has had plenty of problems, both in terms of kind of muted profits compared to some of the competitors, and then of course the Boeing deliveries as well, really weighing on shares.
For sure. Stuck at like $28 now since March, with some ups and some downs along the way. Hey, analyst notes real quick. Carolina, we got, I think, a nice snapshot of the retail story lately. A price cut to Lulu from an analyst, a price hike to On from an analyst.
Yeah, in keeping with the theme of this year, On obviously the overperformer, the outperformer,
Mara
the underperformer.
down
We'll start with
almost
Lululemon.
4%.
Shares higher despite the fact that it got, or actually no, now it turned lower, down about 0.4%, down more than 40% year to date.
Arm.
Baird is still bullish on shares, kept its
Nvidia.
but actually lowered its price target on shares of Lululemon to $470 from $505. Kept that outperform rating, so still sees 56% upside, but said June checks remain muted. There's a lack of a clear inflection point in June that's consistent with management's guidance, but they do think that expectations for the second half of 2024 improvement are reasonable because Lululemon is making strides with their marketing investments. Does think a clear U.S. growth inflection may be needed to boost investor sentiment, but says the stock's current valuation more than discounts a slower growth backdrop, so it supports an attractive risk reward. In terms of On Holdings, taking a look at shares there, they're only up about 0.1% right now, but they've been a big winner, up almost 40% year to date. So, moving in the total opposite direction of Lululemon, and they did have a tough month of June, but Goldman Sachs raised their price target on Holdings to $47 per share from $41 a share, kept a buy rating, so that's more than 25% upside from current levels. They don't report earnings until August, but Goldman sees On's Q2 revenue growing 33% in constant currency, says EBITDA margins will expand to 15.3%, so that's about 120 basis points.
Wow. And
they also updated their direct-to-consumer estimates, now forecasting DTC sales growth of 25% year over year. Prior forecast was 23% year over year. So On currently trading around $37 a share. So it's $10 upside from here, according to Goldman Sachs.
All right, nice. Pretty bullish, even if the pullback, hurts a little bit. Still within the context of a pretty good run for On. All right, more on the way, according to Goldman. Thank you, Caroline. Appreciate it very much. Let's check out the PMIs here before we go into the break. As numbers hit right in line with expectations.
Not really getting upgraded.
Numbers, so I don't think ISM is going to stray too far from that. When PMI hits at 55, probably not going to get a huge gap. So it seems like we might be in the clear for the day. When we come back, we're going to talk some chips and levered funds functionality when NVIDIA goes berserk. How do you get 2x on that? And then when it comes down, do all the flows run away? We're going to catch up with Mr. Matt Tuttle next.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade.
Well, my Jimmy promotion yesterday on Chewy is up 80 cents. Yeah, I remember that, Jim. That was a joke. Okay, we have an expansion pattern here on the IWM. I mean AMD. I was looking at IWM. Damn it. Stop it. See SPY. Expansion pattern.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
All right, we got stocks doing pretty good here as it seems like we're in the clear. PMI's just hit at 55, which is a pretty nice distance into the 50s. I got Tom White here with me in studio, and Matt Tuttle's joining us this morning. We're going to talk some levered funds here, so we're keeping an eye on the market ahead of ISM in about 10 minutes, but it seems like we're pretty off to the races. Mr. Tuttle, good to see you, sir. Let's talk what's first on the docket. NVIDIA, is it kind of cooled off? How are the funds doing?
Funds are doing great. I mean, we're still seeing large inflows into R2X and, the 2Xs across the board. So, that's really caught on. We do see people tactically going into NVDQ, which is the short side. So, yeah, I think people are playing it the right way, where they're buying the dips in NVDX, and then when NVIDIA goes up, they're selling it and buying NVDQ, which, I think is the way you want to play it. Me personally, I own NVDX in my long-term accounts, and then I trade the long and the short based on what's going on short-term.
Got it. So you stick with the levered as kind of your base position?
Yeah, I mean, I think you've got to have, a long-term position in NVIDIA. And I'm perfectly comfortable holding a, 2X daily levered long-term. I mean, I understand how the leverage works over time, so not a problem. And I think NVIDIA is the future.
Do you, does it seem like others share that view, or do you see movement in and out as a trading vehicle every day, or people park it in there? How permeable are those flows?
Yeah, I mean, I think everyone's different. I think the majority of people are trading in and out, but certainly I talk to people who have long-term positions, not just in the stock, but in the options as well.
Okay. Now, it's built on swaps to get the leverage. How is that functioning when the stock got so extreme? I know we haven't talked in a couple of weeks. NVIDIA's cooled off. What was the market structure like in operating that when like trillions of dollars were moving around on a weekly basis?
It's like herding cats every day trying to find NVIDIA exposure. Wall Street is chocked to the gills in NVIDIA. So it's just a battle talking to all the counterparties on where we're going to get NVIDIA every day. We always end up with what we need, so it's not an issue, but certainly would make my life a little bit easier from an operational standpoint if NVIDIA cooled off for a while.
Wow. And is it to the point where it gets difficult achieving the full leverage that's in there? Is there liquidity issues in any way? How has it impacted the functioning?
Yeah.
Well, it hasn't impacted the functioning at all. It's just, beg, borrowing, and stealing from counterparties every day, trying to figure out, who's got NVIDIA today.
Yeah, who does?
We always get it.
Will you not get as good prices, though?
I'd like to see you fall down.
No, I mean the pricing is the pricing. Occasionally it might cost, a little bit more on the financing, but that's minimal in the whole scheme of things.
And that's going to be on your end anyway, right? Like
Yeah.
the fees don't change. The fees are fixed.
Fees are fixed.
Okay. Have you had to like model out any scenarios like what if? I mean, like it's been crazy enough already, but like, I mean, what if it had like a 20% day at this size? Like, would that impede anything, or how do you think that would happen? Or what if on the downside too? I mean, I guess you're saying at this point that would kind of almost be a preferred outcome in a way.
Yeah, the downside's a non-issue. On the upside, we feel like we've got, capacity out there for pretty much anything. So, we've modeled it out. There's nothing we're concerned about there.
Okay, all right. So it's more just kind of like a fun anecdote about how stocked people are getting on NVIDIA, because that's basically where it's stemming from, right? Like the dealers or market makers whatever say, oh, you got too much of this on my book.
Yeah, there's only so much people want to have on their balance sheets, so it's it's an interesting phenomenon. But again, NVIDIA's been calming down. We expect at some point very shortly it's gonna just go back to normal.
Got it. Okay. All right. Cool. That's very good insight. I appreciate that, Matt. Hey, Apple, you've got the long 2X. You don't have the short one, but that's kind of the other stock I'm most interested in right now because it's so different. I mean, it's basically pure valuation. But just real quick, tell me about the flows there. AAPX.
Yeah, we've started, Apple's been going up recently, and we've started to see some real flows in there. That was of all the ones we had, that was the smallest. And, now that's really starting to build up. I think people are getting a lot more interested in Apple here.
All right. Appreciate it, sir. Thanks as always. Appreciate the insight into the functioning. Good stuff, man. Just told the CEO and CIO at Total Capital Management. All right. NVDX, the 2X long. Tom White's looking at options, though. All right. Can't teach an old dog new tricks. Go into the options market, of course.
Yes.
And the 2X is not a bad option. It's not, literally.
Yeah, exactly. But if you look at NVIDIA, it's still up, 147% so far this year, even though it's pulled back from those all-time highs of about 100, just over 140 last month. So I looked at a strategy because I think a lot of people are waiting maybe for a further pullback, or maybe it's stabilizing above this 120 level. So I looked at a cash secured put in here where, hey, I want to get bullish on it, but not maybe ultra bullish. And hey, I might be willing to buy the shares if it continues to fall below 120. So selling, going out to the August 2nd weekly cycle. So 30 days to expiration on this trade, where I'm going to sell the 120 strike put. It's basically just a couple bucks out of the money to the downside. You're collecting a credit of $5, right? So that's what you can make, $500 per put that you sell. Now, if the stock goes below 120, what does that give you the opportunity to do? Well, if you still hold that short put into expiration, it's below 120, you get a sign on it, you're buying the shares if you collected that $5 credit at 115. So that's about a 6% discount to the current share price. So this is one of those strategies I look at where maybe you want to get into it, but hey, you're willing to buy it if it goes lower, but if it doesn't, I can take advantage of higher implied volatility, a lot of option premium in these short out of money puts here, where I can, hey, I have a cushion to the downside, but I'm willing to buy it if it continues to fall because it's a neutral to bullish stance.
As far as selling option spreads and collecting premium, this is about as juicy as it gets because you're only $2 away in a stock that moves quite a bit.
Yeah, but you're $7 away from that break even where you start losing money.
Right.
So I think that's
first strikes at 120.
120. So, and that's the thing. It's not risk defined. It's risk defined if the stock goes to zero, but at the same time, you're willing to buy the shares. And this is one of those repetitive strategies where every week, every 2 weeks, every month, you can sell it out of the money put with, hey, I'm going to just keep the credit that I collect, take that profitability, or if it does fall, hey, I'm willing to buy the shares.
Got it. Nice trade. All right, cool. Get $500 for it.
Yep.
Hope it doesn't break down.
Yep.
Or own it lower. Thanks, Tom. Thank you, Matt Tuttle, for the Lever ETF chat. We got ISIM coming out. 2 minutes away.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim. the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Still, pretty big miss there on ISM services. So this is the highlight of the day. Let's get straight into it. I got Ben here with me in the studio as we're looking at this number. Mr. Lichtenstein, futures host, back with me. So the quick read here: 48.8. Ben, top line. That's a big miss.
It is a huge miss, Oliver, into contraction territory.
Wow.
I'm looking back to see how long it's been since we've seen these levels here. But again, this was lower than expected, to say the least. Now, stocks actually kind of hovering right around unchanged territory.
No way that's going to last.
It looks to me like we're going back to the fall of last year, basically.
The prices paid didn't move. How can you spin this as bad as good? It's just the market's got to be, I can't logically take it anymore if the market tries to spin this as good.
Well, let's begin with the fact that the S&P Global, the composite PMI number,
that was good.
PMI, those were really strong.
Those were good. Market gives way more weight to ISM though.
Spring of 2022 levels for that. Yes, I agree with you. The ISM is going to have a little bit more credibility here.
It's a good number for PMI, right?
Looking at the non-manufacturing new orders, look at this, just cratering, 47.3. I mean, that does not paint a pretty picture for an economy that's supposedly charging along and chugging along at a pretty good clip here. Again, going back to now into contraction territory for the new orders. And as I'm looking here, I mean you got to go way back for that. It's
bonds picked up on it. Let's look at bonds intraday. Look at bonds. Bonds took the cue.
Stocks coming off a bit.
Stocks are just trying to do this Fed thing. It doesn't make sense. Feds can't go until September. Inflation's too high. We just heard from Jerome Powell again yesterday. And it seems to me we have to be done with this whole bad is good thing, because bad is only good if
bad is only good.
Too. Yeah. And people go, oh, it's a survey. Well, it doesn't matter. We're talking in the same universe of this one report. You have standards in the report, and the inflation component is not going down, but the activity is dropping off. That's a big drop off.
Labor conditions remain pretty strong, though, right? And we've argued for a while that the pillar of strength in this economy has been labor.
Yeah.
So maybe this can be sort of looked at as possibly a one and done. I mean, I don't know. I
labor numbers were good. Okay, they were okay today.
Labor numbers are okay. They're pretty good. And so this is a bit of a disappointment here for sure. But again, we also talk about how one data point does not a trend make. Now, I would argue that this number here, again, kind of just looking at this business activity here, 49.6 from prior 61.2. I mean, again, this number is going to raise some eyebrows. Now, the other thing to kind of remind yourself of is, don't forget, we've got very few eyes on these reports here with the holiday abbreviated week here right now. So maybe, again, that might explain some of the reaction we're seeing here in terms of limited reaction in the S&Ps.
Yeah, I'm with you.
That's happened this fall since the open.
Gold caught a little bit of a bid there. I'm watching gold. I do have utility in gold. I believe that it does recognize when you're kind of shifting from Goldilocks to purgatory. I've been looking at the Bitcoin gold spread because Bitcoin's like good times, we're spending money, we're wasting money, we're having a great time. Gold is like, all right, cool off a little bit here.
That gold bid came into play a little bit earlier this morning.
You're right, there's the chart.
2358, and it rallied up after the data.
It's at highs right now.
2360 is a key area, so we're building good momentum. Look, up 1.5%. We had Arlen Sutterman join us this morning from StoneX Financial, and he was talking about gold and the bid. And to your point, Oliver, he said, look, this is a product that could benefit in multiple environments right now. And when you look at the trajectory, the bulls have been in charge there as well.
This is the worst print since COVID for ISM. I've got it up right now because the other number that was this bad was in December 22. December 22 was 49, and so today at 48.8. This is the worst print since COVID, and it's not really a one-off because we've been straddling the line around 52-ish basically for a year, and that's off of course, the 65, 66 from 21. So it's kind of a overall drift lower in ISMs that now is almost like it's cracking.
And that's why I was saying I think it's a little bit of a reach to say one data point is not a trend make, because we actually have been seeing this trend start to play out. But I would argue that this is at a faster pace than we have been seeing, and that's what raises concerns in terms of the market. So again, if this were to continue, obviously a bigger concern if we were to see some sort of a cratering of the economy, but I think it's a little bit premature to kind of declare that based on this number here right now. And then again, especially when you look at what we saw in terms of labor conditions and the balance that provides, the point earlier.
Yeah, true. Good balance with the numbers this morning. That does offer kind of a different case. The dollar got dinged pretty hard, by the way. So dollar and bonds definitely saw the number, responded in kind. Stocks trying to figure out if bad is good, basically, at this point, which, again, I'll sit here and argue till my breath is out that we've got to drop that at this point.
Don't forget, if you're talking about the U.S. dollar, we've got the UK elections tomorrow as well, so that could be a catalyst also.
Will occur.
Obviously, the situation, well, we heard from Christine Lagarde yesterday, and their situation in terms of inflation, similar to the U.S. in some ways, right? We've seen some progress, but still holding above those targeted levels that they'd like to see. Obviously, the ECB going ahead with the rate cut, the Fed still holding pat, but I would be keeping a close eye on that the UK results tomorrow and the reaction in the British pound, and then ultimately the impact that has on the dollar.
Right, yeah, nice. Anything that surprises positively, it seems, from that part of the world has the potential to kind of hit the dollar now. The data are coming in soft because the dollar now, as I pointed out, that dollar yields chart, we're closing now with the dollar coming down. It's the same chart I talked about this morning. So the dollar, we talked about, we mentioned it for weeks. The dollar was elevated relative to yield, and in the last, call it 3 days, yields caught up to the dollar. So today, the thought coming into this was, if any of this goes soft, then you kind of have the dollar starting to close the gap, which it is now, because bonds are obviously rallying. The dollar is coming off in a pretty big way. Dollar lowest right now, it just ticked lowest since June 19th.
But I want to just kind of take a step back and just away from some of the intraday analysis as far as some of the price activity we've seen as of recent. Look at the bigger picture. I mean, the dollar in a very wide range over the last year or so. I mean, kind of a similar situation in terms of what we were talking about with crude yesterday, right? Yeah, it's inching its way up and a little bit of concern, but still holding below the April highs, still in a range. And I think that's supportive of stocks. And then lastly, yields. Similar situation, right? Yeah, we inched our way back up to 4.5% this week, but now coming off 4.35 right now. And range-bound contained, I think it feeds into what Powell, the word he uses a lot, which helps this market kind of green light to the upside, and that's balance.
Yeah. My big question is if now dollar down, yields down, is going to be interpreted as bad. That's kind of where, to me, the rubber meets the road right now, because we know when dollar goes down, stocks generally like it. And when yields go down, stocks generally like it. When you've got the inflation elements fixed, how can we spin it as a good thing?
My argument would be that down maybe is not going to necessarily tip the scales one way or the other until we break out and take out those lows that we saw over the last year or so.
All right, nice. Okay, well, we've also got holiday short in trading, so we'll see if the market makes some of it, but definitely that was about as worse as that print could have gone. I did not think that was going to go that poorly. All right, Jeff Pierce with us as we refocus on some stocks here. Market's doing nothing, so all right, chit chat, we're having a great time, but stocks are doing literally squat. All right, but we still got 60 minutes left here. Mr. Jeff Pierce to talk Eli Lilly. There's been a little bit of drama in the obesity drugs after politicians are trying to get in the way.
Yeah, they're certainly trying to cut down the cost. We've seen that, recent call for that White House calling for, different drug stocks to start lowering prices. reduce their U.S. price for Wegovy, Ozempic. Eli Lilly, of course, charges about $1,000 per month for Mounjaro. So, the drug diabetes and weight loss drugs. So that could be some pressure on these companies. Other news for Eli, though, of course, is the FDA approving their Kisunla, the latest Alzheimer's drug that they have. We know it was rejected last year due to insufficient data. Then surprisingly again in March, but approval had been widely anticipated after the FDA advisory panel ended with unanimous support for the drug last month, which is likely why we're not seeing much of a reaction in the stock today. But it's supposed to aid in the removal of those amyloid plaques that's believed to cause those memory issues and thinking problems. The treatment is expected to slow the decline of those issues, and with right now the Alzheimer's Association estimates about 6.9 million people are living with the disease, fifth leading cause of death for adults over 65. This is of course one of the biggest drug makers out there. They plan to really start promoting this with doctors, and cost-wise, it's going to cost about $12,522 for 6 months. For a full 18 months, over $48,000 now. Lilly expects that to be covered by Medicare, which is certainly a big deal when it comes to these approvals. But of course, there's competition out there like Leqembi, which comes from Eisai and Biogen.
All right. They've got a lot going for them, man. What a story right now for Eli Lilly. It's just to see the FDA give credit to this, and it's very hopeful, it's very inspiring, it's something that's been eluding these scientists for a really long time. So even though it's still just, to slow the process, it still is just such a kind of seminal step in the right direction that it's hard not to get excited about, and the shares reflect it. The weight loss stuff, sure, there's a lot of health implications of that too, but that's become such a cultural thing as well that Eli now kind of has both prongs. They've got the neurodegenerative side, they've got the obesity side. I mean, it's just cranking. It's just a beast.
Yeah, absolutely. And I think if you look at specifically when we think about the Alzheimer's side of this, that there was some disappointment when Eisai and Biogen released their previous drug, that Aduhelm, in 2021, really did not do very well. And now we're seeing Leqembi out there. Those sales are about 19 million globally in Q1. Of course, as you pointed out, if you look at some of these drugs that have really moved the needle in terms of revenue, Mounjaro, Zepbound, for Eli Lilly, they're flying off the shelves. They can't meet the demand right now. In fact, the company has just invested about $9 billion in a manufacturing.
Come on, baby.
This is the largest investment in Eli Lilly's history. So, expectations are high in terms of revenue. We've got to meet the demand on those Mounjaro and Zepbound drugs. Certainly, there is some pushback in terms of price, cost, and Medicare, Medicaid coverage, but you can't deny the company's been doing relatively well, right? Revenue coming in $8.7 billion, up 26% the last report. Looking at the stock price, I mean, it's incredible growth.
Wow. All right, good stuff. Jeff Pierce, good analysis. Thanks. Good numbers there, too. What's the numbers behind the rally? Big rally, extending it. Scott Bowers with us, doing some trading. CEO of Prosper Trading Academy. Happy July 4th. Scott, how you doing, sir?
Same to you. I am doing great. How about you?
Trading a little Eli Lilly here. We've been talking tech this morning. We hit the leveraged NVIDIA funds. We hit jobs. So, we're hitting obesity, too. And Alzheimer's.
Don't leave anything outside for what we can go after. And Eli Lilly has been a great trader, especially if you're short-term day trader. In fact, yesterday, full disclosure here, we had sold some put spreads yesterday that we covered today, which is great. Now on this news, fantastic news for the company. Saw a nice little spike this morning. It's back towards close to unchanged here. I'm one though that I look at this and I want to sell the news. Okay. Not that I don't think Lilly can just absolutely monetize, this latest news and the fact that the FDA is behind them now. I want to sell the news short term here. So what I'm looking to do, Oliver, and this was right there just about 20 minutes ago or so when Lilly was trading towards the high of the day. I'm selling a call spread. Just a simple call spread. I'm going out a couple weeks, July 19th expiration, to 920, 925 call spread. I want to sell that for 2.25, somewhere in that range here. That gives me a break even up at around 922 or so on July 19th expiration. And when we see these kind of reports come out, especially in a stock like Lilly. You know, we're not talking about a one-off drug stock. We're talking about one of the biggest kind of grinded out, biggest drug stocks that there are out there. We don't move that quickly. Yes, yesterday we had a lot of volatility. I really think that this is a great opportunity to sell a little upside here. Again, can it explode through? Absolutely here. That's why I use a spread. So I'm stopped out. I know what my maximum risk is here. But again, this is, there's always that thought process of buy the rumor, sell the news. And I think this could be a sell the news situation, at least in the short run.
You know, it hasn't been super volatile on the earnings, to your point. We had a few kind of gappy ones, but surprisingly, with such a momentous move, the earnings have been fairly calm. They don't really stand out on the chart that much. So if there's a bunch of expectations getting priced in for a big swing, it kind of seems like the history favors you a little bit in this case as well.
Yeah, absolutely. You know, I don't have a lot of room to the upside here, but that's okay. I'm willing to take this risk. I think that's a lot of premium, a lot of credit to collect here, even though it's only, $10, $15 out of the money or so. But again, the important thing for everybody to understand is I would never just go out and sell a naked call. That's why I do a call spread. My risk is defined. I know exactly in a blowout move to the upside what I am willing to risk if I happen to get stopped out. I like this one a lot.
All right, nice. Okay, so we'll sell some upside in Eli Lilly, go in the report, and falls a little bit too high. Hey, Scott, while we got you though, we just got pretty bad print. Market seems to be okay with it.
Market is okay with it. Excuse me. But I know you were just discussing with Ben, could we start getting into a situation where even though we want to see these slowdowns, the eco data slowing down, the Fed wants to see it, could we start getting into a situation where now all of a sudden the bad or the slowdown news is not good for the marketplace? I think that we have to be careful what we wish for here. Yes, this all points to the Fed, most likely lowering in September. They're not going to do it at the end of this month here. But I think we have to watch out what we wish for here, because if we do keep getting a continuation of really slow eco data, now all of a sudden they're going to be like, maybe it's not just a quarter point, maybe it's a half point, and the markets may not like that so much. Obviously, Friday morning will be a big number with the jobs report coming out, especially coming off last month's blowout jobs report that way exceeded expectations here. But I think the markets are very complacent. The markets are very accepting of the interest rate environment and everything that's going on right now. That maybe scares me a little bit.
Yeah, well said. Appreciate that, Scott. Good setup for us to have a macro discussion coming up. Thanks for the trade, Eli Lilly, as well. So a little upside into the report. Mr. Bauer, CEO of Prosper Trading Academy. Good stuff, Scott. The one and only Michael Purvis with us this morning. Excited for that discussion. CEO of Tallback and Capital Advisors coming to us next before he gets on the grill for July 4th.
Man, that's good tasting salad. And I got mahi fish.
#1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Markets are taking the lowest ISIN services since COVID pretty well here, with equities still up on the session marginally. Michael Purvis joining me this morning. A pleasure to have him, and I'm happy to say, ahead of the holidays, CEO Tallback Capital Advisors. Mike, thanks for being here today. Appreciate you.
Great to be on, Oliver.
That was a pretty bad number, wasn't it? Because the other lowest was 49 outside of COVID. That was the worst one since COVID.
It certainly was, and the new orders was pretty ugly as well. You know, when you look at some of the subcomponents there. But look, at the end of the day, this is one print out of several. We're dealing with an economic cycle that has a lot of noise on on a lot of individual prints. You really can't draw too many clear conclusions here. And you know, just the other day we had some JOLTS numbers that surprised to the upside here. I think the most important thing to look at is just economic data. The employment data, rather, that is, if the employment data really weakens here, then we have a problem here. But if an ISM survey is, gets prints below 50 and it's the worst print in a while, I don't know if that's really an indication that things are broken in the economy. So I'm going to say, look, you got to kind of withhold judgment right now in terms of predicting where the economy's going.
I mean, it's been trending lower.
The economy's still pretty strong.
It's definitely been trending lower. ISM's definitely been trending lower, right? Just this is kind of a crack. I mean, we were hitting obviously like 60s, a couple of years ago. But to your point, in the ranking of weighting, right, survey data generally not the top ranking. But to me, it really embodies kind of the pickle we're in, because the prices paid don't seem to want to come down. Whereas the activity really has, and that's kind of like even if it's just survey data, if that starts happening in hard data, right? That's kind of the worst case scenario.
That was the most disturbing part of this morning's print was exactly what you just said, is that it looks like some sort of industrial stagflation, if you will, which ultimately will bleed into the consumer if in fact that is a real trend and not just 1 month of an ugly print here. So you're absolutely right. That's the thing to be focused on there. But again, these surveys are volatile. They move up and down, and and they're surveys. They're not hard data. So let's withhold judgment, but let's be aware of what the issues are. Real issues is there sort of industrial stagflation.
Okay. Mike, when I'm looking at your recent market analysis, it seems mostly about intra-market correlations, the concentration skew, what that means for breadth. So it seems like that's where you think our focus generally should be, though, still at the moment, rather than the kind of macroeconomic stuff?
Yeah, well, look, I think you always focus on the macro. I think the macro conditions broadly in pretty good shape here. I think there's a discussion about term premium in the yield curve that that
think that spike was Trump? Where do you stand on that, Mike?
Well, yeah, I mean, look, if you look at the yield curve since the debate last Thursday, it's steepened about 20 basis points. It's all in the back end, right? It's not the short end getting big.
Come on, Spy. I need a little more.
If you look at when Trump won in 2016, the yield curve steepened by 20 basis points in 2 or 3 days. There, and coasted up a little bit after that, and then went steadily down after that, right? I think that's the question, though, is that whether if we do get a Trump victory here, and obviously that comes with a lot of footnotes, what happens to the House, the Senate, and so forth, but I think there's a real legitimate question about whether whether there's sort of a Trump turn premium that will stay embedded there, because looks like he's prone to having a loose fiscal, loose monetary condition, unlike today where we have a loose fiscal, relatively tight monetary condition.
Right.
So
but no
I think
shortage of pressure from our existing president, who said multiple times he thinks the Fed's going to cut. Mike, the steepening, though, it really happened. If you go to the intraday chart, it was on the PCE print, because bonds actually were firm after the debate. They were firm in the response to PCE, and then they reversed. And then it was like from Friday to Tuesday, basically. So, you know, it feels to me, part of me thinks maybe the market was like still holding hope out for a July cut or something, maybe.
Yeah, look, I think there's always some hopium about a July cut there. But look, you know, Oliver, I think what's important is to zoom out on, okay, let's say we get a cut in September or we don't get a cut in September.
Even?
I think you have to step back and, you know, like think about two questions here. One, is it really going, is 25 or 50 bips this year going to really have a material impact on improving the economy here? Because the economy has more forwards without, you know, despite the interest rate hikes, despite one of the most aggressive hiking cycles ever. So it's not clear to me how much that really impacts, you know, a cut will help. It might help boost markets.
No, great point.
There, but I'm not sure it's really, I'm not sure it's really going to flow through that much. And particularly if a term premium is sticky, things like mortgage rates are not going to be coming down then, right? Or not, maybe not coming down in a material way. If the term premium is higher there. And
drop a little more.
Inflation data continues to be saying that we're not getting a clear path to 2%, which I think is it's certainly my base case. I actually think that Powell's going to really, I think,
there we go.
I'm increasingly inclined to think that Powell won't cut at all this year, if anything, because if Trump does win, he's going to want to put as much dry powder in the tank as he possibly can.
Yes.
Right? There, because if I'm right that Trump win means a loose fiscal, loose monetary condition, you know, down the road, then he's going to want to keep rates as high as possible, unless the data really falls apart on us.
Well, I think it also, not to game too much into the political theory, but I don't think he's going to be around for very long if Trump does win.
Well, they're not exactly best friends, are they? And term's only a year and a half away.
So I feel like he might want to do one for his own record before he gets out. Mike, okay, but back to the point of correlations in markets, because really the most important thing at the end of the day for most people is, do I try and pick stocks or do I just park it in the index? And this has been like the biggest victory for index funds since their invention, this super highly concentrated market. It's like the number of stocks beating the S&P is at a record low according to Ed Clissold's analysis. So it's like, why even bother? Buy the index.
Well, it's a great advertisement for passive, or it's a great advertisement for really good stock pickers, right? And
93, 94.
We all know is horrible. I think just 25 names of the S&P 500 are actually beating the S&P 500, which is kind of remarkable there. But look, at the end of the day, you know, correlation.
So if you're in the puts with me, profit
are at the lowest levels they've ever been since really the late 1990s. And what's really interesting, Oliver, is that you know, that ultimately weighs on the VIX, and your earlier guest was talking about, you know, options and all that. But there's a
94 cents. There's big money here.
You know, correlations across stocks is going to stay is going to keep finding new lows, partly because of this tech outperformance from Mag 6 or whatever you want to call it. Is so they're such big market weights, and they're so decoupled. And that's going to drive down things like implied correlations and realized correlations, which is also reflective of, you know, basically a pretty healthy risk-on condition there. Now, you don't want to have, you know, you'd love to see a better breadth condition there, but that doesn't mean that the S&P 500 as an index equity rally is really in jeopardy. It just means that, you know, like
bingo, baby.
Earnings growth is driving the outperformance there. Mag 6 earnings growth is far superior to the SPX equal weight earnings growth. SPX equal weight is up 4% or so this year to date, and the earnings are up 4% year to date, right? It's really as simple as that. Mag 6 earnings are up 25% year to date.
Sounds like we go with it. We embrace it. That this is just how disruption works. The productivity and the earnings flow upward.
Yeah, and look, at the end of the day, from an equity rally point of view, you want an earnings-driven rally, not a PE expansion-driven rally, and that's what you're seeing here, which is actually quite healthy. So it's
Last couple weeks though, that got a little frothier though. Basically since Apple. I mean, Apple was pure valuation move though. I mean, last couple weeks.
Yeah, that's true. That's true. Yeah. The overall index though is really. If you look at Mag 6, for example, you've actually had PE contraction since the end of last year, right?
Amazing.
Because the earnings have grown faster than the price level there. If you look at the Mag 6 market cap weighted index.
Wow.
So that's healthy about this rally. What's not as good is that you'd love to see, bank stocks and retailers and the rest, really start, surging there. But their earnings growth is just simply not only superior from a quantitative point of view in these big tech names, it's a lot more, sort of predictable. They're like super high growth utilities, with the ability to do buybacks, which only reinforces earnings growth, resiliency and reliability there. So it's sort of quality and quantity of earnings growth in these big tech names is really, really compelling.
Yeah.
And there's less ordinary economic risk in some of the others.
Better to keep.
Obviously, Nvidia begs a lot of footnotes on that point, but
Sure.
They're because it is a chip stock ultimately.
Better to keep with the index and the trade then than try and get fancy with rotation. It seems like, Mike, you're pretty kind of content with the.
I'm not a big. I'm not. Look, I think I put out a cautionary note because big tech got super overextended early last week. That Nvidia surge there, but that was technical overstretching.
Right.
Like it was just ridiculously overbought there from here through the next several months, certainly through the rest of the summer. I'm gonna stay with what's been working. I think these tech monsters are earnings monsters, and I'm gonna keep I'm keeping it simple and just working with that. I think that's if you put a gun to my head and said I had to pair trade into the end of the year, I'd be long Mag 6 and short the SPX equal weight.
All right. Love it. Ride the momentum wave. Hey, a July 4th trade, baby. What's not to love? America first, building the bots, all the capital's flowing our way, same as it ever has.
Yeah.
Let's
Strong dollar.
Let that bird fly, baby. All right, Mike Purvis, appreciate your time, sir.
Yeah, anytime, Oliver. Have a great weekend. Have a great holiday.
Yeah, you man. Happy Independence Day. Thanks. Mike Purvis, CEO, Tall Bag and Capital Advisor. Right, there you go. You heard it. Short the equal weight and keep riding with the market cap math. Favors NVIDIA and the momentum trade. Coming up, Chart Master. Speaking of America, chicken, booze. Get that seltzer up. Thank you. All right, Coca-Cola. There we go.
On the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're going to always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Schwab. Did you say Schwab?
How's my favorite client?
Great. I started
He said Schwab.
now I can easily invest in trends, like wearable tech.
On the Schwab Network.
All that research sounds exhausting. Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Morning Trade Live. Let's get ready for the holiday. We got some charts. Rick Ducat, Jenny Horn. We got Tyson Foods. We got Bud. We got Coca-Cola. So which came first, the chicken or the egg?
The chicken, obvious. I don't know. I actually think in that argument, I mean,
Wilco says watch 547.75.
No, I think Tyson's actually the most
You're
interesting.
picking up what I'm putting down.
I am picking up what you're putting down, and I think I'm hungry because it's like, you know, late morning. We're like working a half day. I'm ready for you know.
Get the barbecue going. Let's go.
Yeah, we have a nice 4th of July theme with objectively like no major news on any of these names. So I just did some deep diving into like the cyclicality of Tyson's business. I think first of all is fascinating because obviously with exposure to like commodity prices, there's many factors that are, I mean, just entirely out of their control. So when the company did hold its last earnings call, we saw some overall, I'd say, disappointment regarding like their improvement in their pricing strategy, which led to some pressure. And it's hard to, I'd say, blame the street for that one because we saw adjusted earnings per share come in around 15 cents versus the almost $2 in earnings they reported just a year ago. So we've seen substantial decreases in like their growth, their profitability is one concern, but there's only so many things, again, they can really do to mitigate some of these commodity prices. Right now, the thinking is that with cutting costs, they're just waiting for some commodity prices to normalize. But one thing that is a bright spot is over the past several decades, I mean, they've grown their dividend by an incredible 800%.
Wow.
They have not paid every single year. There have been, again, some years where they haven't been able to do so, which some are saying now we could see them cutting their dividends. I think we're a little too soon to jump the gun and make that call. But with, again, the cyclical nature of their business, they do see market downturns, but they're resilient. I will give them that.
Okay. And the chart's not terrible, I don't think. But July 4th is a catalyst, not a thing.
No.
Okay. Like the Super Bowl moves like Wing Company.
No, I think the catalyst for 4th of July is more of like the travel component, but like as far as like some of these like the ancillary names you'd think would be associated, not really, no.
Okay. All right, Rick Ducat, what do we got?
You know, these are three kind of more consumer staple type names here. So not a ton of net change on the year for all of these three names here. We're only up about 9% or so over the past 52 weeks here. Still though, we did have some volatility during the year. Lows of around 45 went all the way up to highs of near 62. Since then though, we've started to kind of pare back a little bit here. We've got this white trend line, our downward sloping trend line here. That's still in play. We did break through this blue trend line though to the downside. You know, we kind of pushed below. We had this kind of V-shaped move here that stabilized right around our volume profile point of control, the area of heaviest trading on our chart, right near 54. So now we're in a situation where we're finding ourselves right around a cluster of our three moving averages. Yellow 21-day, orange 63-day, purple 252-day, exponential moving averages, commonly followed moving averages. They're all kind of grouping together. They're all kind of sideways as well. This speaks to a lack of clear trend direction. We've had some kind of choppy price action here, back and forth here. So this is kind of illustrating to us that we don't have strong directionality. When we look at the RSI, our measure of momentum, this tells a similar story. We've got a similar trend line, but we are right near the 50 midline that separates bullish and bearish momentum here. So not a strong read either way, once again, by this metric here. So when we look for support and resistance, this moving average is a definite point we need to work through to the downside if we start moving lower. This is a convenient spot to look for some footholds as well. Then we've got our lows right here that I mentioned before near 54 to the upside. Push above this trend line. That's what we need to do here. Then we topped out at this red line several times near the $61 mark. Once again, another volume note as well there too. So that could be a key area in the coming days.
Hey Rick, why did the chicken chart cross the moving average?
Why?
I don't know. I had no follow-up to that. Sorry, it's a great chart. I just was making sure I had that joke in the tank ready. All right, let's talk some beer. We saw the seltzer on the B-roll, which has been kind of the bane of their existence.
It's been the bane of everyone's existence. Seltzer isn't cool anymore. I mean, like,
stop drinking it, people.
I have to say that the way that every company was trying to basically copy like the success of White Claw, I feel like it's like the first one.
Right. Yeah, and then it ruined it.
It wasn't good to begin with.
It's like how all the mimic bands ruined Nickelback.
You're so right, and I think we should put more positive words around Nickelback because people are yeah, you know, that's another great. I mean, you know,
maybe Creed is the better one. They're all impersonations.
I hope I'm listening to them all tomorrow, frankly, and drinking a Bud Light. That sounds like a pretty good Thursday. But as far as Bud Light's concerned, I think that the story became really overblown when it was like all these like bad, I mean, like the bad PR that's been endured over the last several years, and
specifically Modelo did take over as the throne of like the #1 best-selling beer in the U.S. However, when you look back at last year, still over the course of the year,
It was Bud's
it
crown?
still was Bud. Is that amazing?
God, no.
The question we were talking about earlier, Caroline and I, about Constellation brands. So it was Modelo for a moment.
It was Modelo for a moment. It was like the last 2 quarters of last year, but still, when you look at the overall annual sales, Bud Light still comes out on top, and like by a significant amount. So that is frankly amazing. Is you could just look at like all of the various posts I saw on like X and social media that make me say no one is drinking Bud Light. That was not the case. They just lost the crown for 2. I think it was like 2 quarters. So yeah, good fun fact for you. But I also was really reading another interesting report that actually a Bernstein analyst did this report on like overall consumers where pot is legal are now drinking less beer. No impact on like spirits or wine, but they're drinking less beer, and that's now a concern for this analyst for a name like obviously Anheuser-Busch. So
interesting. Why would you stop drinking beer but not wine if you're smoking weed?
I have no idea because to me, if anything, that's like the
Because it's dinner, you dummy.
I see it complementing each other as far as
Dinner.
beer is concerned. But Bud Light, I mean, trades at like a relatively low valuation at this point, 22 times. It's actually higher than its historical average. It's been, like it shot up recently, but then has pulled back, and we're sort of back to where we were even prior to its recent run up. So it's like a whole big nothing of a chart as far as like overall price activity.
Yeah, right. It kind of has for all the drama around it. I don't know. I just don't feel that American drinking a beer from a company called Anheuser-Busch.
I see your point. I've always been a Bud man, though. That's near and dear to my heart. Not a recommendation. But once again, only up about 8%.
Or is it?
Once again, only up about 8% during the past year, kind of a sideways action. And because this is an ADR, it's very gappy. There's a lot of gaps on this chart. It's a foreign, derivative of a company that's not really traded in the U.S., but you can access it using this ADR product here. Nevertheless, this area right here is a significant gap because it was our earnings event here. That gives us a point to watch. Turns out that's about where price hit its low point after the move up, right near 50 cents.
Kind of heading back down there right now.
Yeah, and this chart, it's a little difficult to see because of the gaps here, but we had this rather consistent downward trend line in white. We pushed above it, though, and then we kept going down, though. So kind of a disappointment for the bulls who were looking for a breakout. Our old resistance trend line became supportive then here. And then, possibly, due to Constellation Brands earnings today, we're up on the day here. We're right near our volume profile point of control, once again near 60, which is quite close to our 21-day EMA. This is a confluence we have to work our way through. Once again, clustered moving averages altogether speak to
kind of like the other one.
Yeah, like a rather weak trend here. RSI looks a little worse here. We are below the 50 midline here, but at least we invalidated that downward trend line, so kind of more sideways. Ultimate high point to watch, this high point during our downswing, this little rally during our downswing, 63.50 would be one mark to possibly beat.
All right, so we're trying to get out of the downtrend before the old support, which is kind of nice. It felt like we didn't have to hit that, so a little buoyancy to the chart. All right, last one, Coca-Cola.
So, okay, I have to say, of all 3 of these, I think this is my favorite one, the one at least I consume the most. I just had Pepsi recently for the first time in like a decade the other day. It's terrible. I mean, Pepsi is awful. It tastes to me notably different than Coke.
It can't be that slow of a news day. They would debate Coke, Pepsi.
It might be. It might be that slow of a news day. But, okay, Coca-Cola, what is interesting about
Glad that you're keeping it honest and giving it a try.
You know what? I continue to channel checks everywhere. I'm always on the pulse. Maybe that is a recommendation.
Don't get compliance on you.
No kidding. But so as far as Coke is concerned, it is the largest non-alcoholic beverage distributor in the world. I mean, it has a $275 billion market cap. This is a pretty massive company, but it's so boring. I mean, like, even its chart actually looks...
It's good boring.
It is good boring, but it's one of, like, the most resilient, reliable stocks we can really discuss, and it has, like, now a portfolio that is vastly diversified. I mean, we saw some weakness in some of its overall, like, juice and water sales last quarter. Its overall, like, namesake business is doing really well, and I have to say, like, the energy drink aspect of this business, they've done a great job like continuing to reform and sort of adapt to consumers' needs. I know Celsius has been like the newcomer in the space, but Coke has various brands that are like caffeinated now, like hydration drinks, and they're really good.
I do. Yeah.
You're the queen of drinks.
I know. I'm a constant beverage trier.
Right.
Yeah, I have nothing but positive remarks to say all the various Coke products I've tried recently. Yeah.
That's a high bar for you when it comes to energy.
I know, and maybe that is a recommendation. Coca-Cola has some good drinks as of late.
All right, nice. Definitely going to get compliance on us now. All right. Rick, it looks pretty good. I mean, what's to say? Pretty good chart.
Yeah, not too bad. A little bit of some hiccups earlier in the year. Once again, kind of a V-shaped move, culminating with our yearly lows near 51.55. But nice move to the upside since then here. However, now we're in a situation where we kind of have this rising wedge type shape, two trend lines both converging toward each other, but the upper trend line has a much more modest slope here. What does this tell us? It tells us the pace of the gains is slowing down here. You can see we're kind of just squeaking up higher highs here, and actually during our last rally we did not take out those closing highs or the intraday highs here. So now we have kind of a double top situation to consider here that could lead to an energetic breakout if we do break to the upside and push above that level, or it could be a ceiling where we get rejected again. So you got to kind of weigh your choices.
It's definitely the most interesting chart so far.
Oh, for sure. Yeah, this is the most interesting one. And we can see also another piece of evidence that tells us the trend is slowing down, triangular shape on the RSI. RSI trending downward here, but at the same time making higher lows, but quite close to the 50 midline.
Coiled spring.
Yeah, exactly. You know, we
shaking up bottle.
We always are interested in these triangular price or RSI movements because, as I say often, low volatility is frequently a precursor to high volatility. It's getting primed for the breakout, much like a bottle of soda being shaken up.
No, actually, it works because you've got what, like, I mean, I guess the earnings, you've got 2 weeks, basically. You've got the earnings that do kind of fit in potentially sort of to the point of the ascending wedge or whatever it's called, that it might be kind of a potential catalyst.
Yeah, and remember too, rising wedge typically is regarded as more bearish. It's a more bearish pattern despite the name of rising here. Because what we're seeing is weaker and weaker highs and increasingly anxious buyers who get flushed out. You know?
Actually, that's the Bitcoin chart basically at its highs in long term. All right, interesting. Very cool. All right, thanks, Rick. Coca-Cola chart, pretty interesting looking there. All right, thanks, Jenny, for the July 4th fun. When we come back, our market meetup panel. As equities right now are still a little change. That's basically it. We haven't had a big response to ISM, but we'll be right back. Tesla's having a great day, up right now like 7%. So that's a big move on the session. All right, we got more ahead here on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Apple about to break pivot point.
To meet up chat here as we've got about 8 minutes. Kevin Green, George Tillis with me here this morning. We're heading out to the west, to the rugged lands of Utah, where a certain Greek is standing by with some market thoughts. George Tillis saying, good morning, man. Welcome to the conversation, GT. So the subjects basically at hand include market concentration that some view as positive or negative, and the other is this morning's data, which obviously missed, but no one seems to really care about ISMs, George.
No, I think, when it comes to the overall markets and the economy, OJ, I mean, if you think about manufacturing and construction employment, they're actually still very strong. So I think the backdrop of the economy is still relatively robust. We're looking at even some revisions of the Atlanta Fed's GDP model. They keep moving their needle down from the standpoint of GDP growth, but nonetheless, I think we're still growing, albeit at a slower clip in the economy. Now, the markets, on the other hand, one would say the concentration risk is bad, but at the same time, just look at these companies. I mean, I look at them as just mega monopolies, and so therefore, that's just what we're dealing with. And with that said, you could say that this is not necessarily an outlandish, concentration when we're considering these companies and the valuations that they manifest into the overall broader index like the S&P 500. So, yeah, ideally speaking, it would be good to see more participation across the board, but these are companies that have between 30 and 40% market share, but they also generate 30-40% of the profits of the index. So
Better get back in these puts.
Yeah, okay. That is really where I come back to our conversation with Matt Tuttle, too, about the fact that his way to play NVIDIA is just to be parked in his long levered fund because it's just so reliable from a profit standpoint, and also the fact that, as Mike Purvis pointed out, a big cohort of mega caps at the top have actually gone down in valuation compared to the start of the year, though that calculus
Get my
shifted
tea ready.
the last couple weeks here a bit if you include Apple and Oracle and some others, Broadcom too. But KG, I mean, to the point, it's hard to argue against changing anything until it breaks, because naturally the index is doing what it should. This is the whole great, Bogle view, which is we don't have to work, we just park our money and the index will do its work discovering the best companies on its own.
I mean, we've seen that work in the past, and that's why we continue to see melt-ups in this market. So, I agree with that. One thing to note when you're talking about the 2x levered and just parking there, I think we do have to kind of talk about, there is a daily reset, that risk that you also have with that. So what Matt is really trying to focus on is that the up days are going to outlast those down days, and you really don't want to see really sharp down days within those 2-time levered funds, because it is kind of tough to be able to recover that. But, you're right. I mean, when you're looking at the economic data here today, it's showing soft.
Double top on the puts.
Keep in mind here, it's soft data. And so soft data is not hard data. We're not having the actual numbers themselves. It's just the sentiment of these purchasing managers is what we saw as soft today. One thing to actually note when you read that report too, we had a situation where freight costs is starting to come into the picture a lot more, and that's where you're seeing the pricing headwinds. You talked about prices earlier, that it really hasn't abated. That's like the only thing that was actually very strong there. And the respondents are saying the same thing. And now we might be starting to see the residual effects of what happened in the Red Sea, as well as what we saw with the port flood in New Jersey. Maybe that is actually impacting these companies when it comes to container prices, as well as trying to ship freight around the world.
So the EIA number we just had, though, that showed a draw for crude, crude flipped around the negative now, which was kind of a sleeper data print for the day, since we're talking shipping and input costs here. Give me a quick thought on that, KG.
Yeah, so this is not outside of the norm. If you actually look at it this time last year, we saw a pretty significant draw as well. So the report came in at 12.15 million barrel draw when it comes to commercial crude oil inventories. Now, when you're kind of looking at the under the hood here, and you're looking at product supply, that wasn't really a huge spike to the upside there. When you're looking at gasoline demand, nothing of a huge upside spike there. But the key is the exports, and exports actually did increase by about 10% last week, which would equate to around, let's say, 2 million barrels, 2.4 million barrels for the week increase. So that could also be another reason why we saw that dramatic draw. But Oliver, this time last year when we had the same type of draw situation, this is where we actually did see crude move from $70 up to $95, around a 35% increase. So are we going to see that same type of reaction this year, knowing that we are seeing some tighter supplies and refining mixes kind of shift based on the economy? And I'm not sure what the answer is going to be for that. But if you are a bull, you want to continue to see significant draws like this across the board for all of these products.
Okay, a crude bull.
Yes.
It does. Well, crude always like fades whatever the EIA move is. It's crazy. It's like so reliable. Always does the opposite of what you think it should do. It feels like. That's why I don't trade crude. I can't figure it out. George, let's talk little jobs here for Friday. Numbers from ADP. Jobless claims seem to be fine. Jolts were steady at 8 million. So should we generally expect the status quo to hit on Friday?
I think so. Look, I think the revisions in the prior months, at least the last few months, to the downside are what we should expect. I think if you look at the expectations, right around 190,000 jobs, ideally, if you're looking at around 200,000 on average, that will essentially keep the unemployment rate steady, between 3.5% and 4%. We're obviously on the higher side of that from a natural unemployment rate, which is normal. But at the same time, I think from the standpoint of GDP and keeping the economy steady at a steady clip between 1.5% and 2%, the 200,000 number is right where we should be considering population growth and the demands for new workers. So, nothing out of the ordinary in the labor markets. I think looking within the labor market, I think it's important because I will stress that if you look at, historically speaking, labor market weakness starts to manifest in manufacturing and construction. And construction is very unique right now because if you look at new housing starts, we're running around 1.2 to 1.3 million, extremely low. If you go back to even the 70s, we were running over 2 million annual housing starts, and the population was much less then. So there's clearly still a housing shortage, so I think that's going to help keep construction employment relatively steady going forward.
I love it. Good assessment, George. I mean, the main underpinnings haven't become dislodged, but some of that housing data softened a little bit in the last couple reads. But this will be a pure labor look on Friday. Great stuff, guys. Thank you very much. George Tillis, Kevin Green, thank you for joining Morning Trade Live with me ahead of July 4th.
Oh, yeah.
2 more shows. Market's still open for 2 hours. Trading 360 with Caroline Woods is coming up next. Fast market behind it, and then markets close at 12 Chicago time. Have a great Independence Day. We'll see you on Friday.
Siri, yep.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full view. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device.
Schwab.
Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once
including myself,
we were able to help her move forward. Your client won't care how much you know until they know how much you care.
I don't care. So take that and shove it.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets.
Tesla's at the 63 on the 1 minute.
Anywhere on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Darn, 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 and din, din.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Caroline Woods, filling in for Nicole Petalides, live from the floor of the New York Stock Exchange. Coming up on today's show, our 360 Spotlight will feature several energy names to keep on your radar, and a discussion about AI in the defense space. Then George Sillis will walk us through today's disruptor, which is On Holdings. And our 360 round panel wraps up the show with a look at Constellation Brands after earnings. Before we get to all of that, let's take a quick look at the markets. Seeing some modest action on this holiday shortened session ahead of the holiday tomorrow, and of course a shortened trading week. Taking a look, the Dow has turned negative, down about 71 points or 0.2%. Salesforce, the biggest winner there, but being offset by United Health, the biggest loser. Meanwhile, the S&P 500 is holding above 5,500, up about 0.2% now. The Nasdaq up 0.3. We're seeing weakness in all of the Mag 7, aside from Nvidia and Tesla, though. Russell, meanwhile, up about 0.3%. Now let's check out some of the futures products. You can see the dollar, oil, and Bitcoin all lower. Bitcoin trading just above 60,450 right now. Meanwhile, gold is higher, up about 1.6%. Trading around $2,371. All right, for a look at some of the top moving stocks in today's market, I'm joined by Jenny Horn, markets correspondent here on the Schwab Network. So Jenny, of course, we're going to kick things off by talking about Tesla on the move again, up something like, 16% this week, and Wedbush's Dan Ives has weighed in. Tell us more.
Yeah, and I have to say, I give Dan Ives some credit because all of the analysts I'm seeing today that are upgrading or raising their price targets, Dan Ives has at least been loyal. I mean, throughout the duration of what has been a year of, so far, disappointing numbers from Tesla. So I think refreshing to see deliveries outpace expectations yesterday, and that's what initially sent, obviously, shares up almost 10%, actually as high as where we were in yesterday's session, adding to the fact that we saw a 6% rally on Monday, now up, like you mentioned, 16% roughly this week. Also making another move higher today. So I think this has been a very interesting reversal in some of the pessimism that has unfortunately plagued Tesla for the better part of the last year or so. We're still lower on the year, and I think that actually that 12-month mark speaks to the fact that we've pulled back very substantially, but attempting to recover. And as far as like the overall streak is concerned, I think that this is one of the most polarizing stocks out there, as you have Wedbush today with a $300 price target, up from $275. The new bull case, they said, though, is around $400 a share by 2025. They kept it out before trading. They mentioned the choppy start to this year and the fact that overall the Tesla demand story has made a significant turn for the positive as we head into now the back half of this year. And they said this could be actually a major turning point in the Tesla bull case as we look into now the second half of 24 into early 2025. They also said that with the majority of price cuts in the rearview mirror and demand stabilization globally for EVs, but especially in China, they believe that Tesla's march towards 2 million units as its annual trajectory should be reached over the coming quarters, with clear momentum and now easier comps into 2025. So this excites me. I like to see some overall price activity to the upside in Tesla.
Yeah.
Being beaten up so badly. Of course, the street low price target is $22.86. I believe that's from Gordon Johnson, who's a longtime bear in this name. But now 300 is the new street high, so optimism there. Average price target right now is around 182, so that actually implies some significant downside from where we're currently trading. Obviously, analysts haven't updated their targets yet, but I think it's been a fun week to watch Tesla. It's the first time we've been able to discuss beats and outperformance in quite some time.
Honey.
I think Adam Jonas at Morgan Stanley is still the
Come on.
Jenny, because he has a $310 price target, but
Ooh.
Guys has that bull case price target for next year, which is higher. And I actually have to correct.
I got a new girlfriend.
Now Tesla's now up 23% this week. I had said 16%, but this
Sorry,
5%
Jenny.
gain today really moving it higher. Now only down 2.5% year to date, so quite the recovery there. All right, let's talk about Southwest Airlines. A little bit different of a situation.
You felt a little relief there, didn't you, honey?
Poison pill actually shares higher on this news. What's the latest there?
Yeah, I thought this was so interesting. I first read the headline. I was like, what on earth does this mean? Yeah, we're seeing now a really interesting plan from Southwest. Poison pill is a really good way to put it, but overall, Southwest announced they approved the adoption of this limited duration shareholder rights plan that now will take effect immediately and will expire in 1 year. Now, any extension would be subject to prior approval by their shareholders overall, but the board, in consultation with its advisors, adopted the rights to the plan in response to this public announcement by Elliott Investment that it had basically accumulated a significant economic interest in Southwest Airlines overall, their common stock. So, in adopting this common right plan, the board considered, among other things, that Elliott, who had announced it built approximately a 11% economic stake in Southwest, has not reported its full purported position in Southwest on any filings with the SEC, and has made regulatory filings with U.S. antitrust authorities that would provide it flexibility to acquire now a significant percentage of Southwest Airlines voting power across two of the funds that start as early as July 11th.
Well, interesting.
I don't necessarily see this as like a major catalyst that moves the needle. I think there's a lot of people that are in agreement with Elliott that said they're feeling very much like leadership right now is to blame. I mean, we have not seen a recovery in this name meaningfully so since December of 2022 when we had various scheduling issues over the holiday, and they've just been yet to see things bounce back. Continual bad news, rising fuel costs, the macro situation as well are all things that make you say at this point maybe we need new leadership, and it's not necessarily like an industry problem, it's a Southwest problem at this point.
Yeah, the executive chairman of the board, Gary Kelly, who we know Elliott Investment Management wants to oust, as well as CEO Bob Jordan, said, "We are confident that we have the right strategy, the right plan, and the right team in place to succeed." So not necessarily in agreement with Elliott. So we'll have to see how that plays out, and if Southwest, or if Elliott ends up building a 12.5% stake. So Jenny Horn, markets correspondent here on the network. Thanks so much.
Thanks, Caroline.
All right, let's get some insights on the news that's shaping the markets. And for that, we welcome in Burns McKinney, Managing Director, Senior Portfolio Manager at NFJ Investment Group. Burns, thanks so much for joining us. Great to see you.
Thank you.
So as I was saying at the top of the show, not a whole lot of action today, but we are still seeing the S&P 500 above 5,500. Dow has turned negative, but overall the big question is, can the momentum from the first half of the year continue in the second half of the year? What do you think? Is there room to run for this market?
Well, first of all, oftentimes the best way to predict what's going to happen in the second half of the year is just to look at what happened in the first half. I know we as investors and pundits always like to call a turn, but typically speaking, momentum does carry the day, and so we should probably expect to see things do a little bit better going forward. Probably the biggest driver that could post continued gains later this year would be the fact that most of the recent reports show inflation continuing to come down, and as that happens, as you see jobs reports like we've seen today, and like we'll see a little bit more data later this week, showing no real breaks in the economy, but nonetheless a slowing down of the economy, that should give a Fed that has been very data dependent thus far the ability to move forward with possible interest rate cuts later this year, which could be the next catalyst down the line for the equity markets.
So is this rally dependent on the Fed actually cutting rates, and what happens if the Fed doesn't actually cut rates? The market's now pricing in, 2 cuts? The Fed said 1. Powell yesterday said he needs to kind of wait and see. So does this rally stall out if those cuts are pushed to next year?
I wouldn't necessarily say it stalls out, but it would definitely lose one of its primary supports. I think you do have a market for which, they finally converged on the Fed's dot plots with the expectations. We came into the year earlier this year with the expectations of 5, 6, 7 rate cuts, and I think the markets have kind of gotten a little bit of a dose of reality, and so they are in place there, but. That said, in many ways, things are a little bit priced for perfection with respect to, what the Fed does later this year, given the fact that, if you just look at valuations alone show that you have the S&P right now trading at about 22 times forward earnings, which is, more expensive than it's been about 80% of the time this millennium. And so you don't have valuation on your side. And so I would argue the markets are a little bit reliant to this day, on the Fed having the ability to at least cut rates once or twice this year. That said, what matters over the long term for investors who are looking out 2 and 3 years is not necessarily what the central bank does this year with respect to, does it cut once, does it cut no times, does it cut twice, but rather where they end up ultimately settling with respect to interest rates.
All right, so let's talk about areas of the market that you find attractive right now, especially given valuations. You say value equities are ready to turn a corner. So starting with just your sector picks, where are you finding value?
Some of the places we're looking at, we're looking for places that you do have secular trends working in your favor. The industrials are a fairly interesting space, given the fact that you have, we talked 2 or 3 years ago about the big infrastructure plans, but that said, a lot of that money is just now starting to go out the door. So you have, a lot of spending boost from infrastructure spending. You have, just with geopolitical turmoil around the world, that should give a little bit of a floor to defense spending, and valuations really aren't stretched there. So that'd be one place to look. Kind of an interesting place to look as well for investors that are looking to kind of maybe straddle the line between defense and offense is healthcare. The healthcare stocks really aren't trading at demanding valuations right now, and it's one sector for which you have both demographic trends and just the consistency of spending on the defensive side. But that said, it's also the sector for which going back over the last couple of decades where you had better earnings growth than any other sector. So you do get an opportunity to kind of take advantage of growth if you're wrong on that defensive positioning.
Okay, so in terms of a few names that you like, Honeywell. So you said industrials. There's your industrial name. Why Honeywell specifically?
Sure thing. Yeah, they really they stand to benefit from a lot of what I was just speaking of. You've got a name there that for years people thought of Honeywell as being a little bit of a miniature GE. They have a reputation for having great management. It's trading at it's had a little bit of a tough 2 or 3 years, and so as a result, you're getting Honeywell at a discount to its industrial peers. You have a name that's been extremely shareholder friendly. They've grown the dividend by nearly 10% per year over the past decade. And going back to the story of secular trends driving names, you have a name that a lot of the spaces in which they operate are very well positioned. They provide cockpits control systems for jets, which is an area where the increases in air travel should give it a little bit of a boost. And they're one of the dominant players in building controls, smart thermostats, which makes it a play on both the Internet of Things and really specifically energy efficiency. So that's one we definitely like.
All right, we only have about 30 seconds left, but I know you have a few other picks. You have Pest Control with ROL. You have Crown Castle CCI also as a pick. Any just quick thoughts on the two of those? One
that we are getting some looks at would be Rollins, which most folks don't know the name Rollins, they just know the name Orkin. They're one of the two dominant players in pest control, and it's trading relative to the market as cheap as it has in the last 10 years. And it's the type of business for which most of their revenues are recurring, they're contractual, so you do have repeating earnings, and they do the dirty work that no one else really wants to. It's the type of thing where you pay a little bit now or you end up paying a whole lot later when it comes to termites and the likes thereof.
All right, we have to leave it there. Burns McKinney, NFJ Investment Group, thanks so much for those picks and for your insights. Appreciate you being here.
Thanks for having me.
Have a good holiday. Plenty more to come on Trading 360. Next up, it's the big three stocks, three charts, three trades. Ben Lichtenstein goes through the technicals, and Don Kaufman of Theo Trade will take us through the trades for Eli Lilly, Intel, and Lowe's. That's next on Trading 360 on Schwab Network. We'll be right back.
Very interesting. CCI was on the list. Goldman Sachs initials coverage on Crown Castle. Gives it a neutral rating. FSLR. That's another one. FSLR. Oh, yeah. Okay, here's one that's pulled back. So it didn't bounce a little bit, but not much. Down to that third soldier. Second. Around 213.
He's Alex Coffey. Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Well, well, well. Come real close to hitting it yesterday. I have to keep an eye on this one. FSLR. A couple weeks ago, they were raising the target on it. First Solar. Might be interesting. Well, I must have mentioned it before right back here. It said something about 213.72. Or did I just put that on there? I don't think I did. Could have. Not sure you can get it off that. Yeah, there's a situation here. I did put that there. Okay. Well, I don't know yet, but I like it. FSLR. Frankenstein. Talking about Lily. I'm gonna FSLR.
Areas of consolidation, the vertical separation, the well-defined trend up, it all plays in here with LLY. It is in a very well-defined trend up off that 2023 low around 300, above 830 to begin the week in a breakout phase, seeking value higher. Let's keep an eye on this one because this one has some legs, conviction, energy. Hey, everything the bulls are looking for here, simply put, guys.
Yeah, and it's interesting because Wall Street analysts are still bullish on this name. If you take a look at the breakdown, the majority are in the buy camp, but the median price target's 880, so quite a bit lower than where it's trading right now. So it sounds like maybe there needs to play some catch-up from the analysts. All right, Don, let's talk about your next trade, and that's Intel. Quite a bit different of a performer this year, down almost 40% year to date. What are you thinking about that one?
Yeah, you know, chip demand is still largely in question right now with what could be possibly a slower economy. But look, you know, AI is all the rage, and Intel just doesn't feel like they're in the center of that. So right now, Intel has been holding in and around $30 support, which Ben is going to show you momentarily. And it has been absolutely unequivocally flat at that 30 level.
Yep.
I think we're actually going to see Intel
I agree.
under the 30 and actually go down to what has been an older support level, which is 25. And as such, I'm going to trade it for exactly that, but I'm going to give myself ample time. I'm going to go all the way out to Intel's September 20th options expiration. I'm going to be buying the 30 puts, buying the 30 puts, selling the 27 puts. So being that it's only a $30 product, I'm just going to do a $3 wide put spread, right? Buying the 30s, selling the 27s. The trade is for a $1 debit.
Looky.
Between now and the September expiration that we are going to crack through that 30 level, which looks very, very reasonable with, as I said, that old support of 25.
All right, Ben, walk us through the chart. Something tells me you're going to look at the 30 level.
Look, first and foremost, it's a more granular, very similar situation in terms of what we just had going on with Eli Lilly. A chop, right? Not a lot of conviction here one way or the other on a 5-minute candle. So I just wanted to speak to the difference between the horizontal phase and that vertical phase, which we'll get into in just a second. But hey, simply put, we are in a bit of a range here. 31.20, we'll call it right now, slightly higher on the day, but well-defined upper, well-defined lower extreme. 31.50 down to around that 30.20 level. Stepping back, you can see this is where we start to see some of that conviction, as I mentioned, which you can see easily separates those two phases, right? Where you break down and then you get that horizontal development where you accept the new lower level. And even as I look at this chart here, look, this pattern presents itself. I don't want to pull out the fine-tooth comb here, but I mean, multiple times here. You can see, again, high conviction, consolidation, wash, rinse, repeat, a staircase-type pattern, trend lower, bouncing around 31.50. Taking one more step back, I just wanted to show you this selling we're seeing here. Remember, we were talking about kind of a chop on the intraday. After a double top that formed going all the way back to the spring of 2020, we're talking beginning of 2021, stock's been coming under pressure, but I do want to point to, again, most recent lows still holding above lows lows here. That was back in October of 2022, beginning of 2023. And even as I look here, recent highs fell short of, again, those are the highs from, when was that? Up around the beginning of 2022. So speaking of kind of range bound and contained and not a lot of conviction one way or the other, it seems like, again, after that big move lower, it's been mostly just that.
All right, Don, your final trade is Lowe's. Lowe's is another underperformer this year, although not by all that much, only down about 4% year to date. So seems pretty modest compared to Intel. Talk to us about this final trade.
Yeah, inside of Lowe's, look, the interest rates, which is higher for longer, appears to finally be having a...
Ta-da. SPY hit 550.49 about 3 minutes ago. So, I mean, it's getting up there and teasing us now. 550 area, Jimmy said. What, a week ago? Let's see here. Okay, we're going to find out. I didn't see if we got right under 5 or 550.09. Crowd's going quiet. Jimmy says 550 is everything. 550. Right now we have the 9 sitting above the 21. These are EMAs. The 21's like the big brother to the 9. So if we break the 9, it could be a possibility that we hit the 63 and then hold that just to shake a few people out. But we're going to find out here real fast, within a minute. Someone's going to say, hey, man, you're getting heavy up here. You going to break the 9, or am I going to drop you to the 63? He says, okay. Here, get on my shoulders. Crowd's watching. Did you see the squeeze, everybody? Uh-oh. Here comes the chickens. Okay, get ready. Which now hit 4 cents. That was it. People are tripping out right now. Get rid of a few chickens. Jimmy's watching. Over here. Make a business decision. Okay. Oh, here comes 21. Check out this. So there was a little pop on cannabis today. ACB and Hillary and CGC, Cron. Oh, here we go. Spy at the 200 right here. Okay. July, right? $5.50s. X. No, the SPX has had a good climb too. It could drop. Oh yeah. Yabba dabba doo. FSLR. Yep, she's on there now. First Solar. Apple. Apple would have been a good one. Next time we see 210, if we do on Apple, that's when you want to check that one out. I think so.
Increase in revenue from AI that a lot of other companies have yet to achieve. So I do think still have some more upside.
So Matt, just quickly, when you look through to the rest of the year, you're obviously bullish on some energy plays there. So it's not just AI and big tech, but do you expect to see a broadening out of this rally?
That's one of my concerns. I mean, I'm bullish on AI on a very long-term basis, but I just don't think there's very many companies that are actually turning into real, getting the real revenues from this thing, and it's going to be longer, stretched out a lot further. So even though I'm bullish overall on a longer-term basis, it's only a few companies like Leidos that I think will do well on a more near-term basis. So therefore, I'm worried that some of these technology stocks, that people will start to pare back on it, and I think it's probably a good idea that they do. And so I'm looking at some other areas where people, kind of that barbell approach that you hear a lot of people talk about. With you still want to hold on to some tech, but lighten up a little bit there. Maybe add a little cash, which is paying you 5%, and that'll also help you as we go through these uncertain times. So, but one area I do think that in the energy area and the defense area, these are ones that are going to do well in uncertain times because this geopolitical thing, and of course what's going on with President Biden, it's just going to give us more uncertainty over the coming weeks. So it's a good way to kind of hide a little bit after such a great run in the tech sector. Don't be so reliant on that area.
All right, maybe getting a little bit more value. All right, Matt Maley, the Maley Report, thanks so much for stopping by.
Thank you.
Coming up next, it's time for the Disruptor as George is lacing up his Hokas and taking a look at On Holdings. More Trading 360 after this. Stay with us.
Oh, nice.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Caroline Woods, live from the New York Stock Exchange. It's time now for this Disruptors. George Silas, senior markets correspondent, is here with today's company, which is On Holdings, up after a Goldman Sachs price target hike. All right, George, set the record straight for us, though. Are you a Hoka's wearer, an On wearer, or something else like Nike?
Let's just put it this way. All three brands exist in my household in some capacity. But look, I think if you look at On Holdings, obviously this is a brand that's taking off when it comes to athletic wear. They actually have very, very nice outdoor activity, footwear, leisure wear. And the other thing is people are wearing from casual standpoints, but also from the lifestyle standpoint. And I think this is a very powerful brand that's taking a lot of market share away from Nike. And in fact, Hoka, which you mentioned previously also before the break, has been taking off. And I think Nike has been less innovative, and that's been the challenge for that company from the standpoint of their footwear, which is their primary business. And if you look at the price action just year to date, comparing the three, you can see that the trends are obviously moving away from Nike towards Decker's Hoka brand, as well as On Holdings. Now, if you look at the call today by Goldman Sachs for On Holdings, they actually maintain a buy rating on this name because it is still a growth stock, and they increased their target to $47 from $41. And I think what's happening here is after the stock moved higher in mid-May based on earnings, you're actually seeing a pullback from those highs based on what I suggest is a capital raise. And that's fine because the company's still growing its business overall. But I think their call is valuation, because it is a growth stock trading really at a reasonable price, considering that the earnings estimates for this year have actually risen from 80 cents to 97 cents. This is based on last quarter's results and revision of guidance higher. And going into 2025, they've also increased their earnings target to $1.10. Now, both of those numbers are actually quite low, considering the EBITDA growth estimates, which are growing sequentially year over year, and on a forward basis, higher 3% in 2025 versus 2024. And they're also, that's around 46% earnings growth. And if you look at sales growth estimates, they're also expected to increase by about 3 to 4% compared to last year, at around 35%. So you're basically seeing, earnings growth around 45%, just give or take a percent or two, and the stock is trading at less than 1 times its growth rate, around 36 times forward earnings. So I think this call from Goldman is valuation, growth at a reasonable price valuation, plus their earnings growth and revenue continue to accelerate, not decelerate, and that's a very strong fundamental basis.
All right, growth at a reasonable price for a sneaker company that doesn't actually have cheap sneakers. I will say I'm due for a new pair, and they're $170 a pop. But, Goldman thinks it can go to $47 a share. The median price target's $42. It's currently at $36.63. Walk us through an example trade for this name, given all of that.
Yeah, so if you look at the last 6 weeks, the stock has lost some momentum. And like I said, I suggest it's probably because of the capital raise. But if you look at the price action, the stock, at least in the last 6 months, seems to respect the 100-day moving average. So we can certainly see some additional softness. So you have to keep that in mind. So what we're going to do in this case is structure sort of a neutral to bullish trade. So it allows us flexibility 3 ways. The stock could pull back. It could also continue where it's at around the $36 area or go higher. So in this case, I'm going to go out to August with 44 days to expiration. I'm going to sell the $35 cash secured put. Now, earlier today, you could have sold that for about $1.75 a contract for a share, or $175 a contract. So effectively, by structuring this trade, that's your max profit, $175 a contract. But the stock could fall to 35, and you get to keep that profit, which is about 5% yield to strike in 44 days. But if you structure this trade, you have to be willing and able to take ownership of 100 shares per contract at 33.25, and that's your essentially cost basis price. So it allows us flexibility. So if you want to buy it lower, this is a trade you could consider. But also, if you want to harvest some yield as the stock sort of settles maybe to that 100-period moving average, this is also a trade that fits that same narrative.
So Wall Street largely bullish on this name, and we've found that there are the winners that can withstand a choosy consumer, and there are the losers that are feeling the impact of a consumer and not wanting to necessarily spend. But how at risk do you think a company like On Holdings would be if the consumer does continue to pull back?
Well, I think there's obviously risk if the consumers are pulling back, but I think the consumers who purchase their products or consumers aren't really price sensitive. And so there's a major cohort of folks that aren't price sensitive and haven't really been impacted by the effects of inflation. And so, generally those who can afford these products buy these products. And you're right, they are very expensive. They seem to have a resale price maintenance. In other words, they don't discount their products. They also allow customizable shoes now, and they're actually moving into apparel as well. So the higher-end consumer, let's just put it in that regard, I don't think it's too sensitive to challenging prices that On is holding, because people will pay a premium for brands, and this is certainly an innovative brand that has become very popular.
I've bought more than 20 pairs of these and have never gotten a discount, but Oliver Rennick seems to find them at Nordstrom Rack at discounted prices. So he's the lucky one. George Silas, thanks so much. Coming up next, it's time for our 360 round on all things Constellation Brands earnings. We'll bring in the panel to discuss next.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Ethan! How's my favorite client?
Great! I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech. Trends?
All that research sounds exhausting.
Schwab.
Schwab's technology does the work. So if I spot an opportunity in robotics, or
Right,
pets,
just like clockwork.
stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
It's time to look forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on next gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. It's time for the 360 round. We're talking Constellation Brands after earnings. For that, let's bring in our panel. Bill Kirk is Managing Director of Roth Capital Partners, and Dan Ahrens is Managing Director and Portfolio Manager at Advisor Shares. Great to have you both here. Dan, let's start with you. It was a mixed report, an earnings beat, a revenue miss. They backed their full year outlook, but something must have been said on that earnings call because shares were flat at the open, and now they're down 3%. What are your thoughts on this mixed report, if you will?
Well, it's good that they held guidance, but we currently have Constellation as an avoid. We have owned it in the past in our Vice ETF that typically owns stocks like alcohol companies. But in the current environment, we only own a couple different alcohol companies in that fund. They're greatly underweighted. We are not fans of Constellation Brands right now. And frankly, in the past, most people saw different rotations in alcohol. And what I mean there is out of big beer and perhaps into higher end distilled spirits. But right now, we're really not seeing much growth prospects in alcohol at all. Comparatively, there's a lot more cannabis sales and hemp-derived beverage sales that are really dinging a lot of alcohol revenue.
Okay. All right. Well, I'll talk to you about some of your picks instead in just a second. But Bill, I want to bring you into the conversation. You have a buy rating and a $305 price target on shares of Constellation. Curious what gets it there and what in this report helps or potentially hurts, because I'm seeing a headline saying expect lower volumes and margins in the second half of the year. Does that shake your confidence at all?
It does not. This reaction today is the wrong reaction for all the issues that the larger beer industry may have. Constellation does not share those issues. Constellation's beer business is growing 7%. It is now entering the seasonally largest period of the year. Every single week between Memorial Day and Labor Day, every single week is bigger than the Super Bowl. And all the shelf space gains that they received from retailers,
It is
start to
the
matter in
4th
summer.
tomorrow.
Consumption spikes. That's when being in stock on shelf at retail
Everybody be
every
safe.
large weekend really matters. So we actually think their performance from here can accelerate. If you look against the broader consumer staples world, their growth rate is 4.5 percentage points better than the CPG sector. And it should trade at a larger premium than it does to the sector. It trades at a very modest premium to the sector. So with that kind of outperformance, it is misunderstood relative to peers, relative to beer, and entering the summer.
Okay. So Dan, you mentioned it's an avoid for you. It doesn't sound like you have a lot of bullishness in the space overall.
Said
What
okay.
would you like more?
Okay.
In the alcohol space, our Vice ETF does still own a couple companies, but again, I need to stress those are currently underweighted right now. We're not seeing a lot of growth prospects in alcohol at all. We do hold Molson Coors, ticker symbol TAP. We also hold a small position in Boston Beer, SAM. Another interesting alcohol company that a lot of people don't know about is called MGP Ingredients, MGPI. They sell a lot of bulk alcohol and have some brands as well. In our Vice ETF, we're really weighting much more towards gaming. I mean, online gaming as well as casino gaming and restaurants. Fast casual restaurants are doing well in this environment, but we're shying away from beer.
But Dan, just to follow up on your Vice ETF, I was taking a look at the holdings. The biggest holding is NVIDIA. I don't necessarily. So are you looking at AI as a Vice? And I also saw Ferrari in there. I wish that I could afford to have a Ferrari as a Vice. But an interesting biggest holding in NVIDIA, not necessarily what one would think of as a Vice.
That's right,
it's all
baby.
about gaming. That's all about online gaming, which overlaps into AI, of course. It's about their chip business.
How dare you bash NVIDIA?
So it's it's not a core holding in vice that most people think of as alcohol and tobacco and gambling. But there's so much growth in online AI and gaming. That's why we have NVIDIA in that position there.
Woo!
All right, Bill, I want to bring it back to Constellation because it really just shows that beer continues to be strong, wine continues to be weak. Is that particular to Constellation, or is that just a new trend or a trend that we'll continue to see down the line in general?
That's not unique to Constellation. That is a larger industry phenomenon. Wine is softer than beer. Wine is a particularly hard category to develop brands in. A lot of wine drinkers shop by style, varietals, rather than have a specific brand. There's brand loyalty is beer. But what's remarkable about Constellation is they're delivering almost 10% earnings growth, despite their wine business being down 10%, despite their beer expenses going up on the depreciation side, and their capital spend going up. And I think that underscores just how strong that core business is, that your total company can still grow earnings 10% despite those issues and despite that exposure from wine.
And Bill, just quickly, is it a real threat? I'm seeing so many, non-alcoholic options
Well,
now.
it's nothing right now.
People are sober curious, if you will.
STZ.
Is that a threat to a brand like Constellation?
They've even launched their own. There's a non-alc version of Corona that came out earlier this year.
People better watch out.
As a total percentage of beer is about 1%, but it is growing about 30%. So it's only 1 point of the entire industry, but it is growing rather rapidly. The options have become much better, led probably by Athletic Brewing. The taste profiles are a lot better of the products, and they do substitute for some beer occasions, maybe some weekday occasions, maybe some pace of consumption type of occasions. So it is taking away a little bit of beer, but again, it's 1 percentage point.
Now, this was one that we talked about yesterday.
So the headwind to beer then, I guess, would be just 0.3 percentage points a year. So not the dramatic maybe substitution that some people make it out to be.
Or it might have been this morning.
We'll have to leave it there. Bill Kirk, Roth Capital Partners, Dan Aarons, Advisor Shares. Thank you both so much for joining us on Trading 360. And thank all of you as well. Download the free Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. Have
I'm
a
going to
safe
write
4th
down
of
the time
July.
on this
Fast
now.
Market is next, and I'll see you there.
God.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Whoa.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions. But
Oh, gosh.
I watched my mother go through being a...
Okay, that's enough. Sorry. Tesla back to resistance. Anybody in Tesla? Tesla back to resistance. Do. I'll get the push ready. We're back above 500 again. The answer is no. The answer to that is no. It's a tough decision. See, Jimmy says it's just not a car company. Now, Wall Street and Fat Cats, they look at it as a car company. That's a big mistake. It's a tech company. So today, it's not the cars, it's some other rigmarole stuff they're involved in. So Jimmy says, very good. We fooled the Fat Cats. Do you agree? Say yes. Why? Because of this. I'm going to wait for the pullback. $246 was my extension. The crowd's going wild here at the sports arena. I think Mike sees it. 245.99. We can go higher. Now where's your overhead resistance? See, under 260 on your overhead resistance. $240. Oh my God, 220. Yep. I'm going to say 240. $241. Oh, perfect. We get ready to sneeze. Okay, get ready. You ready for the magical number? 240. Exactly. Oh, yeah. Yep. I can see that happening. So we got it set at 241. Well, SPY just had a new high. Yep, that's not good. That's not good. $5.50 calls are up like 20 some cents. Jimmy no play. The video new highs, mannequin. New high. Up 190. That'd been nice. 550 strikes. 160 to 190. Might have been more than that. I forgot what they were at. Oh, yeah. SPX. Very low volume. Very low. The 5220s. Puts. Here they go right here. $115. 105. Okay, the crowd's going looking for a knife. Merry Christmas, Jimmy. Oh. Hmm. I got the puts and the calls looking at them both, but SMCI boom. That one right there is going to make you rich. New high for today, SMCI. There goes the SPX and the SPY. Boom, baby. Nice. That was like a $200 boom right there. Be careful. Very good. Big boom on SPY. Very nice.
Just to kind of run through some of the commentary that I've seen, Bernstein kept an underperform rating on shares with a price target of 120. Does not believe that Tesla will achieve its goal of growing unit deliveries this year unless it materially cuts prices and provides very favorable financing, which of course they say pressures margins and free cash flow.
Stretch my back for a second.
They don't see a lower cost Model 2 arriving in volume before 2026. and anticipates that new lower-cost models in 2025 will be relatively modest tweaks, which are unlikely to stimulate demand, tweaks to the Model 3. Meanwhile, Guggenheim did raise its price target on Tesla, but only to 134 from 126, so kept accelerating on shares, saying a 5% delivery decline never looked so good. The analyst there believes that most of the 10% jump was actually due to record energy storage deployments, not car sales. That's something else that other analysts are bullish on, that actually are bulls as well, specifically Garrett Nelson over at CFRA. Wells Fargo kept an underweight rating on shares with a $120 price target, saying fiscal 2024 number are still in question. Obviously, the expectation around the annual number is 1.8 million, which would be about flat, but other analysts are thinking that could be weaker. The first half of 2024 pace implies 1.66 million annual run rate, according to Wells Fargo, which would be down 8% from 2023. And then JP Morgan also kept an underweight rating on Tesla with a $115 price target. And the analysts there actually focused on the fact that vehicle deliveries declined year over year by that 4.8% for a second straight quarter, despite global battery EV market growing 22% in Q2, saying this implies significant share loss. We know competition is heating up, so JP Morgan really focused on that. But of course, there are bulls as well. B of A raised the price target to 260 from 220, kept a buy rating, saying both Tesla and Rivian sales show there are some signs of life in terms of EV concerns or EV demand concerns. And then, of course, Wedbush's Dan Ives raised his price target to 300 from 275, has a bull case of 400 for 2025. He thinks the worst is in the rearview mirror. He says Tesla's march towards 2 million units annually should be reached over the coming quarters, and says Tesla is the most undervalued AI play in the market in our view, with a historical robotaxi day ahead for Musk and Tesla on the 8th that will lay the yellow brick road to FSD and an autonomous future. So Dan Ives getting even more bullish there. Obviously, all of that negative analyst commentary, though, not weighing on shares today. They're still up about 5.4% at this point.
So Caroline, I mean, obviously we probably are seeing new bulls getting into this particular space and short sellers getting out as well, which is probably fueling this rally to the upside. But my question for you, when you're looking at the analyst notes, you brought up the energy space, and it's a very small slice of their overall business, but it has rapid growth. Are you seeing any analysts really trying to factor that into their projections moving forward, knowing that we just saw their business pretty much double their capacity in a matter of a quarter, and that side of their business generates around $1.6 billion worth of revenue? I mean, that could actually tip the scales for top line and bottom line growth in the coming quarters.
Yeah, actually, Garrett Nelson over at CFRA, who now has a $250 price target, still a buy rating. He's obviously a friend of the network and has been a Tesla bull for quite some time. Actually pointed to today's rally as, or the gains that we're seeing as due in large part to that energy storage growth. He says that's becoming an important aspect of the story. It's something we don't talk about a lot, but Tesla sells backup battery storage to residential customers and utilities. And Kevin, as you said, it deployed 9.4 gigawatt hours of storage in the second quarter. That was a record, and the prior high was 4.1 gigawatt hours. So a huge jump like that could impact, obviously, sales and earnings estimates. So even the bears, I had mentioned one, looked at that as potentially positive to earnings. And then the bulls, like Garrett Nelson over at CFRA, says that's becoming a bigger part of the story. So it's not just the automotive sales as we know. It's the AI component with the robotics and the autonomous vehicles that will get that robotaxi event on August 8th, which should be, the bulls think, a huge catalyst for Tesla, although the question is how much is priced in at this point. But that energy storage is definitely a part of the business that we should be taking a closer look at as well.
Yeah, a couple more catalysts coming up. Earnings on the 23rd and that August 8th robotaxi event. All eyes will continue to be on Tesla. Thanks to Caroline Wood, Senior Markets Correspondent here, breaking down the story here. But Nick, I want to bring you back in here because I look at Tesla and I look at RSI, Relative Strength Index, at 83, overbought on a technical basis. Parabolic move to the upside. There's a lot of optimism in this name, but you're still seeing a slowdown in EV sales. I don't know, oil's at $83 a barrel. Maybe that helps a little bit. But give me your take, and you got an example trade.
Yeah, I think Caroline, in the comments that she was giving us from the different analysts,
as always with Tesla, show just the massive disparity in how the company is valued and what they are. Right? You see, price targets $100 below where we currently are in a void, and you see, $100 above where we are and strong bias. So I think you almost have to take those with a grain of salt. But the opinion to me is driven by, is it a car company or is it not a car company? It's been this way for a long time.
Oh my gosh.
There's been such disparity in terms of those ratings. If you look at just the EV components of it, which a lot of those negative analyst ratings or downgrades are doing, EV sales right now are slowing. Not too bad, right, in the scheme of where they came from a year ago. So the slowing trend has halted, but they are losing shares. So you're like, well, that's bad on top of bad, right?
Yeah.
The overall market's slow, and they're losing some shares. So negative story on that side of it. But if you look at what Dan Ives put out and other sort of similar theories on the fact that it's not just a car company, that it's an AI company kind of in waiting. You look at some of the LiDAR and the sort of tracking and the autonomous driving that's potentially going to take over the entire space with the robotaxi event. You look at the charging stations that they're essentially creating the grid for the country and probably trying to go beyond that. And then you tie in these other companies that aren't even public. You look at the way that they're putting out their own internet service, or he is Elon Musk's internet service, and tie that to SpaceX. It's like, are you part of the bigger piece of it, or are you thinking this is a car company and measuring it by those standards? That's why there's just such this massive disparity. So that we can get into the trade here in a second, but I think even though overbought in the short term, you don't see a lot of mega cap stocks moving 20+% in a week. I do think that yes, this could go either way. I think if they lean into the AI component of it, they talk more about that in the autonomous driving with the taxis on August 8th. There's a potential for this to still rally a bit from here, but you certainly have to be cautious given how far they've come so quickly.
Right. So let's break down this trade real quick, Nick. I'm going to go through it for our viewers here real quick. It's a diagonal, but it's a long-dated one. You're going out to the October 250 strike call. It's about $5 out of the money to the upside. You're buying that. That's 107 days to expiration. And then you're selling the July 5th weekly options that expire in just a couple days here. The 255 strike call. So it's a $5 wide. Bullish, somewhat bullish call, diagonal to the upside. You're paying, we've got a $25.75 debit, so $2,775 to the upside on this one. On the price on it, $25.75 I've got, but it's actually gone higher because the stock's moving higher, so you got to take that into consideration. But what we have here is $25.75 debit, but that takes your break evens to about 242 and 275 to the upside. Nick, when you look at this, the key to this trade is the rolling, that you want that short 255 strike in the July 5th options to expire worthless, and then you still got the long October 250 calls that have over 100 days, and that's where you can start maybe rolling or selling other calls against this, reducing risk, right?
That's right. It's only $5 wide right now, but there's a lot of price volatility in this time because there is so much distance between those. So when I sent this trade, it was about $26. It's $27.50 now. So you can play with the strikes a little bit. It is intended to be a bullish play, right? Given the fact we rallied already, you may move that short strike in the short week up one. I was trying to take advantage of the holiday week there, and the rally that we've already seen. But giving yourself a lot of time, you'd have almost 20 rolls, right? If this continues to work, so you'd be long that 250, and then you're able to roll. Assuming you're managing that, and not getting assigned on that, which is important. But it's a big cash outlay. But the argument for continued rally through that August 8th day, we're trying to avoid that going beyond there, take a little bit of that volatility out of it. Yeah, it gets past earnings as well, and then you're ultimately just playing this to chip away at the cost of that and get long the upside for a bit less than it's currently trading.
Right, and those rolls on just a weekly basis. If you look at the July 5th, if you look at just the at-the-money roll on the 245 strike, if you were to roll that from this Friday's expiration to the following, that's nearly $5 in credit that you can collect. So, as Nick mentioned, this is one that needs to be managed, but if you let that 255 strike call that expires this Friday just expire worthless, it stays below there, then you can start doing some trade management as long as the market's open on that, reducing risk. and maybe selling other calls against it, and then increasing potential profitability. But right now, into expiration, you've got 2 break-even points on that one just due to the short call that you sold in the near-term options. All right, good look at that example trade there. Thanks to Nick Theodorakis, Managing Director of Market Risk at Charles Schwab. But coming up after break, Kevin and I will be joined by Landon Swan from Likefolio for a look at sentiment data on PayPal. Fintech stock has underperformed the market over the last couple of years as a new CEO tries to work on new initiatives. Stick around, Fast Market coming right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close.
Oliver.
Then the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I remember when I first started flying and we would experience turbulence. I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
Oh boy. Does anybody think 600 before the election? That's a good question. I thought 550.
Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. That's going to be Landon Swan.
I thought of 550.
Likefolio. Welcome back to the show, Landon.
Thank you. Thanks for having me.
All right. So, Likefolio data, I'm wondering because PayPal is down about 3% this year. It's been lagging for a couple of years. Hey, they've got over 420 million people on their platforms, Landon, but that doesn't equate to maybe growth, and we've seen those numbers stagnate here a little bit. Do you guys have the data that kind of backs up the weakness here that we're seeing in PayPal?
Yeah, I mean, there's a lot of weakness. If you look at like a 3-year chart of this company, it's insane. I mean, it looks very different than the 1-year chart. 1 year, you're like, all right, we're kind of holding steady. But when you look at the 3, you're like, whoa, where did we used to be? It was so much higher. So this is way, way off from highs. This is an old name. I mean, this was like pioneer in the internet. They were part of eBay back in the day. They were huge.
PayPal.
They kind of fell off. They're making a little bit of a comeback.
I added that to my watch list yesterday.
So it's really interesting to see, the evolution of PayPal. They did get upgraded this week. They do have a low PE ratio, only 15.
There it is.
I will say that, they had a period of declining user base that started in 2020. Every quarter from 2020 until last quarter was a decline in user base, and they added 2 million.
Disney's up 70 cents.
They snapped that, right? They reversed that downtrend. The good news is that their total payment volume's up about 14% on a year-over-year basis. Their transactions per account is at an all-time high of 60. So there's a lot of potentially good news as to what's happening. Maybe the bleeding has stopped, right? But the bleeding is real. I mean, when you look at the total mind share of users talking about PayPal versus Shopify and Square, PayPal's at 73% right now, and 2 years ago they were at 82%. So that they have dropped significantly. They're losing to the competition, and honestly, it's mostly PayPal, not the Venmo brand. So PayPal, we've seen a plateau or a fall off, but Venmo is actually doing fairly well. This mind share chart here is what I'm talking about. Basically, it's sitting at 74%. This looked like 2 years ago that PayPal slice was at 82%. So Square and Shopify are starting to expand at the expense of PayPal. So they're really taking market share away there. But yeah, I think a lot of it has to do with, is this PayPal? Is this Venmo? What's going on between the two? And it's, obviously PayPal's a huge user base compared to Venmo, but Venmo brags and has users that have about 22% higher disposable income versus those users of Cash App. So these are the better users to have on Venmo. They've got 90 million US users, but you can see here in the chart when you break out the brands that the growth just isn't there. I mean, that's why the stock chart looks like it does, is because they just haven't been able to do much. Now, they've got a lot of initiatives, they've got a lot of goals that they're trying to turn things around. You talked about the new CEO, and this is a stop the bleeding situation, and frankly, the stock price, if you look at it, is fairly low. I mean, you can talk about how it's kind of in the lower end of the 6-month channel, but a 3-year chart is extremely low. But I think deservedly so. They've lost a lot of market share. They've got a long way to go to come back, and I think it's an aggressive stance to take now to say that they're low enough and we're seeing the ship turn around. We're seeing the very first inkling of maybe the bleeding has stopped, maybe the ship is turning around, and it might be a good buy. But for me, I got to wait for a little bit more data to confirm that they're actually turning the ship in the right direction, and maybe this could be low, when we look at it years from now. But right now, I'm not convinced.
So Landon, when you have this data set, especially that mind map that you kind of called it out here, you're talking about total mentions. Do you have any insights into positive sentiment, or is it negative sentiment? Are you putting all of them in just one basket? Because I would kind of look at that data too, because you said that there was actually increasing last year, but the stock was sliding and their experience was sliding. So is that kind of an inverse correlation when you're looking at some of these fintech players in the space?
Yeah, we didn't include any sentiment data today because there's not a huge talking point on that. PayPal's slightly lower than Venmo, but across the rest of them when you're looking at the competition, there's really not a lot to say that people are unhappy with Venmo and happy with Cash App, something like that. The numbers are all pretty close. So we're actually mostly looking at how much people are talking about them. What's the web visits look like, just as a volume metric, really. And I think the main thing here is that that mind share has moved so much. I mean, that's a big number to go from 82 to 74 in just a couple of years. But like we talked about, over this last quarter, they stopped the 3-year bleeding trend, and they've actually added some users. So we'll see if that starts to bottom out and maybe potentially grow.
Landon, when you look at the competition in this space, I don't use PayPal or Venmo anymore. I use Zelle, right? Because all these banks are interconnected. I don't have to have another account. Is that part of the problem? And then also now with the new tax laws in place for a lot of these, where you can just transfer money to somebody, you've got to report all that stuff. Is that causing some problems and headwinds for this company?
That is probably, you talked about sentiment. That was probably the biggest negative spike among these companies that we've seen, is that tax law. And, knock on wood, maybe November something will change with that. Well, who knows? But, I think that's definitely a potential problem for these companies. I think the limit's $600, right? I mean, that's peanuts. And everybody's making $600 transactions all the time over the course of a year. So yeah, that's definitely a problem. And yes, to your other question, absolutely, the competition is tough. I mean, back in '99, PayPal was groundbreaking technology, and now it's just anybody can create a platform like this. Banks are getting in on it, so they have a lot of competition.
So Apple's above 220 right now.
The key is going to be UI and UX. How easy is it to use these platforms? What's the user experience like? Because like you said, if you could just connect your bank and then Zelle somebody some money, why use PayPal? So the PayPal has to have a very strong user interface, very strong user experience, and people are going to go where it's easiest. It's all going to be cheap. There's really not a lot of margin on the user to user side. Where the margin lies is on the merchant side, and that's actually pretty interesting for PayPal. They're launching this what they call Fast Lane, which is, I guess, their kind of answer to Square. It's a checkout services. They're in test mode right now. They've got high conversion rates, and so they're looking to answer the market's questions about how can you become more viable. And I think that's a really good potential solution for them. We'll see what adoption looks like. We'll see what those conversion rates look like, because in the end, merchants are going to use whatever gets them the most money. If it's Square, if it's PayPal, if it's just standard checkout, we'll see. But I like that they're at least trying.
Yeah, and you mentioned that Susquehanna upgrade price target up to $71, positive from neutral also. All right, great stuff, great data. As always, Landon, have a great day. Have a great holiday.
Yeah, happy Independence Day. Thanks, guys.
Thank you. That's Landon Swan, co-founder at Likefolio. KG, the upgrade, the new CEO that came over from Intuit, Alex Chris, he's trying to make some changes. They're trying to use, because it seemed like they had a bunch of different wide array of platforms to use, but they're all trying to streamline that. Maybe that'll help with costs and
let's
the
hope it
job cuts that
does.
they announced. But give me your take here on PayPal, and you got an example trade.
Yeah, I think it's still a little bit of a tough space.
Apple's double topping here.
Some consolidation over the next year or 2 years could actually improve or help out PayPal's ability to be able to gain market share. But it does sound like they are trying to streamline some of the back-end operations, and some of those synergies will actually impact the bottom line. Knowing that and knowing the technical setup where it looks like it could try to potentially break out to the upside here, looking at a call spread here, actually buying the call spread, looking at the July 26th, 60-65 call spread, doing this for a debit of $1.15. Now the max loss on this trade is going to be the debit paid for it, so $115. Max gain is going to be the difference between the spread, which is $5 minus the debit that is spent. So the max gain is going to be $385 with a break even of $61.15. Now, Tom, typically you would like to actually sell maybe a put against this in order to try to reduce some of that premium, but just knowing the historical nature of the stock in the past, where it can gap to the upside or it can gap down fairly quickly, there was a lot of a fair amount of downside risk. So kind of looking at this spread in order to maximize the potential upside move, maybe, and then also minimize the risk to the downside, just in case we do get some bad news or we get a Hindenburg type of report like what happened to Square and things of that nature. So very conservative, still need a move. But once again, the technical setup and then also the fundamental setup, the buybacks are all bullish in nature right now when it comes to PayPal.
Yep, they did spending 100% of their cash flow on share repurchases also. But let's break this one down. July 26th weekly cycle. So you've only got a few weeks until expiration on this one, 23 days. And earnings are the 29th. So, Kev, I like this setup where a lot of times, or historically, you'll see some stocks rally into earnings. You're avoiding the earnings event on this. It expires a few days before that. But buying the July 26 weekly 60 strike call, selling the 65, $5 wide bullish call vertical. As Kevin mentioned, the risk on this is the debit you pay, so $115 per spread. But KG, it's got a good risk reward setup here for PayPal going into this. You've got 3.5 weeks in this particular position, but one of the keys I always like to tell our viewers is when you're buying verticals like this, if the stock does rally over the next 23 days, and maybe this thing expands to $2.5, it gives you some opportunities if you do a 10 lot to maybe parse some of your position also, right?
Or even a one lot, man.
Yeah,
I'll take $150. Yes, it does allow you to trade out of this spread earlier if the market does allow for you to do so. And having that run up into earnings, that's the biggest risk that we have. That downside risk that I was kind of talking about. If they have a bad earnings announcement, or if they don't surprise the street, then you can see a gap to the downside, which you want to be able to avoid. So trying to find a little bit of an opportunity for a melt up in implied volatility moving into the earnings announcement, potentially seeing the price advancing, especially in the favorable rate environment at this point in time. And yes, you could get out of it earlier if it does allow. So 10 lot or 1 lot. You know, it's got a little bit of walking around money with the 1 lot there. You know, some good money. At least.
Yeah, or 100 lot. It depends on how much risk tolerance you have. You got to remember, just 3 weeks ago, this stock was above 65 bucks a share. So it's not like you need a massive rally to some outsized number at this point. But a good look at a bullish call vertical there in PayPal if you think that's going to rally into potentially earnings. All right, thanks to Kevin Green for joining me today here on Fast Market with co-hosting duties. But we're going to take a quick break. When we come back, we're going to take a look at Netflix. The stock's rallied nearly 40% so far this year, helping out. I don't know why this stock wasn't in the Magnificent Seven. It should have been. Maybe it should be the Magnificent Eight at this point, but it's had a good run so far. We'll talk about that when we come back right here on Fast Market.
Dig it. I'm gonna rest up. Let's start a new challenge.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere. On
AMD is the chip. Yes.
No place better than the Schwab Network.
We're right at the 200 right now. AMD.
Here on the Schwab Network. Before we take a look at Netflix, let's bring in Ben Lichtenstein, Senior Futures Contributor here. Benny, we've got, it seems like the path of SPX higher, NASDAQ higher continues, and the laggards, the Dow and the Russell, actually now negative.
Yeah, absolutely. That trend still in place, that's for sure, with the S&Ps up to 55.33 today, another new intraday all-time high, closed above yesterday. I think it'll be, if we do, I think it'll be the 33rd new all-time high just this year. I mean, this market's been on a rip. The NASDAQ as well, up to 20,183. Last I looked, off those upper levels here right now, but you can see not by much. 3 of the 4 majors in positive territory, to your point.
We're at the 200 on AMD.
411. And then you've got the Russell, which is just kind of an outlier, to say the least, up to down to 2038, I think it was, basically, right around now, these levels that we're trading. Yeah, there it is, at 2036.
Spike hit the 200
after
too.
coming off levels we saw up around 2049. So the Russell unwilling to hold that upper level. Rallied earlier, but it sold off. The other majors, for the most part, especially the S&Ps and the
strike,
NASDAQ, holding that upper level. After data today and rates hanging out around 4.35, the market likes it.
Yeah, it does.
You mentioned rates at 10-year yield. Just 2 days ago, Ben.
Like it's so much it's going to drop.
Highest level since the beginning of June, so 1 month highs. But we've seen that crater. That's probably lending some support to equities, right?
Yeah, it didn't stay long up there. That's for sure, right? Yeah. Fed Chair Jerome Powell kind of walking investors back off a cliff and talking about some of the progress we've made in terms of inflation. You know, what stood out to me, Tom, was the June low was down around just below 4.2%, right? And then we screamed higher back to that 4.5 level. So there was some concerns associated with that crude rallying as well throughout the period last month, right, from 72 to 82 and 84 this week. But the data also was, kind of been supportive of rates to the upside. But again, to your point, they've come back off here, and I think we've been range bound and contained, and that's helped the market along this trajectory to the upside.
All right, great stuff. As always, thanks to Ben Lichtenstein. He's the host of the Future Show here on the network every morning, 8 a.m. Eastern. Catch him weekday. But now let's bring in our next guest. That's going to be George Tilla, Senior Markets Correspondent here. George, we're talking Netflix. This is one I kind of wanted to hit. It's up 40% so far this year, up 55% from year-ago levels. I mean, this should have been in the Magnificent Seven because it has been straight up over the last couple of years.
Yeah.
It has. I mean, this is a pretty remarkable turnaround, and I think I'm going to put another company in the same camp, Meta Platforms, because both of these companies, if you look at performance in the bear market, which really started back in November 2021, they declined significantly, and they've rebounded significantly since, of course, the correction now manifested through the end of 2022. So I think this is a great story for Netflix. If you look at price performance, it's really getting close to those $700 intraday.
SPY just went boing.
Late 2021. It's been a steady mover, and overall, I think their business
New high.
has really successfully pivoted, and so they really have focused more so, and they talked about this even last quarter when they reported earnings. Subscriber growth, they're not going to be reporting it going forward in the next year because of the composition of their revenue breakdown, which is now growing advertising. So these are advertising-based companies. I'm going to throw Meta Platform in that same camp. And that's where Netflix is going. And so I think the restructuring of their pricing plan, for the marginal viewer, essentially going to the advertising model, and then of course those who want to pay for the logins, they did pay. So they actually restructured all the pricing to again pacify those who are at the margin, not a very active viewer. That's been a good strategy. But at the same time, one thing about Netflix is doing is its subscriber ads. If you look at last quarter, it grew 16%, sales were higher 15%. So when you see the subscriber growth faster than revenue growth, that's very positive. But one of the things I noticed, Netflix is less profitable than it has been in the past historically in terms of its growth rates, but its margins have expanded. And so I think what's happened here is the pricing restructuring has really impacted the bottom line, even though the growth rates for both sales and earnings are actually down compared to their 5-year averages. Their profit margins are higher by about 30%. At the same time, their multiple, if you look at the forward multiple, at least for 2025's 30 times earnings, it's trading around 38% discount to its 5-year average. So the company seems to be executing very well operationally, because if you look at the operating margin growth that the company's generated, it's about 45% compared to, when I calculated it, to late 2022 for the full year. So they've become more efficient. They've actually increased their margins slowly, and irrespective of the decline in sales growth, 11% is estimated for next year, and that's significantly lower than their 5-year average, which is around 17%. But effectively, the profit growth is also going to be around 24%, which is below their historical average. So all the averages on a historical basis are higher than its last year, but their profit margin has expanded. And I think it's an important story underneath Netflix, because they really seem to be operating extremely well, irrespective of the slower growth rates.
Yeah, and I think that margin expansion due to this ad tier that came into fruition. As of mid-May, they had 40 million users on that, so that's probably helping widen out margins. George, my question to you is, though, when I look at the PE and the forward-looking PE, they're getting pretty thick here. Is that a cause of concern as we're getting close to that all-time high of $700 a share?
So that's the thing. It's a good question, and again, like I brought up just a moment ago, if you look at the revenue growth rates, it's about 10% lower than its historical average. If you look at the earnings growth rates, it's around 12% lower than its historical average. But the stock is trading at an earnings multiple about 30% lower than its historical average. So one could make the case that even though the profit growth rate and the revenue growth rate is decelerating, that it's still cheap on a historical basis. And I'm looking at 2025's forward multiple around 30 times compared to the 5-year average of 49. So I think it's a situation, Tom. Ideally speaking, let the market tell us what's happening. Obviously, the trend in the last year has been higher, but I think that level, which is right around an intraday basis, $700, needs to be broken for potential trend continuation.
Yeah, they got earnings coming up. One more quick thing, George. We've got like 20 seconds. Is subscribers, 270 million subscribers paying, but saturation here in the States, but
she's moving
international enough to pull them, or to support maybe this high valuation that we've got.
So here's another thing. Yeah, that's a good question. If you actually look at what they've done on an international basis, they seem to have tapped into the price sensitivity of the international markets to actually lower prices internationally. I think that's been a great strategy because it just adds more users in the international market because they realize the saturation in the United States, but they still have tremendous opportunities internationally. And so they're essentially tapping into the willingness to pay.
Just book resistance
through the different price structures, ad tiers, and so forth, but also international sensitivity to prices. They've lowered them, and I think it's been a great move.
Yeah, they're taking a playbook out of the pharma companies, sticking it to us here in the U.S. by having higher rates.
Exactly.
Of course. All right, great stuff. Great backdrop for us. That's George Tella, senior markets correspondent here, breaking down Netflix. Now let's get to an example trade here on Netflix. As George mentioned, getting close to those all-time highs. It did stall out just under $690 a share about a week ago. So I'm looking at that, and I'm looking at the earnings event that's coming up on the 18th of July. So I want to avoid that with this example trade that we're going to look at, where maybe it does have a little bit more upside, doesn't get up towards that previous high that we've seen at 689.88. So looked at a call butterfly that's broken wing, and I'm actually going to collect a credit on it. So let's break down this trade. July 12th weekly cycle, so just about a week and a half until expiration on this one. You're going to avoid that earnings event.
You got me on that one.
Of the 685 strike call, I'm going to sell 2 of the 690 strike calls, and I'm going to buy 1 of the 710 strike calls. So staying risk to find on this
$7.70 for the 55.30s.
$5 wide call vertical that's bullish, right? And then you're selling a $20 wide call vertical to help finance it. You're collecting a credit on this one of $2.25.
SPX.
That means your max loss would be $1,275, and that's all the way above 710 is your max risk or max loss on it. Now look at this. Look at how this is set up.
820.
This type of strategy where if I'm collecting a 225 credit, it takes my break even up to 697.25. That's just below 700, above the previous high that we saw last week. So you want this to kind of creep up because you have that little kicker there right at your short strike of $690 per share. Now,
I mean,
if the stock
870
falls or stays where it is around the 681, 682 level, you just get to keep that credit that you collected. Where you have that little kicker in there, starts at the short or the long 685 strike up to that short strike at 690. Now, that break even, 697, right? You've got about
the puts can be changed.
So you have that cushion where you actually can be more profitable on this, but anything above at 697.25 level, it starts to tail off a little bit. Now, it's currently trading $2.85 credit, so you can actually get a little bit more credit on this, and that would take your break even up a little bit. But I think on this type of strategy is where you believe that maybe it's going to go lower, right? So you get to keep that credit that you collect of $2.25, but it continues to grind higher like it has been over the last year and a half. I mean, if you look at that chart, we've had last earnings, it did dip. It filled that gap within a week and a half and then rallied to those fresh 3-year highs at 689.88. But now we're starting to consolidate a little bit. So you kind of want to look at that that type of strategy in that way at that point. But this is it's a bearish to neutral type strategy where even if it does go higher and goes against what might happen going into this earnings event, you still get that kicker in there. Now, what's your max profit on a trade like this? Well, your max profit's going to be that 225, and then the kicker at the short 290 strike. You have a potential to make nearly $770 on this, $75 on that. That's if it settles at or near 690. But the idea in this type of strategy is you profit in 3 out of 4 scenarios, right?
That's your
If
support
the
line
stock
right
goes
there.
lower, you get to keep that credit. That stock goes lower, you get to keep that credit that you collected, 225. If it goes higher, or stays where it is, you get to keep that credit that you collect. If it goes higher, you get to get that little kicker in there where you're profitable.
Good 530s.
All the way to 690.
Big spread on 'em.
Is your break even. That's where you basically
Big spread.
want it to stay below 697.25. But good look at a skewed or broken wing call butterfly collecting a credit on that one. All right. That's going to do it for us today here on Fast Market. Make sure you download the Schwab Network app, available in the Apple App Store, and tune in 24/7 right here on the Schwab Network and schwabnetwork.com. Have a great day.
Boom, boom. $2.90 to $6. I'm gonna see if I can sneak one in here for 2.
Forgot to look up to see the fireworks.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
I don't want to say nothing about his dad. You can tell he loves him. What's the deal with this thing? Oh, your dad. Corn artist. Market stop. Something awful fishy going on around here. Something all fishy going on around here. Were you telling me this is over with? The fuck, man? I didn't tell them to close the market. The highway robbery.
Yeah, let's hit the bar, huh?
Yeah. Huh. Well. I'm going to be shopping for vacation. Tesla was proud today. Market's closed. Woo! Huh. Well. I'm about ready to take the rest of the day off. Not sure, Randy. It's either Negril, Jamaica, where all the prostitutes are, or Mexico, Cancun. I could. I think it's a very weird way we ended the session. So I'm going to take a break. And catch everybody later. Be safe. I get some drink. Go to Aruba. I don't know what to do. Catch y'all later, YouTubers.